Morning. B Semiconductors, clearly one of them, quoted 9% higher on TradeGate. They're talking about a long-term sales outlook that may be impressing investors. We'll see if the market digests it in the same way. And Barclays is actually downgrading the European insurance sector. We'll see what the read-through is at the open, Anna.
Okay, so we'll look for weakness at the start of the European trading day. U.S. futures also pointing lower on those same trade headlines, that trade narrative, looking a little bit risk-off right now, but not to the extent that we're expecting to see it in Europe. So we'll see if we are indeed to see German stocks down by 0.8% as futures had indicated they might be. Of course, the FTSE 100 often goes its own way, did so yesterday. We see it a little bit more resilient, perhaps, to the downside around trade, although we've already had news lines around trade and the impact of trade tariffs on the UK economy linked to April's GDP print, so perhaps we'll get to that conversation a little bit later. So the markets we have open right now are in negative territory, down by 0.5% on the CAC, down by 0.8% on the DAX. So there's that negativity. We'll see if it's concentrated around some of the exporting names, if it is that trade narrative that is weighing on things. We also have SAP to factor in, Critty, and any read across from the Oracle numbers overnight. So we'll watch the tech names over in Germany as well. Broadly speaking, then, it does seem as if this trade narrative is something that weighs on sentiment.
Absolutely. I think we have a few answers already right from the get-go, which is a little bit unusual for the German index, where we do see it open. And a lot of this is, to your point, Anna, actually coming from SAP, but perhaps in the opposite direction that we expected. We expected a positive read-through from Oracle. We're actually seeing the opposite. ASML, SAP, Schneider Electric, they are actually some of your biggest weights this morning when it comes to these markets. And you are seeing a very defensive tilt across the board. So bank stocks as well, some of those cyclically exposed names also taking a little bit of a beating. One bright spot, though, one spot in the green, that, of course, is utilities, but that, of course, screams defensive, screams risk-off.
Yeah, absolutely. Utilities going higher, energy going higher as well. So we see the likes of BP, Total, Shell, Eni, all moving higher, and that they're pretty heavily weighted, of course, on the markets they exist in, and partly reflecting that big move higher we saw in yesterday's session on oil prices, because we're down 0.8% on the oil price this morning, but we were up 5% in yesterday's session at one point. So there does seem as if we need to factor that into markets. But as you say, Critty, those two sectors in positive really stand out as being exceptional. The rest of the market is pretty downward looking right now. Travel and leisure, actually, the worst performing sector, and that again might be a reflection of energy price moves. So when oil prices move sufficiently, that can become the only thing that matters to companies such as TUI, Lufthansa, EasyJet, Ryanair, all of those down by more than 1.5% in this morning's session.
Absolutely. You point to the Total story and the oil story there as well. There's another piece, especially for Total, that might be contributing to that heavy volume we're seeing to the upside. Some news this morning, a statement coming out. They are partnering with Mistral, which, of course, is the major European AI offering, perhaps, when they're talking about their innovation lab. So perhaps a little bit of an AI read-through into a sector that doesn't traditionally talk about AI. We're also, I should mention, getting a halting in shares when it comes to BE Semiconductor. So a lot of heavy volume there as well. We've got one eye on the energy space and one eye on the tech space and one eye on the overlap as well. Joining us now to digest all of this news flow, Virginie Messonnier, Global CIO Equity for O Equities at Allianz Global Investors. You picked a great day to join us because we don't really know what's happening, which I think feels like the norm now, in that we have so many of these trade headlines to digest, so much of geopolitical risk in various parts of the world. What do you do in an environment where you don't know what to do?
Well, I think you have to think that the markets have rebounded quite nicely since the lows of April, right? On the NASDAQ, we're up about 30%. Europe has done quite well. You've had the U.S. and China discussions, which were not bad, but they didn't come out with a big boom, right? 6 months rare earth. China wants 14 nano, and they probably got 28, or So you need a pause in the market. The market is absorbing this. At the same time, you've got oil prices flaring up, impact potentially on inflation, which is quite important, and geopolitics. So in that environment, I think you want to reassess all your holding. You want diversification. You want very strong portfolio construction. Maybe take a little bit of profits in names that have done really, really well, right? And just see what happens. I mean, really, that's the thing. I'm not seeing this as a major risk-off. But clearly, as we approach the July deadline on tariffs, there's a belief, I think, in the market that things will be extended. And it's possible that Mr. Trump tries to heighten the pressure because he is under a lot of pressure himself, right, in terms of his tax bill, et cetera.
I mean, to the point that he even, and we played this at the start of the show, was comparing the likes of his relationship with South Korea and Japan, which is supposed to be the bright spot in these trade arguments, to the likes of the EU. So to your point, the volatility story persists. You were often on our show, and we ask you what the pain trade is. I'm going to ask you what the opposite. What is the lazy trade in this market? What is the go-to sit back and watch trade in this market?
Well, I mean, for me, you still want to be in tech. So, you have to be in tech if you look at how things are developing. So if you don't have enough and tech names come back, because generally they will come back if there's a risk off, you need to position yourself, right? Same for industrials. If you're not in China, you have to add to China if you have a risk off, right? We've done a bit of work around robots in China. It's actually quite amazing. 50% of the world installed capacity, 2/3 of the patent, 66% of the humanoids, robots. Those are really interesting opportunities for the long term. And that's where you have to say, but diversification and portfolio construction is key.
Okay. Diversification, portfolio construction, and humanoids. These are the messages I'm taking
not only humanoids,
yeah.
But if you have an opportunity to buy and you're not positioned enough in tech or industrials, you want to be.
But this
there.
is important. I think it's interesting to think about tech from a number of angles because we are tackling the US exceptionalism story in lots of ways this morning. And one of those is around US technology.
Yes.
And how much is the China technology story eating into that US exceptionalism? I mean, that's a stretch when you look at NVIDIA. That's still by far and away, a standout performer. But how worried should US tech be about what we're seeing coming out of China?
So, you have to think about what is US exceptionalism. Are we talking about the historical legacy, security umbrella, US dollar strong, US Treasury, everybody sells, trade deficit, people sell to the US, get US dollar, reinvest in US assets? Or are we talking about the exceptionalism of some companies, their mindset, their innovation, their risk-taking attitude, their ability to fail and pick up and go again, and which is an illustration of the tech sector. If you look at the pillars of the historical legacy of US exceptionalism, I think we see some cracks. Some of them self-induced because we are departing from the Second World War order, in that shifting world order. And the U.S. has domestic priorities that sometimes come in contradiction to this service, if you want, right? So I think that's one thing. But if you look at the tech sector, still very strong. But as a result of shifting world order, we have this bifurcation, China, US, or China, rest of the world, particularly in tech. So you see some innovation. And of course, in China, you have 18 million engineers, challenges in demographics. So you need that innovation. Yeah. So there is competition, but there's still absolutely room for US tech names in the portfolio.
Okay, so that's the tech conversation. Let me ask you about yields and how they play in here, because if we're changing the world order, we had a conversation last hour with our guest who was talking about how that means dollar weakness, and that also means higher long-end yields in the United States. That might spread globally. Where does that are you playing that, is that steeper curve? I know that, equities are your focus, but is that steeper curve going to be something that damages the equity trade?
So shifting world order is a sliding path. It's not new. It's been going on for at least 10 years, right, as China ascended. The increase in yields in the U.S., in my view, is the response of very specific actions and uncertainties that are currently in the markets around new presidency, tax bill, deficits, where does it land? Where do tariffs land to pay for those changes and deregulation and tax bills? That, of course, has an impact on the world, but that's still very U.S. specific. If you look at Europe, for example, we've got, sub 2% inflation, we've had cut-in rates, we've had, a very different environment. Now, if long bond rates were above 5% in the U.S. for a long time, I think, which is not our central case, right? I think you could have that spread, but the U.S. dollar and the U.S. market is still very, very large. And it's not like everybody are going to sell all their assets overnight. So I think you're in that phase. Let's see where we are in 6 months. The economy will have slowed. The tax bill will be through. We'll know much more about tariffs, and let's see where yields are at that point in time.
Can you just connect the dots for us here about, we do see these jitters, of course, to Anna's point, in the bond market off of the deficit. But is that simply just a volatility of the bond story that then moves the equity market, or is there a fundamental case of how a deficit affects the corporation that we need to be thinking about?
So, yes, of course. And it affects it in the cost of capital. Right, because if you think of growth companies who finance themselves and who think very long-term, they have to think about long-term cost of capital. And if the long-term cost of capital is much higher, it will have an impact on how you finance your growth. Therefore, you need to demand for higher potential earnings from your investment in order to take into account that cost. So there is definitely an impact.
But does that impact... Is that impact cushioned, perhaps, if you see a more gradual move in yields?
Yes.
Or what are we worrying more about a more, quite literally, a cliff dive, basically, in yields?
Yeah. Gradual moves are always better for the equity market than sudden moves, except if sudden moves look like an aberration, a technical reaction, or where people say, let's keep things within a bigger framework and understand what is going on, right? That's the key.
Virginie, thank you very much. Thanks for joining us. Virginie Massenet, Global CIO for Equities at Allianz Global Investors. Let's visit the Core Six. Have a look at some of these key European mega names, if you like. Novo Nordisk, in fact, it's all red. That tells you something, doesn't it? We're all red across these European equity markets this morning. Almost all sectors in negative territory. Only energy and utilities go higher, and they're not really reflected in this Core Six. So Novo Nordisk, LVMH, there we are. Nestle, a little bit of defensive pickup perhaps there, but Nestle is pretty flat this morning. Let's check in on some of the individual stock movers then. There are a few to choose from. Where do you want to start, Joe Easton?
So we'll start with BE Semi, Anna, because that is really the big mover today. We were up around 10% at the open of trading, now up around 7.3% over in Amsterdam. Now, the company projecting that its revenue target could potentially hit 1.9 billion euros in terms of its medium-term annual goal. It previously estimated around $1 billion, so that was kind of the uplift in their forecast this morning. This coming from an investor day for the firm. It's the semiconductor machinery group, so a really big gain for that one. Coming down a little bit now, but still up 6.8% for BE Semi. Then in terms of the sectors, as Anna mentioned, energy really the strong spot today, given the gain in crude. Crude slightly lower this morning, but on a two-day basis, still up around 4%. So we're still seeing a boost coming through into BP, Total Energies, Shell as well. All of those stocks gaining more than 1% today. And then that feeding through as well into the airlines. The airlines significantly weaker. It does seem to be partly due to the oil price coming up, but also news on fares out of the US yesterday. Another drop down in airline fares, a third month of decline. So we saw United, American, all of those US listed stocks coming down. We're seeing that feeding through today into the European names. IAG, Lufthansa, Air France, all pretty much lower. Air France down 5%, a pretty big move in that one. Then finally on insurance, as Kriti flagged earlier, we did see Barclays downgrading its sector view on insurance. This is pretty much all due to valuation. It's the third best performing sector in Europe this year, and Barclays saying that the rally has gone too far. So they're cutting three key stocks today: Allianz, Swiss Re, Zurich, all downgraded. There are some actual insurance issues potentially related to natural catastrophe losses and property and casualty insurance. A little bit weaker as well, but it's mainly due to valuations and those insurance stocks falling in early European trade this morning.
Joe Easton from our equities team walking us through some of those early movers as we, of course, see a risk-off tone across the board. Coming up on the program, let's talk about perhaps different asset classes also dealing with that risk-off mood and some heightened tensions in the Middle East. Oil hit with volatility as those tensions rise over nuclear talks with Iran. We'll break down the latest headlines and what you need to know. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. $1-trillion industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. 8:16 then here in London. So just 17, in fact, 17 minutes into our European trading day. And equity markets are weaker, with the exception of the FTSE 100, which is pretty flat. The DAX down by 0.7%. A host of factors taking us a little bit weaker over in Germany. The negativity overall perhaps can be attributed to the latest trade headlines coming from President Trump and Howard Lutnick. More specifically, what's more resilient this morning is energy stocks, and that is to do with the latest moves in energy prices. So oil prices in yesterday's session surged really strongly, up by 5% at one point. We didn't have time to factor all of that into our European trading day, and so perhaps we do a little bit more of that this morning. BP, as you see, up by 2%, and the rest of the sector pretty resilient, even though oil prices have retreated from those highs and are now down by around 0.9% on Brent. So we're at 69.16 on the Brent price. So with oil edging slightly lower, but after jumping more than 4% in yesterday's session, let's focus on the oil price. Traders are tracking rising tensions tensions in the Middle East and the latest moves in US trade policy, both of those pulling in different directions. Our Bloomberg Middle East energy markets reporter, Anthony DePaola, joins us now from Dubai. So, Anthony, take us through the factors that are driving the oil price right now. A big focus on politics and the potential for violence, I suppose, in the Middle East.
Yeah, and that out perfectly in terms of explaining the two factors that are really the push and the pull here, the trade on the one side and the geopolitics on the other. And if we look at that picture, it's really that risk of something happening in terms of the Middle East and in terms of an outbreak of potential violence in the Middle East between the U.S. and Iran, between Israel and Iran. That's really the risk that is pushing prices higher. We've seen also some positive news coming out in general about the U.S.-China talks, the fact that they think those talks went well and that they're progressing. Those are going to be bumpy as that goes along, but that then eases some of those concerns about the economy and that are weighing on the oil price as well. But then some of those negativities pull that back. But I think the real story here, even though we are seeing a little bit of weakness today in the oil price, the real story is that big jump that we saw yesterday. And even before going into yesterday, when there was about a 4% gain, we had seen a couple dollars more on the oil price since the start of last week. So we've really seen kind of a buildup as things looked more positive there in terms of oil. So I think really what is driving this is that those issues around the Iran talks, the fact that Donald Trump came out yesterday and said that the talks that he didn't think they were going very positively. A lot of that is push and pull. We've seen this happen before, where Trump will come out and say that it's going well. The Iranians will come out and say that they haven't gotten what they want. We see this back and forth, but what is really driving that is that tangible concern, where we see the U.S. Potentially pulling out some non-essential personnel from the embassy in Baghdad, which shows a real threat there. We have also seen some warnings for vessels in the regions as well, which we know they have been under threat too. So we are seeing these real kind of tangible signs that people are getting concerned. So we think that's really what's inside that higher oil price at the moment, Anna and Greet.
So, Anthony, this is the drivers to the upside of the oil price, as you mentioned. Talk to us about what may be weighing on the downside, because oil market traders also have to be thinking about what these trade talks actually mean. What is the more dominant factor for an oil watcher at the moment?
Yeah, again, right now it's that geopolitical risk of something that happens in the Middle East. And there is in the background that risk of economic tension, economic stress caused by a failure of the trade talks. So anytime that we hear something negative about some bumps in the road in the trade talks, which of course there will be, we're still in an environment where there's a massive amount of tariffs between the U.S. and China. Trump again is talking about coming in with the reciprocal tariffs and naming those amounts as we come to the end of that 90-day period. Bessent giving some more positive spin on that, saying that if countries are engaged, maybe they'll get another 90-day extension, but there's still a lot of uncertainty now, so that is kind of pulling on that. But I think one thing that the oil market is telling us as well, too, is that there is still that big concern about an interruption of supplies that could come out of a conflict with Iran. It's also showing us that at the moment, the market wasn't putting that much of a downside on Iran coming back, because as we were seeing the positive news up till now about how the talks have been going, we have seen oil kind of bottoming out between that 60-65 area. So that wasn't a huge leg down. And that comes as well with OPEC bringing lots of more oil into the market. So we are seeing that oil kind of holding up around that $60 a barrel mark up until now. We did report earlier this week that things are looking good in the market in terms of the fundamentals of the market, in terms of demand as we go into the summer. That could weaken going into the second half of the year, so we should see that drop. But we are seeing at the moment, with the fundamentals strong and with the up until now positivity about Iran, we'd seen oil kind of in that 60-65 range, so not hugely lower. now we see that, of course, as there's concern that those stocks might unravel coming up to the 70. And it'll really come down to if people think there's a risk to the supply coming out of the region. That's really what traders will be watching, Kriti.
Certainly something we're going to be keeping a very, very close eye on. Anthony DiPaolo, our Bloomberg Middle East energy markets reporter, walking us through the dynamics in the oil market. Let's take a hard pivot here and talk about the dynamics in one of the biggest retailers in the UK. Tesco shares on the move this morning after the company reported sales that beat estimates. Shares higher by about 1.4% in a fairly weaker broad market session. Charlie Wells is here with the latest. Charlie, walk us through these numbers.
Yeah, Curtis, so they had a beat on like-for-like sales, beating estimates, and a lot of this has to do with price. So Tesco, in a lot of ways, has kind of been meeting the consumer where they are, which is very price-sensitive at the moment. And, you know, it's an incredibly competitive market. Ken Murphy, the Tesco CEO, talked in the statement out this morning about that competitiveness in this market. So they've been aggressively trying to keep market share. Tesco is the largest grocer here in the country. But it's not just about price, too. They've made some strategic choices. So they rolled out about 350 own brand products in the quarter. And they also saw some of their higher end products, that Tesco Finest range, up about 18% in the quarter as well. So it's price, but it's also these sort of strategic moves as well that they've been taking that have helped them.
Yeah. And how is this particular retailer then? How does it set the tone for the rest of the sector?
One of the concerns earlier in this year was of a price war. And this is something, of course, that consumers love, investors hate, right? And we had all this news about Asda being back, about trying to kind of regain market share. Just last month, Asda was talking about discounting thousands of products. So there's concern that, you know, from the investor's perspective, this could launch that price war. We're not necessarily seeing that so much. And it seems like there's something of a floor on prices right now because of this other issue that we're seeing across the sector, which is increased costs that have come from the payroll taxes that we've seen under this new government, from minimum wage that we've also seen. So that's something that could actually kind of limit how far down prices could go in the sector. But it's still incredibly competitive, and we're seeing that in these numbers right now.
Is there a read-through here, or a takeaway, I should say, from how we should be interpreting the broader economy?
It's interesting, Kriti, because I think there's been a lot of messy data on the consumer, right? So on some hand, you know, last month you got consumer confidence ticking up just a little bit. And you could say, you know, perhaps that bodes well for a lot of these consumer companies. Maybe that's why we're seeing a little bit of uptick in Tesco. But then you get things like the GDP numbers looking bad this morning. And you could maybe take this as a read that, all right, well, sure, Tesco's doing great. They've beat, but it's Tesco, right? It's not Waitrose. It's not M&S. Maybe this is a sign that the consumer is trading down and benefiting some of these sorts of retailers that you start to see benefit in a downturn.
Yeah, we'll see if those figures out of the UK set the stage for a sort of tepid second quarter, or whether it was all about exports and that was really a sort of April story before the deal is enacted between the UK and the US. Thank you very much, Charlie. Charlie Wells with the latest on the UK retail space. Yeah, it is a really interesting dynamic that's happening in the UK, because you were asking earlier, one of our guests, you know, when do we see the effect of tariffs come through in US CPI? It was elusive yesterday. We didn't really see it, did we? And partly that's because tariffs were not implemented to the full extent that everybody had feared. Partly maybe businesses just taking it on the margin and protecting consumers for a period. But the longer it goes on, the less businesses can protect consumers from the effects of tariffs.
But perhaps already that weakness showing up in the market. If you just look at the broad dollar weakness we're seeing this morning, a complete turnaround in the pound since that data has shown up, because ordinarily you'd see a stronger euro, a stronger pound on the back of that dollar weakness. This morning, the pound is actually weaker, and that's been a story that's changed in the last, about say, 90 minutes or so since we got that data. Still at a 135 handle, but certainly a data set that's sticking out.
Coming up on the program, we're going to be speaking to JP Morgan Private Bank's Grace Peters and Stephen Parker on why they think U.S. equities are poised to make new highs over the next 12 months. We'll talk U.S., rest of the world. This is Bloomberg.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation.
I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
DoubleLine Group CEO and CIO Jeffrey Gundlach there talking about that American exceptionalism story. And we've talked about this from several different angles, from the trade perspective, from the deficit perspective as well. But I took a recent trip to New York about two months ago, and I had this crazy experience, which is what people are saying in Europe, the rest of the world may not be how it's being interpreted stateside. So we picked two people who are at the core of that conversation, Grace Peters and Stephen Parker, the co-heads of global investment strategy over at JP Morgan Private Bank, having these conversations about where we stand, visiting, of course, Steve is visiting from New York. Grace is a regular on the show. Steve, I'm going to come to you first because this is such a conversation right now, and it feels like there are two different views. You're here in London. Do you feel that difference between what you're hearing in the States and what you're hearing from international investors?
You know, I think when it comes to this question around American exceptionalism, I don't know that there is necessarily a feeling that some of the nearer-term trends around growth, technology, innovation are changing. I think the conversation that's evolving, particularly with our clients in the U.S., is more of a strategic question and evaluating portfolios which for a long time have been going in one direction, which is towards U.S. assets, towards the dollar, now stepping back and reevaluating whether perhaps diversification, adding non-U.S. exposure makes sense.
So Grace, hop on in here because this is your area of expertise. We just had Virginie Masseneuve over on from Allianz talking about kind of what that lazy complacency trade is, that when you're kind of in a cautious mode, she said you still go right back to tech. And we've seen that in this market, that the stock market has rebounded, the bond market kind of has rebounded. The dollar hasn't, though. What does an allocation to the U.S. look like in this environment?
Well, I think it does start with technology. And, you know, whilst there's been a lot of drama around tariffs so far this year, what has undoubtedly happened as well is reaffirmation of the AI story. When we go back to the start of this year, we were looking at broad adoption of AI across the US of around 5 to 6%. And latest figures imply that's more like 9 to 10% on an economy-wide basis. So AI is getting adopted. That is going to propel the US stock market. And so I think an allocation starts there. And just to build on what Steve said already, the notion of US exceptionalism has got two sides, push and pull. And I think when we think about broadening outside of the US, you also have to think, well, what is Europe as a key region to diversify into? What has it got to offer? And I think there is a fundamental change to the European psyche that's taken place through the course of this year. A thought that they have over-regulated companies, under-regulated their own defence. And therefore, I think that sets the stage for diversification to look first and foremost in international markets towards European equities, and gold would be the other one.
It was interesting. We had a conversation from a tech forum earlier on in the programme, and our colleague Tom was talking to a tech venture capitalist who was saying what's happening in Europe, to your point, is a really interesting new mindset that people are prepared to take risks again, is the way that he described it. Now, that's tech in Europe. That's not the whole of the European economy. So are we talking about, in your conversations with international investors, are they just drifting slightly away from US assets? Is that a sort of correct characterization? Is it nothing more than that?
I think the first step is rebalancing. There's been this unintentional and intentional drift towards US assets, perhaps away from some of the strategic asset allocations that were in place. So step one is rebalancing. Then I think step two is, as you say, thinking, well, what is my funding currency? Where do I have my spending needs? And again, in the context of, is that misaligned? And then I'd say, this notion of there being a domestic story in Europe is new.
Yes.
When in the past we've spoken about why invest in European equities, it's often been driven by, it's a global market. You get exposure to emerging markets, some US, and it's a nice globally diversified index. And it was more about avoiding the European domestics, including banks. Now I think that's changed, and we think that the European domestic story is far stronger, including banks, and also Europe is a more real asset heavy sector, which I think is also a positive.
And how is that conversation, Steve, how is that conversation going down in the United States? How much recognition is there from the people you talk to about the opportunities that Europe can represent at this point, with Germany spending on defence and infrastructure and the other changes that we might see in terms of regulation?
I would say for U.S. investors, we've had various points over the last decade where we've gotten more excited about Europe, and it's been broadly met with a high degree of skepticism. I think today the conversation is resonating. I think the changes that we've seen in Germany, the willingness to spend and increase the fiscal push, particularly one story that's resonating particularly well is this defense story. We see the headlines. We recognize that there is going to be a commitment to ramp up defense spending, infrastructure spending. So all of those things are resonating more with U.S. clients. But like Grace said, this isn't a wholesale shift out of the U.S. into Europe. It's more of a rebalancing story at this point.
Yeah, we often talk about U.S. exceptionalism as diminished, not destroyed. And so ultimately, portfolios are still tilted towards the U.S., but, within that context of making sure they're properly diversified and rebalanced.
But in that diminished, not destroyed narrative, the euro seems to be on a tear at the moment. And a lot of that is coming from the fiscal impulse that Anna was discussing there. But Steve, from your vantage point, there's a lot of questions here about this is the euro's moment to shine. Europe is traditionally associated with a cyclical tilt as well. I don't know if we're in a cyclical moment necessarily. Is there merit to the idea that the euro functions as a safe haven currency, or in Christine Lagarde's perhaps hopes one day, eventually a reserve currency?
Yeah, we don't see a change in the dollar's status as the reserve currency of the world. There's really not an alternative to the dollar. But what we are seeing is that similar rebalancing dynamic that you're seeing in equity portfolios is happening within currency portfolios as well, right? The world has gone very long dollars, and I think most investors acknowledge that the dollar, from a valuation perspective, has probably been extended for a while. It was some of these changes from a policy perspective, from a growth perspective, that are now causing both investors and central banks to reevaluate the diversification in their FX portfolios. And the euro and the yen are probably the two top destinations for that rebalancing, along with gold.
So, Grace, where does the UK fall in all of that? It feels they've done something very special here, I think, that they've navigated the relationship with the United States. This is respectively speaking, to how the EU and others are being thought about, and with China quite deftly and quite carefully. And that, I think, has boosted the pound as well. How long does that UK exceptionalism perhaps last?
Well, I think the economic backdrop in the UK is more challenged, actually, despite some of the drivers that you mentioned. We've obviously seen weaker GDP, weaker payrolls. Inflation is still an unknown, as it is around the world. And so our allocations are tilting much more to the Eurozone rather than the UK specifically. I would say an interesting dynamic to us is actually within UK domestic mid-caps, where you're starting to see more signs of M&A, in terms of currency, but also relative valuation is really, I think, the key driver there. So that's definitely something to watch. But broadly, these trends around infrastructure, defence, they are more tilted to the Eurozone rather than to the UK market.
Okay, and we've talked about, in our trip around the world, Grace, we talked a bit about Europe and the United States. That leaves a whole lot of the rest of the world, doesn't it? Yeah. And we've maybe touched on China a little. What about the emerging market story? Because we were talking about, from the debt side earlier on, how, with our guest at 7:15, about how some of the debt nervousness in global markets is being driven by developed markets, not EM right now. And I wonder where you see the opportunities in EM versus DM at this point.
So when it comes to the debt dynamics for the developed world, actually the interesting thing to us is that overall debt, like if you think US consumer, household and government debt, it hasn't significantly changed. It hasn't increased. It's just there's been a shift, which is why I think we feel developed world corporates and households are actually in a resilient place, and we prefer developed world investing over EM investing. I would say, look, there are pockets within emerging markets that look very interesting to us, and I would call out Indian equities as really top of that list. The best GDP growth in the world, we think, this year and actually structurally over the longer term. And most importantly, it's a region where that GDP growth actually translates into earnings growth, which is not what you see across all emerging markets.
So if we see balance sheets for corporates and individuals maybe not quite so stretched, that leaves governments and developed market governments. We have different questions and different concerns there. And that's being reflected in long-end yields. And we've talked quite a bit about steepening of curves as a result. Is that something that increasingly investors that you talk to are preparing for?
So it's something that is coming up in a lot of conversations. But it's interesting. I was actually reading an article the other day about concerns about budget deficits, what it would mean for growth and for inflation and the U.S. Treasury market. And then you looked, and it was an article from June of 1970. So this is a concern.
Did that feel good or bad? I'm not sure.
Well, I think markets have done okay over the last 55 years. I'm not trying to dismiss the risks associated with the budget challenges that we're facing right now, but we have to keep in mind we can't manage portfolios around black swan events, and we don't know when markets will decide that this is a problem. So what do you do? One, in the near term, we are more cautious on the longer end of the curve. We think that to the extent markets begin pricing in more risk, that's where it will happen. And then we lean in on diversification. At the end of the day, that's the best way to navigate some of these challenges. And importantly, diversification doesn't just mean bonds to complement your stock portfolio. It means alternatives, things like hedge funds, infrastructure, that will be more resilient in periods where debt concerns are higher.
That's why we've called our outlook comfortably uncomfortable, because there are obviously all of these things that make you feel very uncomfortable, but I think there's also a lot of things that we can do practically in the portfolio to account for the base case, but also the tail risk.
So there's an argument here. You both made the argument that bringing in alternatives may be a kind of spot to have a little bit more carry, a little bit more yield in your portfolio. We were just a super return in Berlin last week. These are still fairly illiquid assets. And a lot of the drivers that are creating the sell-off perhaps in the long end of the bond market arguably are the same drivers that would affect the private markets. Why would you have exposure to a long-duration asset, whether it's the bond market or the private markets, if you're worried about volatility and a comfortably or uncomfortably comfortable, whatever you just said. Comfortably uncomfortable, say that 5 times fast, element in this dynamic? Wouldn't you want a more short-term exposure?
So I think when it comes to fixed income, I would fully agree. When we're thinking about short to intermediate duration, that to us is the sweet point on the curve. But for infrastructure assets and some of those private market assets, actually the illiquidity works in your favor. And what you're trying to get is income with inflation protection, upside inflation protection as well. So I think core infrastructure is hugely complementary to the issues that you highlight.
So Steve, I think the U.S. has the edge in this in getting that exposure to the private markets via an ETF, for example, or a little bit more accessibility than perhaps European investors have. Are you seeing that interest from more people that are outside of just the traditional institutions?
We are. We're seeing a beginning of this trend towards the democratization of alternatives. You mentioned ETFs. We're looking a lot more at things like evergreen funds that offer a higher degree of liquidity, and in fact, that's becoming a much bigger part of the market. And part of the potential story and part of the structural tailwind that you may be seeing in these markets is with greater access to these alternatives, with more capital flowing in that direction, that's going to mean more demand, higher bids for assets, and so clients are looking to get in early using some of these new tools in the toolkit.
It's a fascinating conversation. Grace Peters and Stephen Parker, the co-heads of Global Investment Strategy, J.P. Morgan Private Bank, talking to us a little bit about everything. I think we took a tour around the world, Anna. We talked a little bit about private and public markets, but I think it feels like the conversation keeps coming back to the policy emanating out of the States.
Right, let's get back to the trade narrative and the trade headlines, because we've had some further news headlines coming through from China. You'll remember earlier on this week and just yesterday talking a lot about Chinese rare earths and how much they're prepared to export them to the United States. Well, China is saying, this is a Ministry of Commerce spokesperson speaking at a press conference, saying they will continue in China to issue more rare earth export licenses. And China says it's already issued some rare earth export licenses, so perhaps trying to give a sense of action post that conversation between Xi and Trump, the two presidents then giving the green light to the framework to sort of double down on the Geneva agenda, I suppose would be one way to describe it. The wider relationship in terms of trade between China and the US, still many questions about that, but at least around rare earths and some tech and aviation parts, we seem to have a little bit of clarity. Coming up on the programme, we'll pivot to the UK. Christy was just talking about the UK economy and the investment outlook there. Following the UK government's multi-year spending review, we'll get reaction from the Shadow Chancellor Mel Stride from the official opposition, the Conservative Party. That conversation is next. This is Bloomberg.
Because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back. This is the opening trade, 8:47 here in London. And European equity markets on the back foot. We are down by more than 1% on the Xetra DAX. We've had global trade headlines moving sentiment a little bit, and we see a little bit of worsening in the US futures picture as well. So we're down around 0.4% on E-minis and NASDAQ futures. The FTSE 100 is going its own way, and that has a lot to do with energy prices, what we've seen over the past 24 hours in terms of the oil price and how that translates into energy stocks. So with the energy sector, one of the few sectors that's moving higher in today's trading session, that helps the London markets to outperform a little bit. Let us stick with what's been going on in the UK. The UK Chancellor, Rachel Reeves, has announced a spending review, this over the last 24 hours, of course. It confirmed tens of billions of pounds of new funding to renew Britain's infrastructure and public services. Crucial to that, infrastructure such as trains, and road construction, but also investment in the NHS. Let's listen to what she had to say.
Defence spending will now rise to 2.6% of GDP by April 2027, including the contribution of our intelligence agencies. That uplift provides funding for my right honourable friend, the Defence Secretary, with £11 billion increased in defence spending, and a £600 million uplift for our security and intelligence agencies. This government is investing in the biggest rollout of nuclear power for half a century. A £30 billion commitment to our nuclear-powered future. Yesterday, my right honourable friend, the Energy Secretary, and I announced £14 billion for Sizewell C, producing the energy to power 6 million homes, supporting more than 10,000 jobs, including 1,500 apprentices. I am increasing the financial firepower of the British Business Bank, a 2/3 increase in its investments, increasing its overall financial capacity to £25.6 billion, to help pioneering businesses start up and to scale up, backing Britain's entrepreneurs, backing Britain's wealth creators. I am proud to announce the biggest cash injection into social and affordable housing in 50 years. A new affordable homes programme in which I am investing £39 billion over the next decade. Direct government funding to support house building, especially for social rent. And I am pleased to report that towns and cities, including Blackpool, Preston, Sheffield and Swindon, have already had plans to bring forward bids to build those homes in their communities. I am proud to announce today that this Labour government is making a record cash investment in our National Health Service, increasing real terms day-to-day spending by 3% per year for every single year of this spending review. An extra £29 billion per year for the day-to-day running of our health service.
That was the UK Chancellor, Rachel Reeves, of course, speaking in the House of Commons, delivering the spending review. And this is the first opportunity for the Labour government to really present their spending priorities. Of course, we knew from the budget at the end of last year, in 2024, about the amount of money they'd have to spend. So it wasn't really about the amounts, but this was about the priorities. This was about how much they would put into various parts of the economy. And despite the ever-changing constraints, I suppose, when it comes to bond markets globally, when it comes to pressures around defence spending, trying very hard to prioritise some kind of investment in the UK economy.
And at what cost? And you mentioned that defence spending is such a key piece of it. And this is a conversation that's not just happening in the UK, it's happening around the world. And then as you have these shifting priorities, and by the way, a cushion to deal with perhaps tariffs that are coming down the pike and the ripple effect there, where does that turn around? On top of that, a little bit of a currency impact as well is worth including. I'm sure Rachel Reeves has one eye on the pound as well, some weakness this morning. But it's interesting to see how much of that might be reactionary to how quickly they can implement some of these changes she's talking about.
Yeah, absolutely, because when you invest in productivity, sometimes the payback is long-term or medium-term rather than short-term. And the GDP challenges are clearly quite here and present and current. But having said that, some of that coming through from President Trump's tariff policies, and that seems to be what's in the ONS conclusion questions this morning. Let's get reaction from the official opposition. The Conservative Shadow Chancellor Mel Stride joins us now from Westminster. Thank you so much for joining us, Mel Stride. Thank you for being with us on the programme. So despite the near-term challenges that no doubt the Chancellor faces, do you welcome the fact that this is a government trying to take seriously increasing productivity in the UK economy, trying to invest in technology, investing in healthcare, investing in infrastructure around the UK? Is that something that you would welcome?
Well, naturally, we need to improve productivity and growth in our country. The reality is, under this government, it isn't happening. And I think the question you have to ask about all this investing here, investing there, investing elsewhere, is where is that money coming from and can we afford it? And the reality is that the money is coming from a lot of taxation, a lot of that falling on businesses, about £25 billion worth through national insurance increases for businesses, which is destroying growth. It's also coming by way of very large amounts of borrowing, which has been inflationary. Inflation is now almost twice what it was on the day of the last general election. That's keeping interest rates higher for longer. And in this sort of national debt that's being accumulated, we're now paying on that national debt about $100 billion a year, which is twice what we spend on defence. Okay. So I think we're in a position that's very fragile. And the economy is going to be struggling to really digest this level of additional borrowing and spend.
Well, it seems that the market is increasingly pricing back in some of those rate cut expectations from the Bank of England, and partly because we've had weak GDP data out this morning, and I'm sure you'll lay the blame for that at the Chancellor's door. But I wonder if you accept that actually this was to do with US policy, US tariff policy, one of the drivers of the weakness in the GDP print today. And to the government's credit, they've done a trade framework, at least, arranged a trade framework with the United States.
Well, you've used the word framework. They don't have a clear deal. And in fact, what manufacturers here in the UK are not clear about at all is exactly what tariffs, for example, on steel, we're actually going to be facing. But the reality is that the economy is in a weak place, and that is due to the choices that this government has taken. If you look at the fiscal headroom that the Chancellor built into her numbers back in the autumn budget, that was completely blown and more. She rebuilt that in the spring. Most economists think that will have evaporated again come the autumn. And that is not the basis on which one would go out and have this huge spending splurge that the government's now embarked upon. And yes, of course, things like tariffs internationally will have an effect. We may have to spend more on defence going forward. The various discussions with NATO going on at the moment. We may have the bond markets requiring more interest from us in order to continue to borrow. There are some unfunding commitments that the government came out with yesterday, which you'll have to factor in as well. All of those things, you know, economies have externalities. But the question is, are they building a strong enough economy to withstand those and sustain growth? Yes. And I think the evidence is that that's not the case, I'm afraid.
If you were in a position of having to decide what to spend the UK's money on, then, Mel Stride, how much would you be spending on defence? The conversation currently around 2.6% to 2027.
Yeah, okay, so the government said 2.5%. There's an extra 0.1 they've levered in because that's what we spend on our security services. We have said we should be going to 3% within this Parliament. The government has said they have some aspiration to go to 3% in the next Parliament. The reality is they're going to have to look seriously at putting defence spending up, and that's just going to be another thing that's going to weigh on our economy and comes back to the points that I was making earlier about whether we have a strong, growing economy to carry that additional cost, and I'm afraid at the moment that is looking very doubtful.
Mel, thank you very much. Thanks for joining us. Mel Stride, Conservative Shadow Chancellor. Thanks for spending time with us here on the opening trade. And the first 56 minutes of that opening trade then, Chrissy, have been pretty negative for European equity markets. The DAX continues to worsen. In fact, we're now down by 1.3% on the Xetra DAX. Some of the autos names under pressure, it would seem.
And then the tech names as well, certainly not getting the boost that perhaps we were expecting from Oracle as well. Several pieces of pullback across these markets. Also seeing weakness in the currency market as well. The dollar continues to weaken. It should have boosted the euro. It is. You're seeing some green on the screen there, 115 on that market. But the pound, a 135 handle and weakening as we speak. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Oil jumps as the U.S. orders some of its embassy staff in Iraq to leave after Iran threatens to strike American bases in the Middle East. The clock is ticking. Donald Trump threatens to set unilateral tariffs again within 2 weeks ahead of the end of the 90-day pause next month. Plus, downtown L.A. under curfew for a second night as the U.S. president escalates his immigration crackdown. Now, let's get straight to the markets. All of this is playing on the markets, not only the tariffs, but the increased threat that we're getting from the Middle East. Now, equities and also dollar sliding, dialing up these trade tensions and geopolitical unease, setting a broader tone, actually, of risk-off across the markets. But it's not huge falls. They're just, I think, on tenterhooks to see what happens next. If you look at S&P futures, they're down some 0.4%. Euro, dollar, 115.26. Let's also get onto the European markets map, because I think one of the best conversation is what exactly is being priced in. I know a lot of the serious people are not taking some of the threats seriously. That's the narrative that's going through the markets. Is it because on tariffs, Donald Trump has walked away twice before? Is this just to put pressure in terms of timeline? That's probably the conversation that we'll have. We're seeing a bit of pressure on the CAC 40, the DAX down some 1.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we'll talk tariffs and markets in a moment with Christian Olting from Deutsche Bank Private Bank, but we, of course, begin with geopolitics. Now, the U.S. has ordered some embassy staff to depart Baghdad and authorized military service member families to leave the Middle East. That's after Iran threatened to strike American bases if it's attacked over its nuclear program. Now, let's bring in Ross Matheson, our EMEA news director. Now, first of all, Ross, I mean, this kind of came out of nowhere, right? It came from a New York Post. Comments from Donald Trump saying, I don't believe we're making progress with Iran. It seems to have escalated very quickly.
Well, that's right. But what this really is about is where are these nuclear talks between the US and Iran going? For months now, there have been conversations around, is Israel preparing to strike Iran directly and unilaterally? Does it have the capacity to do so, and would it target Iran's nuclear facilities, which would be a major escalation in the region. So we know that those plans have been in the wings for a while and possibly being prepared, but it's colliding with these tensions over the nuclear talks. And we know that from Donald Trump, his perspective is these talks are really bogged down and not going anywhere. We do know for now, Oman said this morning that the next round of talks is at this stage going ahead this weekend, and US officials will be in the region for that. So that possibly creates some breathing space in all of this, because if those talks are going ahead, you can't imagine some kind of strike on Iran is imminent. If those talks get cancelled, that might be a further signal for the market. But the question is there any path forward on those talks? Can we get maybe a trade, dare I say, kind of deal where it's a broad framework on the nuclear front and they push all the hard stuff off? And that at least creates, again, some breathing space. But a lot's going to depend on those talks this weekend.
Yeah, and Roz, just to be clear, I mean, from a historical, point of view, like getting, staff out of embassies is a huge deal.
Well, that's right. I mean, for now, it's contained to Iraq, and they are allowing service personnel's family members in the region to leave if they want. And that's obviously from a heightened sense of concern that action may at some point eventuate. And we're seeing that coincide with warnings again about watching shipping in the area from the naval perspective from several countries. So obviously tensions are pretty high. But we've been here before with Israel and the possibility of a direct strike on Iran's nuclear facilities. Donald Trump has said, many a time he's concerned about such a move and what the ramifications of it might be for striking the nuclear facilities. Also, Israel can't really do it on its own. There's a lot of questions here still. And again, the focus really needs to be on what happens at these talks if they go ahead this weekend, and is there a pathway forward on that?
Domestically, of course, in the U.S., there's still quite a lot going on with the Marines in L.A. Where are we on the protests?
Well, it was pretty peaceful so far overnight in L.A. And again, the curfew is there, but we are seeing some of those protests spread to other cities, New York, Chicago. Also, authorities are saying that they're going to continue these immigration raids for another month. So they're not going to fade off in LA. They're also saying they want federal prosecutors to come in and take over criminal cases from the state. So again, these questions around federal power versus state power, and other states are watching that very closely, and you're seeing expressions of concern there, but you're also seeing these protests kind of start to pick up in other cities. And the question is, what does the White House make of those protests, and do they take action there similar to what they've done in LA? So it's thankfully been pretty quiet overnight, but this is something that's still very much bubbling away.
Rose, thank you so much. As always, Rose Matheson there, our head of our EMEA News Direction. Now, President Donald Trump says he intends to send letters to trading partners in the next 1 to 2 weeks, setting unilateral tariff rates ahead of a July 9th deadline to reimpose higher duties on dozens of economies. Well, Trump spoke to reporters in Washington.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
Well, we're now joined by Christian Olting. He's Global Chief Investment Officer at Deutsche Bank Private Bank. Christian, thank you for joining us. There's a lot. There's just a lot to understand, to get through. And certainly on the tariffs, it's unclear whether this is a lever for the timeline, whether he'll go ahead with it, whether it's like a fiscal patch. So how do you see these latest threats?
Yeah, honestly, I'm not so surprised as we are getting closer to the timeline of July 9th that Trump puts some pressure. So if you think of all the negotiations, I think honestly that's to be expected. And I agree, right? Is some deal probably with the UK, there's some deal with China in the negotiations, fine. But the EU deal seems to be very complicated, and there are so many other countries. So that's why I think he puts pressure, because at one point in time he wants to get this done to say I can move ahead with other topics in policy.
But I mean, look, there's a taco trade, Christian, right? Trump always chickens out, or there's a belief that actually he's putting pressure, but then he again doesn't really go quite far. Is it too risky to underestimate that these tariffs will be very punitive going ahead?
Yeah, I think we should never underestimate the tariffs. They will be certainly much, much higher, whatever is the outcome. I think there's a floor of 10%. Then at the beginning of the year, there is a change in the overall setup in tariffs. And eventually we think they are inflationary. So although inflation numbers were okay-ish yesterday, but if I look at Q3, there will be an impact on inflation. And I think the tariff discussion will not end July 9th. Probably EU leads longer. And Trump has also talked about secondary tariffs. I've not heard this for a long time, but that might come back. So I think we will now live for years with that tariff discussion.
What does that mean, again, for when we actually see, that filtering through inflation? I mean, as you say, for the moment, there's bad surveys. It's not really translating into the economy. Certainly inflation isn't. So is it a 3-6 month lag, or is there a worry that actually the Fed messes this up?
No, I think there is always a lag in this. And I think some companies, because there's so much uncertainty at this point in time, they try to digest this via the margins.
Right.
But at one point in time when it's clear it stays, then you need to take a decision, right? Mm-hmm. Sometimes it's good to have clarity, to take forward with CapEx. But I think you cannot always say, okay, I take everything in myself. Right. And that's why I think Q3 inflation probably rise to above 3%, by the way, in the US, which is quite a large number.
So what's the ideal way of building a portfolio in these uncertain times?
So, well, I think what's important is you need to dissect 3 layers. Sorry to say that long. So first of all,
like an onion. I like it.
It's like an onion, indeed. So first you have the political layer, which is a long time period where tariffs might stay forever. Then you have the macroeconomic input. What does it mean? So we say, okay, there's some implications for inflation. That means yields will probably stay at a higher level for quite some time. And then if you look at single markets, sometimes I say markets have a memory of a day, right? So whenever there are companies, different sectors which are doing well, the market will go there. Look at tech, for example, in recent weeks, it all came back in a positive way, right? So, and I think that's the onion, as you say, you need to peel, and that's how you build the portfolios.
So, but do you stay invested no matter what, or actually do you get some dips to actually also go back in?
So, looking back at this year, we said tariffs will probably come in higher than expected, which happened. We made sure it's robust portfolios, but we were underweight on the equity side. But it's never that we say don't stay invested. You need to, I think it's another good example to stay invested with your asset allocation. But you need to look at regions and sectors. And if you look at the markets right now, equity markets, they are very rational. So look, autos are having a lot of stress. Banks are doing very well. So the market is really differentiating. And I think that's something you need to take into account.
I mean, what do you hedge with? Gold?
We like gold a lot, actually.
Everybody likes gold.
Yeah, and I know the ECB has always voiced some concern if there's massive movement, there could be something. But I think if you look in terms of currencies, gold is seen then as a currency. Yeah, so we joined that call. But honestly, we were not the last one to get there. For quite some time we are there. So,
Christian, is there something that the market is misunderstanding, or as everyone's looking here, should we be looking elsewhere? I know some of, for example, the trade on Treasury seem very crowded. Is there something that you want to look at differently?
I think in general the market is not euphoric, which I think is positive.
Yeah.
So I would be concerned if the market would be saying, oh, forget about the tariffs, no, everything has come back. Equity markets, sometimes we see maybe they underestimate that there is tariffs coming. Mm-hmm. Fixed income market, I think, is different, right? So yields are higher than before. CDS spreads on the US are higher than before the so-called Liberation Day. So also you need to differentiate. I think equities look from a single sector company perspective. And maybe there's some underestimation of the tariffs there, yes.
Is the bond steepening trade to consensus now?
Probably yes. However, I would say a lot is priced off the steepening of the curve, but the term premium you see is not very high if you compare to history. I think we need to differentiate. The longer end is certainly bound to inflation and growth, where we say growth is coming down, but inflation staying higher, so more sideways. But I do expect central banks to cut. Although we have a quite tough inflationary environment, at least in the US, I would still say they look at growth, and that's why there are some cuts, and that's why there could be some steepening of the curve.
Christian, is there some kind of trade that you were expecting to work this year that hasn't panned out yet because of the noise?
I would say if you look at the equity side, we had a lot of discussion on technology. That has come really back very positively. And I would say, even people don't say, I would think that could continue. Or if there's some correction in the whole market for political reasons, trade reasons, that's where I really say use that buying opportunity. Because I think the market has probably not looked so much where is productivity gains possible. And that's the whole Europe story, is fiscal. But eventually you look at the markets where there are some productivity gains. And I think that's where you really need to look. And the market has not started to differentiate there.
Chris, what about the UK? Do you look at the UK, it's a small open economy, it's of course not part of the single market, so are there more opportunities in the UK than in Central Europe?
I think what we see right now is maybe that EU and UK are working closer together is probably not so bad, I would say, because it needs a strong Europe, including the UK. I think from tariff, UK are probably better off than the EU, so that's a positive thing. But then you see some people obviously leaving the country. There's a lot of discussion with the clients as well. So I think collaboration makes a lot of sense, and that could deepen, and I think that would be positive for the UK.
Christian, thank you so much. As always, Christian Nolting, their Global Chief Investment Officer at Deutsche Bank Private Bank. Coming up, we're in conversation with the former Italian Prime Minister, Mario Monti. We'll talk trade negotiations, the shifting global geopolitical landscape, and much, much more. That's next, and this is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres June 13th, only on Bloomberg Television.
Now, the Czech president has told Bloomberg he believes his country will adopt the euro, but it will take some time. Peter Pavel has been speaking exclusively to our Kriti Gupta.
This debate has become truly emotional and irrational. My simple argument to our population is that we are dependent on Eurozone, if you like it or not. Most of our trade is with the Eurozone, and in that sense, it doesn't make too much sense when the Eurozone discusses future steps and rules, and we are behind the door. The sentiments are mostly negative because people were told by a number of politicians that by adopting euro, they will become poorer, and everything will be more expensive, and we will have no freedom and autonomy to adjust the courses. But in reality, the room for adjusting courses with our own currency is so narrow that it really doesn't make too much benefit. So sooner or later, I believe that rational reasons will bring us to the adoption of euro, but it will take some time.
Well, that is the Czech President Petr Pavel speaking to Kriti. Now, the U.S. Commerce Secretary Howard Lutnick says the European Union is likely to be among the last deals to be completed. Now, the two sides have been grappling over trade terms before the July 9th cutoff, with the commerce chief saying Europe was more than thorny. Well, I'm very pleased to be joined by Mario Monti. He's a former Italian Prime Minister and President of Bocconi University. He's also doing a seminar today on how Europe can become more competitive. Mr. Monti, thank you for joining us, as always. I mean, we had a plan that, you know, another prime minister put it together to be more competitive. Is Europe now, you know, sitting up and taking notice? What can it do in the immediate term to become better?
Yes, this is quite an extraordinary moment for the European Union, both in terms of difficulties given the attitude of the U.S. administration, but it's also a moment when we realize that unless things are done faster, more together, and in a convincing way, Europe has no way. Now, that's why it's also interesting to go back to previous episodes when European Union made a jump ahead. And for example, the single market, of which we discuss so much these days still, was basically launched in the European Council of Milan in 1985, when you know, for the first time, a European Council under the leadership of Prime Minister Craxi of Italy decided to vote. And Margaret Thatcher was against that. Prime Minister Craxi called the vote. She was outvoted. And so the Intergovernmental Conference started to put together the single market where majority voting is the key. So we are at a moment when if we genuinely exploit realistic political possibilities, we can do much more than we believe we can do.
Yeah. But, Mr. Monti, is this internally? So is this, you know, structural things? Is it defense spending? Is it just doing some of, you know, the things that was laid out in the Draghi report? Or is it actually looking towards China and further east?
Yes, absolutely. And this is not, well, Europe has of course been irresponsible over the past years to believe that it could rely forever at low cost on U.S. defense. That was a big mistake, as we see today. But today, I think the public opinion in Europe is ready to realize that putting ourselves in a better position of security is also defending our lives, our values, our social values. And so if the governments are good enough in explaining this, I think the resistance will go down, and it will be possible to do more on defense, also because, frankly, even if, assume that the US president did not ask for Europe to pay more for its defense, but honestly, could we rely forever on the defense basically steered by the US, which is a great country, which saved Europe several times, but which has now a rather erratic and extravagant foreign policy that is not prudent on our part.
But, Mr. Monti, how difficult is it also to do this during, you know, these trade tensions where, frankly, you don't know whether you're coming and going, there's another deadline, it's unclear whether the U.S. really puts it through. So how much does that complicate things, and what's the right way for Italy and Europe to deal with this?
I think we should calmly consider that the U.S. is temporarily withdrawing from the position of leadership it always held in the international community of liberal democracies and of modern democratic capitalism. There are many countries within and outside the European Union who, on the other hand, want to stick to these values, which are ours and used to be also of the US. So I think we should, for example, well, take the G7 countries. There are countries there like the 4 Europeans in a geographical sense, UK, Germany, France, and Italy, but also Canada and Japan. They may wish to, following some suggestions coming from the Canadian government, to set up an alliance of liberal democracies, which might appeal not necessarily to all the EU member states. For example, Hungary would not be interested, but to many non-European countries like Canada, Australia, New Zealand, and hopefully one day the US might be willing to reconsider, to come back into this, and at that point, a new MAGA will be at the order of the day, make America great again, but in a much more real and deep sense.
Well, Mr. Monti, how much does this depend actually on defense spending? Right, and given the negotiations and the talk at NATO, Rome and Italy seems to not have lagging defense spending. Can they really step it up to at least placate some of the tensions at the moment?
Well, the EU as such has indeed appeased some of the tension by relaxing some of the Brussels-made constraints on fiscal policies. But also it's deeply misleading what some governments are doing, namely to present to the electorate the alternative. If we have to do more defense spending, then it is welfare, it is pension, it is the social state that has to give in. This is not necessarily the case. For example, I know several countries, Italy is one of them, where there is still a huge space to go to reduce the tax evasion. That is something that could well go more productively into defense and security spending. Not necessarily, therefore, there is a trade-off between defense and social.
Yeah, Mr. Monti, if there's one thing that you would, prioritize as former commissioner, as former Italian prime minister right now for Europe, just one, what would that be?
To have the Commission and the President of the European Council to rein in some excessive nationalism that is there, that is really well, take the Draghi report, an excellent report outlining what Europe should do to become more competitive and productive. Okay, all governments paid lip service to this. No government is ready to take it seriously. And they continue to say, Europe, wake up, meaning Brussels, the Commission. But in fact, most of the obstacles that still exist to a unified single market are in the hands of the member states. Look at what is happening concerning the dynamic in the banking system with Unicredit and Commerzbank, but also in Italy. Well, all those defensive actions that are taken to preserve essentially political power by some governments are completely against the single market, the Draghi report proposals, etc. So we need to reduce the degree of hypocrisy if we want to make Europe more effective.
Mr. Monti, thank you so much. Always straight to the point with the former Italian Prime Minister and President of Bocconi. Coming up, oil spiking on heightened tensions in the Middle East. We'll talk with Michele Della Vigna from Goldman's. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil jumps as the U.S. orders some of its embassy staff in Iraq to leave after Iran threatens to strike American bases in the Middle East. Now, the clock is ticking. Donald Trump threatens to set unilateral tariffs again within 2 weeks, ahead of the end of the 90-day pause next month. Plus, downtown L.A. under curfew for a second night as the U.S. president escalates his immigration crackdown. Now, oil has edged lower after jumping more than 4% yesterday after the U.S. ordered some of its embassy staff in Iraq to leave. It follows a threat by Iran to strike American bases in the region if nuclear talks collapse. Well, Kennedy, Bloomberg senior executive editor for energy and commodities, joins us now. So, first of all, well, I mean, let's, I guess take a deep breath and understand exactly what's going on. What's the factor pushing up these prices? Iran said, look, if you touch my nuclear program, we'll retaliate, but we don't really know where we are.
No, but clearly there's been a lot of speculation about which way these negotiations between Iran and the United States might go, and it's absolutely vital to the oil market because if they collapse, it's clear that outside the threat of any military action, there will be more sanctions on Iranian oil from the US, so it will take barrels out of the market. So clearly the market is very sensible, to the threat of military action in the US and in Iran, and what that might do to exports out of the Gulf, but also just that there could be more US pressure on Iranian exports, and that could take barrels out of the market, which is why we've seen the significant rally that we saw yesterday.
Well, we're just getting some breaking news, some headlines crossing the Bloomberg terminal from NOR, which is Iran's semi-official, government agency, and they're basically saying, first of all, that they're launching a new uranium enrichment center. That doesn't seem like great news. And then they're also calling for censure by UN nuclear watchdog as political. So, again, is this talking to a domestic audience, or does it feel like it's really escalating?
I think probably both of those things. Clearly, they want to look like they're strong in this situation to people inside Iran. But again, it speaks to the fact that clearly we don't seem right now, judging by the rhetoric coming in from both sides, to be on the cusp of a deal, even though talks are scheduled to continue, I think, this weekend. And that's making the oil market nervous.
What does this tell us actually about also the heightened state of the markets?
Yeah, it's really interesting where oil is right now. I think the salient fact, the thing that I would point people to is that yesterday we saw Brent hit more than $70. Now that's a price that we haven't seen since before OPEC started making these oversized production increases back in April. And it's really interesting that OPEC's been able to put all this oil back into the market, yet prices have actually rallied in recent weeks. And we know that the Saudis would like to put even more oil in. So I really think that speaks to, A, the underlying strength perhaps of oil demand, but also the fact that the market is very worried about what may happen in Iran.
Well, thank you so much. Will Kennedy there with the very latest, of course, on oil and those breaking news from Iran. Now we're joined by Michele Della Vigna, head of EMEA Natural Resource Research at Goldman Sachs. Michele, thank you for joining us. What do you see as the most imminent threat, actually, to the price of oil and energy sources?
Pleasure, Francine. I think it's a difficult oil market that we're in, because on one side we are going into peak seasonal demand with strong geopolitical risk and inventories at a low level. This is why I think we continue to see the oil prices spike on this news. But if we take the luxury of looking out 3-4 months, as we look to October, November, we are going to have the inventory impact of all of the OPEC increases, which we haven't seen yet in inventories. We are going to get a low in seasonal demand. We will continue to see non-OPEC growth, because one of the things we observe is that so many big projects are ramping up. All of the projects that had investment decision pre-COVID were delayed are now coming on stream. It's like the last hurrah for a lot of countries from a production perspective. And we think that built up a very, very bearish outlook for oil as we look into autumn.
Yeah, Michele, what's very bearish? Is there a kind of level to which a lot of the Gulf nations will have to do something about it?
I think absolutely. I think if we cross down below $60 per barrel and we approach 50, we think that is the level where OPEC will most likely pause the production increases. And this brings us back to one of the problems we're seeing at the moment, which is circularity. So as long as oil remains in the high 60s, it's giving a clear incentive to OPEC to continue to go for production increases and market share. So most likely they will do another 400,000 barrels per day increase in August. And we will only see that in the October inventories. And by the time that happens, it will be seasonal low in demand. The inventories will build very quickly, and I think the price reaction will be quite abrupt.
Michele, talk to me a little bit about what it means for LNG, for example. I mean, can LNG, pick up some of that, do prices, some of them are linked, for example, in Qatar with the price of oil. Does LNG also suffer on the back of it?
Without any doubt, and LNG has an added dynamic to it, which is an avalanche of production coming, really starting from this year, but continuing for 5 years in a row with projects that have been committed and are already under construction. I mean, another read across from LNG is that, especially in 3 countries, the US, Qatar, and Saudi, the increase in gas production is coming with a lot of liquids associated NGLs, which effectively for all purposes are oil equivalent. This by itself will grow liquids production by close to 500,000 barrels per day each year for the next 5 years. And that is independent of oil prices. That's, I think, another bearish driver for oil. And another thing that links the bearish view on LNG with the bearish view on oil on a 6 to 12 month basis.
Michele, talk to me a little bit about, ESG funds. I know you've argued in the past that actually energy companies that lead the energy transition should be a cornerstone of ESG funds and not seen as a hindrance or certainly not a divestment target. Has the space in that changed?
No, I think too little has changed there. We are strong believers that we need more energy on all fronts, that oil demand will grow to the mid-2030s, gas demand will grow all the way to 2050. But in the meantime, renewable production is also growing fast, and we need companies who can manage risk for intermittency and seasonality. So I think the traditional integrated oil and gas companies that are really becoming energy companies, I think should be a cornerstone of any investor's portfolio. Now, it may be difficult to own them if they share our view that oil may go down towards $50 per barrel in the next 3 months, but that actually could be an amazing buying opportunity for these companies that are growing their business both in traditional energy and in some cases very successful in low carbon and renewable energy as well.
Michele, how do you see also the situation in China? We talk a lot about, these tensions, these tariffs, and the fact that it's really pitting the U.S. against China. I mean, China had done quite a lot on energy transition. Does it double down given what's happening in terms of U.S. policies, or does it go the same way?
I think they're doubling down. And this is not because of energy transition. This is because of energy security. They're doubling down on everything they can produce domestically, and that is batteries and solar for renewables and electrification, and that is coal for power generation. It doesn't really lead to a material decarbonization, unfortunately, but it certainly leads to a much safer energy production for them. And that's why I think they keep doubling down. And if the US no longer imports some of their clean tech equipment, I think they will keep exporting it to the rest of the world, including Europe.
Michele, talk to me a little bit about Europe and actually energy security. I know there's a lot of talk, and I was speaking with Mario Monti about the fact that maybe there's not that much money in terms of defense spending, or certainly not as much as the U.S. wants. But where are they on energy security? How is Europe doing?
So let me give you one good news and one question mark. So I think the good news is this avalanche of LNG that is coming on the market, I think is going to be brilliant for Europe. It is going to lead to gas prices, which in 2 years' time, we think will be 50–60% below where they are today. What good news. That's the energy crisis resolved. That's European heavy industry becoming competitive again. That is brilliant. The question mark is on tariffs, because at the moment Europe has barely any tariffs on imports, for instance, on clean tech from China, and therefore on batteries, on solar panels, and increasingly on biofuels and wind. It's entirely dependent on imports. I think there is a serious question mark here as to whether that is the right industrial policy, or whether Europe should think about tariffs again. We've done a Carbonomics report focused on that, where we look at what tariffs would make local production of this clean tech competitive with China, and clearly that would require a big change in industrial policy.
So interesting, Michele. Thank you so much, as always. Just great insights. Michele Della Vigna, they're head of EMEA Natural Resources Research at Goldman Sachs. Now, parts of downtown LA are currently under a second night of curfew as the Trump administration escalates its crackdown on U.S. protests over immigration raids. Charlie Wells is here with a deeper dive. Hi, Charlie. So what, first of all, is the likelihood that these protests continue, but also really spread?
Yeah, Francine, so the conditions really are there for an escalation. And I think there's sort of two factors to keep in mind here. I think one is just this ramping up of these ICE raids across the country. So officials have been talking about how these could continue daily for the next month. So you have that kind of enforcement change. But on the other hand, you have this huge demographic issue. And I think looking from outside the U.S. in, there are 11 million undocumented people in the United States. So you have this huge population, and you have these ICE raids targeting workplaces where a lot of these people go to look for jobs. That's got an emotional element, it's got a demographic element, and it's got this kind of policy change element. So I think this really could continue if people aren't careful.
Yeah, so how is the Trump administration responding? Is it escalating?
They're really doubling down. And I think they really are doubling down in this idea of federal power. So you see this deployment of active duty military troops on patrol in Los Angeles. And, a spokesperson for the Pentagon yesterday was saying that there are now more active duty military personnel in Los Angeles than there are on duty in Syria or Iraq. You also see the Trump administration really kind of in the realm of law enforcement, bringing up this idea of a more expansive federal power. So the Attorney General Pam Bondi yesterday was talking about invoking the Hobbs Act. So this allows federal prosecutors to take over criminal cases that would normally be handled at that local level.
Charlie, hearing over the deployment of troops in L.A. is scheduled at a federal court today. What are the dynamics of that case? We also see really Gavin Newsom double down and fight back.
Right. So this is a lawsuit that Gavin Newsom and the state of California filed on Monday, and it really is about this issue of sort of states' rights versus the federal government. And it's striking because you usually would hear conservatives talk about states' rights, but here you're hearing a Democrat talk about states' rights and about how California alleges Trump has kind of overstepped executive power in deploying these troops on a domestic level. Now, the Department of Justice filed yesterday saying that Trump is within his right to call up the Marines, to call up the National Guard. But this is a question really that this judge later today is going to have to weigh very heavily.
Yeah, and this is a big deal. Charlie, as always, thank you so much. Charlie Wells there with the very latest on LA. Now, some other stories making news today, and there are fresh signs that the UK could be on course for the biggest exodus of wealth in the country's recent history. Now, a Bloomberg analysis of 5 million company filings shows a spike in business leaders leaving. More than 4,400 disclosed an overseas move in the last year, up around 20% on previous years. Apollo Global Management will not recruit investment banking candidates from the class of 2027 this year. Now, this decision comes after a backlash from banks like JPMorgan Chase, which are concerned about junior recruits accepting future job offers too early. Apollo now says this early recruitment process is not beneficial for students or the industry. And the chief executive officer of DoubleLine Capital, Jeffrey Gundlach, believes America's debt burden and interest expenses have just become untenable and may lead investors to move out of dollar-based assets. Well, he spoke to us exclusively at the Bloomberg Global Credit Forum in Los Angeles.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
DoubleLine Capital Chief Executive Jeffrey Gundlach speaking to Bloomberg. Now, coming up, tech founders, investors, chief executives, and government officials gather at Founders Forum here in the UK. We'll take you there shortly for an exclusive interview with the chief executive of the AI avatar platform, Synthesia. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We can't let Shanghai and San Francisco have all the fun. I think Londoners are going to really embrace autonomous vehicles and a robotaxi offering. There's such a rich diversity of different mobility offerings in London, and I think bringing the benefits of autonomy here is so exciting. We've been working on Wave for about 8 years now, and the opportunity to now bring autonomous robotaxis to a market like London, which I think is one of Uber's 5 biggest markets, it's a dream for us. So I'm really excited for this opportunity.
Well, that was the chief executive and co-founder of the autonomous driving startup Wave, speaking to Tom McKenzie earlier about his partnership with Uber to trial driverless cars in London, finally. Now, the Wave chief executive is among the founders and tech investors attending the annual Founders Forum in England's Oxfordshire. Now, this year, Bloomberg and Founders Forum have also combined forces to highlight the European companies and their leaders aiming to have an impact on a global scale. Let's bring in Tom McKenzie, who's with the chief executive, one of our 25 startups to watch. Tom, over to you.
Fran, thank you very much indeed. Yes, pleased to say I'm joined now by the CEO and co-founder of Synthesia, Victor Ripabelli. It's a London-based but global business focused on reshaping the video platform using artificial intelligence with avatars, with a big focus on the enterprise space, and they've seen a lot of growth there. It's another red-hot European startup. Victor, thank you for joining us. We had Jensen Huang, of course, in London and then in Paris talking about the infrastructure needs. You have recently trained your video model on NVIDIA's latest GPUs, the Blackwell, the most sophisticated AI accelerators. You're the first company to have done this. What did you learn? What is it enabling you and Synthesia to do for your customers?
It's very simple, right? It's just much, much more effective. So we're seeing up to like 40 to 70% cost savings on training and inference. And that's massive, right? Those are, of course, things that go back into lowering the prices to serve our models for our customers, and also delivering even more capable models at lower prices, right? And right now in AI land, margins is the talk of the town. The products are great, they work, but they're much more expensive to serve than the kind of SaaS era, right? So any kind of improvement we see in efficiency on kind of like at the chip layer has a massive impact on the industry.
Okay, margins are the talk of the town. Efficiency is in focus. Jensen Huang talking about the needs of infrastructure in Europe, continental Europe, and in the UK. Is infrastructure a bottleneck for a fast-growing company like yours?
I wouldn't say it's a bottleneck for someone like us. We don't need in the millions of GPUs. I think it's very important for Europe strategically that we have data centers, that we can train big models regionally. But I wouldn't say from a practical perspective that it's something that I think a lot about in kind of my everyday.
And you have that partnership, of course, with NVIDIA, one of your backers.
Exactly.
As you continue to innovate your models and your offerings for your enterprise clients, what are you able to give them? How are they adopting this and integrating into their businesses? Because we still need to ask about the return on investment for enterprises. Are you starting to see clear evidence from your clients that is starting to happen for them as they adopt your services?
Oh, massively. So we've been in market now for 5 years with our AI video platform built for the enterprise, helping our customers communicate more effectively in video. And we're seeing cost savings and productivity engagement gains all over the place. Wise, for example, another great UK startup, seen a 20% reduction in production costs for all of their content, right? That's a pretty big line item where you're at a scale like Wise is. And that's something we see repeated across many other companies in the enterprise. UBS, one of the world's large investment banks, they just implemented AI videos as part of the research that they do. So instead of you receiving text-driven research as a customer, you now receive video, which has also been received incredibly well by their customers. So I think we are just seeing this big shift, right, from reading things to watching and listening, and we're powering that shift for so many of our customers.
Are you seeing use cases that you hadn't imagined as your clients adopt this technology?
Absolutely. So when we built the platform, it's very important to me and the team that we build a platform that's open, accessible. You can go in, you can kind of do whatever you want, right? We didn't want to be too prescriptive on what you should do. I think that's really paid off. We have millions of users that every day experiment. Some of the things they do work, some of the things don't work. But there's a lot of, I think, one of the most amazing things about this generative AI era with Synthesia, ChatGPT, all these tools are so easy to use, they're so accessible, and that just breeds this very, very quick iterations on new use cases. And that's very different from the AI era of 2018, 19, where if you wanted to do an AI project, that would be 12 months later, maybe you'd have a result after you've collected the data, trained the models on what's working. And I think that's also why the space is moving so fast, because the speed of iteration, not just on a company level and how quickly I can build new products, but also how quickly my customers can take those products and figure out where they work. It's just a phenomenal combination.
And you guys at Synthesia, you hit this important milestone, revenues of 100 million in terms of ARR for last year, $100 million. What do the revenue streams look like for 2025? The macro environment is a little bit more challenging. Are you seeing that pace of demand and pace of growth and uptake?
We're actually not seeing that. The business is accelerating quite significantly over the last 6 months since we raised our last fund round to Series D. I think there are some macro implications all the tariff talk, of course, I think, for physical goods, obviously has an impact. I think with digital goods, we haven't really seen it yet. Maybe there's more fear in the market. But I think the underlying thing here is that the wave of AI productivity and, the kind of economic opportunity of building an AI massively dwarfs these kind of smaller spikes in the macro environment. So I think for AI companies that are growing really fast, it's very clear that everyone on the planet, every business on the planet know that they need to adopt AI. And so they are very willing to, put budget aside, because I think most companies feel, and I think rightly so, that if they don't adopt AI quickly enough, right, they will be put under a lot of competitive pressure.
What does that mean for the stickiness of your clients and their contracts? Are they signing 12 months and then rolling over? What is that picture for you?
So we're signing multi-year contracts. Our NRR is going up and to the right. And that's driven by, of course, our customers being very happy with the product, but it's also very much driven by expansions. What we're seeing is that usually we'll have one team, they'll come in, they'll find a use case for Synthesia, and then their colleagues will see it, they'll begin to adopt it, other people will adopt it, and that's how we go from contracts with, Fortune 100 companies that may, 3 years ago was $30,000 a year, which is very small in enterprise context, and now it's $1.5 million. So that's the thing we're really seeing in the enterprise. We're able to go and make one team successful. Some of them even start on self-service plans, just putting down their credit card and starting to create content. And then they slowly ramp up their usage and become really big customers and really just integrate AI video into everything they do.
What is your biggest growth market right now, regionally?
The US is our biggest market, but we are a very global company. The platform works in 140 different languages, so we very naturally have big presence in Japan, big presence in Europe. The language barrier is a huge kind of problem for our customers that are global, and we really help to break that down.
Can the UK hold on to Synthesia? You were born and bred in London. You're a multinational team, of course. You are a global enterprise. You're in Series D, so you're getting towards a point where questions will be asked about IPOs, Victor. Is that going to happen in the UK, given the current environment?
So, we're roughly 500 people now, right? So we're a pretty sizable company. We've decided to stay in the UK. I'm personally very passionate about making Europe, a great region to build companies in, and I think we need to build global leaders from here. So that's definitely our ambition to stay here, right? But there's also no denying that when you look at where to listing in Europe and in London, for that matter, it's not very attractive.
It's not very attractive right now. What would they need to do in the UK to change that dynamic and to make you rethink a listing in the UK?
I think there's some simple things like the transaction fee on the London Stock Exchange, for example, that can probably be done better. There's, liquidity problems. How much do pension funds invest in growth stocks, for example, right? That's looking very different in Europe than it does in the US. There's a bunch of structural things that can change. It's not something you can do overnight, but I think if we really want to compete on the global stage, and then we also need, an exchange that really can support that. I don't feel like there's any exchange in Europe that does that today.
No exchange in Europe that does that. Just very briefly, Victor, is this a wake-up moment for Europe in terms of the tech ecosystem?
For sure. And I think it is embarrassing that it took this much macro-political tension for us in Europe to take our defense seriously, to take our tech industry seriously. I'm very happy that it's happening now, and I think everyone is waking up and figuring out that maybe instead of just regulating things, we should, help builders build great companies. We should have a defense that can take care of us. So I think it's good that it's happening. I wish it would have happened 5 years ago. That would have put all of us in a better position. But now that we're here, I think it's good that there's tons of momentum.
Embarrassing, even as it is a wake-up call, and maybe there's that momentum and opportunity going forward. Victor Rippobelli, CEO and co-founder of Synthesia, on the developments around the training of NVIDIA and the push further into the enterprise space around that AI video platform. Back to you, Fran.
All right, Tom, thank you so much. Tom McKenzie there at Founders Forum. Now, also, don't miss the launch of our new monthly show, Bloomberg Tech Europe, and that starts tomorrow at 6:30 a.m. London time. Now, we're just getting some breaking news. An Air India flight carrying 242 passengers on board crashed near Ahmedabad city in the western Indian state of Gujarat. That's according to ANI. They are reporting, actually, local police. We don't know exactly what type of plane that was or the reason for that. We'll keep a very close eye on it. But just latest, this plane has crashed at Ahmedabad airport in India. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Tariff warning. President Trump plans to send letters to trading partners ahead of the July 9th deadline. Unilateral levies ahead. Mideast tensions. The Pentagon orders some staff to pull out of their embassy in Baghdad after Iran threatened to strike U.S. bases. And markets keeping a close eye on that 30-year auction as concerns mount over U.S. deficits and President Trump's tax bill. So let's take a look at futures and how we're shaping up for the trading day. Remember, we had 3 up sessions followed by a small down session yesterday, with the S&P finishing down about 0.25%. Futures pointed to another lower session today, although there are some catalysts in the early hours this morning that may improve as the day goes along. Nasdaq 100 futures down 0.4% after a 0.4% drop for that index yesterday. And Russell 2000 futures, the smaller and medium-sized businesses perhaps more affected by potential tariffs and so on, those futures pointed to a much lower open, down 0.7%. Let's take a look at bond futures because we are all eyes on that 30-year auction later on today. The 20-year yesterday came in pretty fine. That said, we're a little richer today on the 30-year. That yield down to 4.89. That's almost a full 10 basis points lower than where it was just a week or two ago, although still 10 basis points higher than the beginning of the year. Look at that. The 2-year yield down to 3.93 and the 10-year yield at 4.40 after a well-received auction. By the way, sell the dollar continues. That is the theme. Well, let's get some stocks to watch now in the early hours. Here is Joe Easton.
Morning, Bonnie. So we have seen a drop down in Boeing shares recently following this troubling news of a plane crash. A plane that was coming from India to London has crashed, according to latest reporting, and we do understand that it was a Boeing jet. So we've seen that stock dropping on what does sound like pretty tragic news, but we have seen a drop down in Boeing, so just thought we'd bring that one to you. Then in terms of the big earnings moves, we have got a move to the upside in Oracle today. The company smashing its earnings forecast last night. A lot of this tied to the AI growth and the AI machinery, so we're seeing that stock gaining the forecast much better than analysts were expecting. So ORCL up 7.5% this morning. Then we've got CoreWeave. This one potentially going to be stinging some short sellers today. The company, which is also tied to AI, recently IPO'd and was targeted by short sellers, but actually it's got a new involvement in a pact between Google and OpenAI, and that is lifting the stock today. As I say, probably going to see a bit of a short squeeze on that one. And as usual, keep an eye on the terminal for the before the bell opening wrap, which will wrap up all of this news and more before the open of trading. Vonnie.
Joe, thank you so much. Keeping an eye on all those stocks today. And coming up this hour, we're going to be speaking with Amy Wu Silverman of RBC Capital Markets on the biggest risks to volatility and what lies ahead. But first, let's get back to our headline story. President Donald Trump planning to set the agenda for trading partners. He wants to send letters to them in the next 1 to 2 weeks. Joining us now is Bloomberg's Brendan Murray. Brendan, this is all ahead of the July 9th deadline. So what are we anticipating these letters will look like? Separate letters for every nation that we're negotiating with? And does that include places like Japan and Korea, South Korea as well?
Yeah, exactly. So it looks like we're getting two messages from the White House. One from the president, that seems to be targeted toward countries that think that they can stall for time, that they'll automatically get a postponement of the 10% tariff that's set to spring higher on July 9th. And we're hearing Treasury Secretary Bessent say, you know, if you're negotiating with us in good faith, then we'll roll that out for you, and you won't have to face that higher reciprocal tariff. So we're coming down to crunch time now for these trade negotiations. There's just 3 weeks or so to go, and it sounds like the White House is trying to get the ones that are moving the fastest over the finish line and encourage the countries that are dragging their feet to speed up or else face those higher tariffs.
And you have to wonder if it's going to be the worst case scenario again in these letters like it was the last time, or if we should expect something different. Is the EU exempt from this letter, given that we know talks are apparently going to continue maybe even beyond July 9th?
So the EU, according to our reporting recently, thinks that it's going to get some sort of agreement in principle to continue talks further out in the future past that July 9th deadline, and in a way that doesn't raise their tariff to the 50% that President Trump has threatened. Now, Commerce Secretary Howard Lutnick said the EU is at the back of the line. So the EU is apparently one of those countries that the U.S. wants them to improve the offer that they're pulling together, and in order to reach a deal on time. So there's an interesting push and pull going on between the Washington and Brussels right now. The Brussels thinks it can get a postponement, some sort of temporary deal, and the U.S. is saying, well, you're actually not as far along as you think you are.
And if we move to the other theater of this, that's China. And of course, we've had 2 days of talks and an agreement and so on. More chatter out of China today to the effect that, yes, it has started issuing rare earths licenses. How are relations? Are they less frosty?
Yeah, it sounds like there's been a modest de-escalation of the tensions between the U.S. and China. The U.S. came back, and President Trump posted on social media that this was a deal, that it was done, that it was going to help American importers that need China's rare earth minerals. And China seemed to validate that. Some export licenses have been approved over the past 24 or 48 hours. So the U.S. is going to be very carefully monitoring compliance with the Geneva deal that both sides decided to reconfirm this week in London. So it's a fairly fragile truce, however. So we'll have to wait and see if China complies and the U.S. can verify that, whether this relative calm in the relationship can last more than a week or more. They have a couple more months yet before the deadline to reach some sort of agreement. So it's playing out in a way that at any moment it could escalate or even de-escalate.
All right, Brendan, watching every moment for us. Much appreciated. That is Bloomberg's Brendan Murray. Over in the Middle East, tensions are rising, and the U.S. has ordered some staff to leave its embassy in Baghdad after Iran threatened to strike American air bases in the region if talks over its nuclear program fell through. Joining us now from Istanbul is Bloomberg's Patrick Sykes. Patrick, this seems to be escalating, at least partially, quite quickly from Noor, the semi-official Iranian agency. This morning we're hearing that the Iranian government has ordered the launch of a new uranium enrichment center. That doesn't sound so good. And now we're also getting the U.S. State Department telling government employees within Israel not to travel, basically. Is this escalating like it seems to be?
It's definitely escalating today. That move by the Iranians, the announcement that they're going to launch another uranium enrichment facility, was in response to Iran being censured by the UN's nuclear watchdog. Iran had promised to respond in kind in some way, but we didn't know exactly how it would do so. That's definitely going to only increase concerns about the way that Iran's nuclear program is enriching. And the next thing to watch for, I think, from Iran will be whether they follow through on the threat to withdraw from the non-proliferation treaty. That's a decades-long treaty, international treaty that has restricted the proliferation of nuclear weapons. If Iran follows through on that threat, then that's, again, only going to increase the concerns that the atomic program run out of Tehran could be weaponized.
Now, obviously, with this new line from the State Department talking about regional tensions and restricting, at least domestically, travel for government employees, I guess that means that, you know, this theater could be very much in Israel's court as well. Will Israel respond, do you think?
Well, the main thing on the Israel front was overnight we had this report that Israel was ready to carry out an operation against Iran's nuclear sites. Again, that's a threat that they've sort of held in the air for some time. I think that report could have been written at many times over the past 10 or so years, but obviously the timing is important while the nuclear diplomacy talks are going on with the US. I think ultimately it's all just ramping up the pressure ahead of the next round of talks between Iran and the US, mediated by Oman, that are scheduled for this Sunday. With all the bluster in the past few days, you know, staff being withdrawn, potential strikes on the horizon, that's all pointing to a particularly pivotal round of talks. I think it'll be really key to see if they can square the circle of whether or not Iran will be allowed to retain some kind of enrichment capacity in any deal with the US.
Is it possible at all, Patrick, and I know this is probably an impossible question for you to answer, but is it possible that this idea that Iran has ordered the launch of a new uranium enrichment center, that would be something that could be leveraged if necessary in any US talks? So in other words, to withdraw that order might give Iran some ammunition?
Absolutely, and I think for many people, the whole nature of the nuclear program is exactly that. Right? They've increased enrichment massively, and now that enrichment, that capability, those facilities that have been so highly developed are exactly what's on the table to be partially, fully, yet to be seen, dismantled under the terms of a deal. So yeah, exactly. It's leverage for Iran to use. The stumbling block is still that point, which is a zero-sum point of whether they can retain some capacity or if they have to give it all up. And what I think in turn they get in exchange in terms of sanctions relief. That could be partial, it could be complete. There's still a lot of variables to be negotiated.
Patrick, thank you so much. Well, off the back of that, we are actually seeing WTI and Brent down about 1.2%. So not as panicked in that market, at least, as we saw yesterday. That was Patrick Sykes for us in Istanbul. Now to other top stories trending on the terminal this morning. The UK economy shrank by 0.3% in April, month over month, more than the average economist estimate. Sharp tax increases and President Trump's tariffs triggered the biggest monthly contraction in Britain in 18 months. It all cast doubt over the Labour government's plan to bet on growth to fund its spending ambitions. Deutsche Bank's fixed income and currency traders overcame a choppy start to the second quarter and should deliver a stronger second half of the year. That's according to CEO Christian Sewing, who spoke at the Goldman Sachs investment conference. He called the first 15 days in April a rough start. That's, of course, when President Trump's tariff announcement jolted markets. Apollo is taking a leaf out of JP Morgan's book. The asset management giant told prospective investment banking candidates that it won't interview nor extend offers to the class of 2027 this year, saying it believes graduates should take time earlier in their careers to deepen their understanding of business. The letters follow backlash from banks over young recruits accepting future dated offers. Let's take a look at markets now. We are seeing S&P and Dow and Nasdaq 100 futures pointed lower in the early going. More so, in fact, for Russell 2000. This would be after a down session yesterday. And as you can see, the 10-year yield there at 4.40, having dropped 7 or 8 basis points yesterday. We have the 530 spread now below 90 basis points. It'll be fascinating to watch that 30-year auction later on at 1 p.m. Eastern. Now let's head to the Founders Forum, where founders and investors across Europe are gathering in Oxfordshire, England. Bloomberg Editor-in-Chief John Micklethwaite is with Netflix co-CEO Greg Peters. Let's listen in.
I would say, based on our ability to internally estimate the Mike Tyson, Jake Paul audience, which we were, about a quarter of what we actually ended up having. Maybe our estimates aren't as good as they could be, but we think it's going to be quite big, I think, and that's the most important part. And quite big globally, too, because Canelo's obviously got an amazing following in Mexico, and so we'll have some Latin American viewers as well. But to your main question, we do think about this as more of an event strategy rather than a sports strategy per se. So we want to try and do kind of big buzzy events that people are talking about, that they enjoy watching, and then reliving the stories about together. And we think that that's something we can add as value to our subscribers. But we also, and we love sports, to be clear. We would love to have Premier League and American football and many things. And we do carry the American football games on Christmas, and we're going to do World Cup coming up. But we also want to make sure that we are doing this in a profitable way, and so us being very disciplined about what events that we go after, and making sure that we are not paying too much for, let's say, a whole season, of a league. That's the kind of balance that we're seeking to strike.
So you're not going to bid on packages of UFC or Major League Baseball or even Formula One, which sometimes, occasionally you hear your name being mentioned in these moments.
Yeah, for sure. And I think, of course, everyone would love us to be a bidder. It's good to have multiple bidders coming in. And F1 we have a special relationship with because of Drive to Survive, which we love. But I would say until we find a way to do something bigger in a way that we think is sustainably profitable, that's really the crux of it. We've done it with WWE, which is an example where we did a long-term deal where we felt like, if we help grow this property, we get to benefit as well as they get to benefit. So that might be a model, but we've got to really figure out those models that we can remain disciplined around.
So you're more likely to go for a kind of newer sport, if I can put it that way.
Well, perhaps. I don't necessarily know that that's the case. I mean, certainly us finding opportunities with leagues to take particular games that we can eventize, we can do something special around it. The American football games that we did on Christmas Day, we did Beyonce with as well, which was, I think made it more of an event, more special as a result. So those are the kind of opportunities that we're definitely looking for. Things that, if we can help grow the viewership of the sport through those activities, that's good for the league as well. So that typically an opportunity to find a good deal around it. So it's just, finding those specific instances that really work in that model.
Do you think the old model of sports is dead, that it might move more? The thing you're talking about is a more kind of event, individual game almost model.
Well, I wouldn't certainly say that the old model is dead, and I think there's ample bidders for these properties that we see. But I would say we don't know a way to make it work for us in that specific way. And I think, we're enthusiastic about trying to figure that out over a period of time. But, to be very clear, we want to make sure that the properties that we bid for work for our business as well as for the league and for our members.
The idea, though, that you are the most profitable and you're not that interested in it, I think is interesting. On that subject, the other thing that happened this week is we saw Warner Brothers Discovery spinning off its cable channels. huge thing in your industry. What's your reaction to that, and what does that tell you about the industry?
Well, I think we're going through an evolution, and we're sort of getting to the next phase of maturity where the market participants are trying to figure out, given the new reality, sort of what consumers expect from the business. Everything is moving to streaming, everything is moving to on demand. It's very clear that consumers want that. Then they have to rationalize their business for that reality, and we're definitely seeing, the results of that. And I think these are sort of, inevitable, long predicted, long forecasted changes. So there's going to be a period of, shakeout and transition associated with that. I'd say, I feel, we were lucky, I would say, in the fact that we came into this, new ecosystem starting with the new model, so we don't actually have some of the complexities or difficulties of having to navigate through the transition because we've got a legacy business model. So that just makes it a little bit easier for us.
Do you expect to see mergers between these legacy players?
I think that's there's an inevitable logic to that, and then you get to, every merger is a unique opportunity, and sometimes it presents interesting complexities. There's regulatory complexities that often are the case, and then there's, the two companies have got to decide it makes sense, for them to go do it. And there's lots of, I should note that the track record around doing these large media mergers is maybe not amazing. There's some good examples out there, but there's some not necessarily great ones. And so, I think, folks want to think long and hard about whether or not they're in a position to do it well.
So Netflix would likely not be a player in buying some of these things.
I think we have an obligation to explore all of the opportunities that are in front of us. So it's our responsibility.
And then reject them.
It's our responsibility to do good due diligence, but then also to have a cold, hard, disciplined look at, do we think we could do this well? And I would just say, like our track record is we're builders, we're not buyers. And so we're not particularly great at acquiring companies. It's not like sort of a demonstrated practice or capability that we've built. So I think we should bring that, perspective into how we think about these as well.
In terms of competition, though, do you think about the other streamers as competition, or how much do you now think of YouTube as the competitor?
Well, I would say we think that we're in a massively competitive environment, right? And we've got competition from traditional media, we've got competition from new streamers, Amazon, Apple, et cetera. We've got competition from, UGC products, user-generated products like YouTube, like TikTok, sort of everything. Games is obviously a source of competition. Increasingly we see, YouTube as a pretty strong competitor for time and attention. They're doing a good job at accumulating that. And, we think our response and our job is to make sure that we're making sure that it's distinct and clear, the job that we do in the entertainment ecosystem, both for creators in terms of giving them the resources required to produce amazing stories, and a platform to give a big audience for that. And then also, obviously, then for consumers and our members, which is to give them a particular kind of storytelling that they don't see on YouTube, but also make sure that we are, expanding that portfolio in the places that we think we can operate, and expanding the ease of access and the ease of being able to engage in those stories in a way that gives them an experience which is also competitive with what YouTube is offering them.
I mean, your co-CEO, Ted Sarandos, famously said, YouTube is a place where people go to kill time. Netflix is where people spend time. But there's some signs that you're slightly reconsidering that YouTube does seem to be a place which is beginning to compete with you slightly more directly.
Yeah, I think they're trying to move up, frankly, and our job is to defend that space. And so how do we think about that? One of the ways we do that is we think that YouTube is a place where, great storytellers can emerge, and great storytellers that are doing the kind of storytelling that we think that we're good at. And our job should be to say, hey, we think Netflix is a great place for you to go and tell those kind of stories in a different way that our model supports that they might not be able to do on a YouTube, let's say. So that's an example of a place to be competitive. We're also trying to be competitive and trying to think about an evolution of our member experience in ways that there's a broader range of content that we can offer that still feels like Netflix content, what you'd expect to get from us, but also in ways that just, make it easier to get into that space. Because I think, one of the things that we see is sometimes, there's immense value put on getting into a deeply engaging story, and that has a tremendous amount of payoff. And you can see that, in the economics or in our business model. Folks are willing to pay for that. But also sometimes that can seem like a hurdle to get into, right? And so, we want to broaden that space and make it a little bit easier every year.
On the 7 streaming services at the moment, do you expect that number to come down? If we met each other in 3-4 years, would you expect that to be down to fewer?
You know, I generally look at the way the internet works, and it tends to sort into sort of 2 buckets, right? Which is, you know, there's a lot of benefits on scale, and so that would argue that number probably should be smaller. There's also, you know, a space that exists where very targeted, very, you know, niche services can operate at great, you know, lower cost, but, you know, sort of can be quite effective as well. So my guess is that's where we land.
One of the joys of your life at the moment, which you probably didn't anticipate before, is things like tariffs. We have Donald Trump coming to you and now saying he wants to put 100% tariffs on foreign production coming to the US. You make a lot of stuff around the world, and I suspect you would be more affected than most. What's your strategy on that?
Well, we're sort of waiting for a specific proposal. We haven't actually seen any details yet, so it's hard to respond specifically in absence of those details. So we're in sort of standby mode, and as soon as we see something, then we can comment more fully.
Do you worry about entertainment getting wrapped up in much bigger quarrels with China, all those sort of things?
Well, I think that entertainment is a universal product in the sense that all humans want to be told stories. So I definitely see that as a strong reason for, you know, optimistic perspective on the industry. And then we've always had to, I think about storytelling as also having a highly local component, right? Which is, you know, there's very different cultural perspectives and perspectives of storytellers. And mostly our job is to try and give storytellers around the world in multiple different places, multiple different languages, the opportunity to tell their stories. And that wealth and diversity of perspective has served us quite well. So I think, you know, that's what we think.
So you would still continue with it pretty much regardless, but because you need that local content for other places in the world.
You know, that's right. I mean, local consumers want to hear authentic stories from the place and culture that they exist in, and then sometimes those stories become large global phenomena as well. And we definitely think that you have to start local and tell that authentic story, and then if you do that really, really well, sometimes that's the thing that goes, you know, global.
What happens in terms of AI? There's been a lot of fuss about how maybe AI can change the way that films and TV is produced. What would you expect to change most over the next couple of years?
Well, I would say there's a long gap between what you can see in a demo and sort of what you get to when you actually have to put something in production and really, you know, have predictable outputs. So we're definitely in that space where there's a lot of work that goes on. But we're seeing tools, especially tools that help creators in the sort of, you know, non-production part of the process. So this is pre-visualization, you know, or you know, shot composition, things that work in that regard. But I think that gets to really our perspective on what AI will do, which is it'll give an increasingly effective set of tools that still, you know, has the creator at the center. Because we very much believe that storytelling it's a hard thing to go do. It's a unevenly and rare commodity in the distribution of humans in the planet. And great storytellers, you know, will still be at the center of, you know, for creating great stories.
When you look at the value in Netflix, where is it? Is it that subscriber base? Is it the IP? What is the bit that you most want to defend?
Well, I would say we're trying to build more and more value in the IP that we have. We're relatively young in that regard, right? So if you look at our traditional media peers, they have
enormous libraries,
you know, and sort of much more valuable, let's say, IP catalog. But then, you know, I think if you look at our track record, we've only been doing this, you know, for a little bit over a decade, right? And we've, you know, got some properties that we're quite excited. If you think about Stranger Things as an example, we've got, you know, season 2 of Wednesday coming out. I think these are all examples of, you know, us building IP. But you know, largely what I'd say is that we've got you know, over 500 million people on the planet who come to us to seek to be entertained. And our job is to fulfill that, and if we do a good job, that's quite a valuable business.
There's been a slight shift, though, in the kind of business model away. It was all about growing subscribers, and that's what everyone always focused on every quarter. Now there's a little bit more about profits, returns, and one obvious way in which you could become even more profitable is to put up prices. So I wonder to what extent could that be part of the strategy going forward?
Yeah, and we've long had the perspective that it was smart in the business to sort of always grow margin a little bit, every year, because that was sort of building in that discipline about just how we wanted to build a more successful business was important. So we've been doing that for quite some time. And then, we've got a couple different levers to go do that. Obviously, growing subscribers is one of those. We continue to go do that. Being able to raise prices because we've delivered more value to those subscribers, and we think that it's appropriate to go back and ask them to pay a little bit more so that we can reinvest into actually improving the value of the services. Another one, but we've also got increasingly other ones too. We've got advertising we've added to the mix as well, and so now we have the opportunity to work with amazing brands around the world and give them the capability to tell the story about the products and services that they are delivering to consumers on the planet that are interested, because we're targeting increasingly and getting better at personalizing those ad experiences. So I'd say, we're just, as many businesses do, we're getting increasingly sophisticated and having more of those levers at hand to try and continue to do what we do, which is build a better and better business every year.
How much pricing power, though, do you think you have? Do you have the pricing power conceivably to double fees? Just to give you an example, it's much easier to double the subscription fee than to double the number of subscribers.
Well, it depends on what country we're talking about, actually, I would say. And so we think about that answer as very different around different countries around the world. And to be clear, we believe that there's there's hundreds of millions of Netflix capable households that have everything that they need to sign up that aren't currently signed up yet. So we've got a lot of work to go do there as well. But we don't have an a priori position on this, and we really think about this as an interaction with consumers, with our members, where we look for signals that we've delivered more value and it's an appropriate time to ask them to pay a bit more. That's the thing that governs how we actually think about changing prices.
And in terms of the other way of growing business, which you said is to get those subscribers, is that now something that is moving much more to Asia, say, than Europe? I think Europe is your biggest market at the moment.
I'd say one we
put it together.
Yeah, we put it together. We believe there's a subscriber growth pretty much in every country that we operate in. So it's not as if we feel like we're done growing anywhere at this point in time. But to your point, if we look at the sort of the open opportunity, the TAM available to us, there's a lot in Asia. We're just younger in Asia. We've got more work to go do to improve the offering there. We think about oftentimes in countries you start at a center in terms of the content and the offering and how it's presented to market, and then you start to expand out. And there's many countries that we've got a lot more room to grow in Asia.
And just be a little bit more specific on that. Are there particular countries in Asia that you're targeting? Is it across the whole region?
Well, there's tons of opportunity there. So, I would say we first launched in Japan. That's probably the furthest along in that sort of evolution.
Where you were based for
I had the great honor to launch the service there and get us rolling. Korea, is another great example. I think we're making good progress. India, we've seen good acceleration in subscriber growth there as we get more.
Can you charge the same kind of fees in India that you can elsewhere? Subscription normally there is much cheaper.
Yeah, and we do think of pricing as a very local, country-specific situation. So we charge different fees there, and to your point, they're lower in India as well. But I would say there's tons of growth all throughout Asia, and there's tons more work for us to go do.
Is that a really big difference between you and the other streaming services? Is that you do tend to be more global? Amazon maybe as well. Apple's a bit patchy. You've got these other people are behind you. Certainly the standard old Hollywood ones.
Well, I would say in terms of that set, we're the most global, and there's part of being global is being available for consumers around the world, but also being available. There's a deep set of what does that mean? Are you good at payments in the market? Do you have many local partners? Our partnerships in all these markets run incredibly deep, and which is important to making sure that the service is available, accessible to members. But a big part of also being global is the content offering, right? And so we produce in more than 50 countries around the world productions, and so that's critical to making sure that we've got the right kind of stories that those local members want to hear.
One last thing, just if you look at your standard Netflix screen, we're all very used to it.
Yep.
Is that going to change at all?
Well, we did just actually roll out a pretty significant change to it, where we've been working on this for a while, where we've had the same essentially UI structure, user interface structure, for almost 10 years, and now we've just come up with a new one, which we think will set up the business for the next 10 years worth of innovation. It supports new content types effectively. So we mentioned all the live things that we're doing, like that Canelo Crawford fight. It'll do a better job at letting people know that this fight's coming, and then they can remember and and be able to watch it in time. Games is another interesting space for us, where we'll actually be able to deliver more games to the TV. So that's an exciting. And then there's just tons of look and feel improvements, and also one of the main benefits is that this new user interface will be able to respond dynamically to what you want in the moment, right? So we definitely see that not only do we personalize as we do today, so your Netflix looks different than my Netflix, but you probably have different needs from Netflix in the moment, right? So whether that's Sunday afternoon, maybe with the family around the TV, versus Thursday night by yourself, those, we want to make sure that the UI is doing that specific job very, very well.
So we're going to end up with a more kind of personalized Netflix. Could it be the place where actually the thing we've always looked for on the news side is to try and personalize news? People have tried and failed. Do you think entertainment is the place where we might see that first?
Well, I would say we're already highly personalized, right? So the title selection that you and I get,
what you've been watching and so on,
that'll be very different for you and I. We actually present titles differently in a personalized way. So even if we get maybe the same story, let's say Black Doves, incredible story, you might have a connection to that story that might be different than mine. So the assets that we use to present that should be personalized and specific in that way. But then this next step with the new user interface is that we actually want the form and function of the UI to be personalized as well, so that it is tailored and optimized to doing the job that you need in your particular moment, versus a different moment that you show up, or versus what I need in any other moment.
Peter, thank you very much. We could spend a long time discussing how Black Doves would be different for both of us, but thank you.
Thank you.
Thank you. I'll be back.
That was Netflix co-CEO Greg Peters with Bloomberg editor-in-chief John Micklethwaite at the Founders Forum in England. And you can continue to follow our Founders Forum panels by typing Live Go on your terminals. It's just after 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Tariff warning. President Trump plans to send letters to trading partners setting unilateral levies ahead of the July 9th deadline. Mideast tensions. The Pentagon orders some staff to pull out of their embassy in Baghdad after Iran threatened to strike U.S. air bases. And markets keeping a close eye on the 30-year Treasury auction as concerns mount over U.S. deficits and President Trump's tax bill. Let's take a look at where we stand markets-wise now. We are taking another leg lower, this partially on Boeing, which is down more than 7%. But as you can see, S&P futures pointed to a drop of 0.4% at the open after a down day yesterday. That index was down about 0.25%. The Nasdaq 100 showing a drop of about 0.3 at the open on those futures. And the Russell 2000, perhaps on these tariff letters going out in the next 1 to 2 weeks, maybe affecting small to medium-sized businesses more, down 0.75% in the early going in terms of futures. Take a quick look at the bond markets, because we did see a big rally yesterday, and that's being reflected in yields. The 2-year yield there is sensitive to interest rate moves. Now the market pricing in about 47 basis points of cuts before the end of the year at 392.86, and that all crucial 30-year yield down almost 10 basis points from a couple of weeks ago, and down several basis points after yesterday's successful auction. We'll see how traders feel those 30 years are valued later on today at 1 o'clock when we look at that auction. Back to breaking news now. Boeing is down 7% in early going. An Air India Boeing 787 aircraft carrying 242 passengers and crew has crashed, according to the ANI news agency. The plane was travelling from Ahmedabad in Gujarat to London Gatwick. For more, we're joined by Bloomberg's global aviation correspondent, Sid Phillip. Sid, give us the latest. What do we know about how this plane crashed, when it crashed, and so on?
Morning, Moni. So we don't really know yet about how this plane crashed or what really went wrong with this crash. But I mean, essentially, it was a catastrophic incident for the airline. And essentially, we're trying to see, in the next coming days, we'll sort of have more insight into what really went wrong with the aircraft. It was a Boeing 787 jet. It was 12 years old and was operated by Air India. It had sort of flown a flight from New Delhi to Ahmedabad earlier in the day and was sort of on its takeoff. It was taking off for London when the crash occurred. And so it was just minutes after taking off that we had the crash. It was about 625 feet off the ground, and it was sort of at takeoff speed. So we're trying to figure out what the details are of this incident. We're trying to figure out what really went wrong, but it is a catastrophic incident for the airline, and it is we'll have to see if there was anything that went wrong with the aircraft or whether it was a technical error or pilot error. We still don't know the details, but it is a significant crisis for the carrier.
And it literally just happened. Rescue operations obviously just underway. We're hearing from a spokesperson for the airport that airport, Ahmedabad Airport, is obviously closed. Just give us some context, Sid. Air India is obviously the flag carrier airline for India, one of the largest fleet sizes. It travels in and out of airports all across India and Gujarat region all day long, every day, right? And tell us a little bit more about the 787 Dreamliner. As I understand it, this would be the first incident for that particular aircraft.
Yes, this would be. So the 787 Dreamliner is a very advanced aircraft. It's the first ever fatal crash for the aircraft, and so this would be a very significant it would be a very significant moment for the model, which has so far had an unblemished safety record. And we're looking to see what really went wrong. I mean, Air India obviously is in the midst of a revitalization of its fleet after it's been taken over by India's Tata Group. It was state-owned, and now it's owned by the Tata Group, and they're in the midst of expanding its fleet. They've placed large orders. At the last Paris Air Show, they announced orders for 430 aircraft, and so they are in a growth mode. They are flying to more destinations, both within India and around the world, and we're really looking to see what this impact means for the carrier and their growth plans as well, I mean, longer term.
Absolutely, and our thoughts, of course, are with everybody involved inside the aircraft and outside as well. Sid Phillip, thank you so much. That is our airline expert, Sid Phillip, and we'll keep you updated as we learn more throughout the morning. A quick check of the markets now. We're seeing futures pointed to a lower open in a few hours, about 0.4% per index. That's after a down day yesterday, but 3 up days previously. You can see the 10-year yield there at 4.39. We are looking at a spread, a 5.30 spread below 90 basis points, about 89 basis points. And that bodes potentially well for the auction later on, the 30-year auction. All eyes will be on that auction. So joining us now to talk us through some of these market moves is Amy Wu Silverman, Head of Derivative Strategy at RBC Capital Markets. Amy, talk to us about the character of this market at the moment. We have a VIX at around 18, a move index that's pretty, I don't want to say complacent. That might be adding too much motivation to this market, but is it a complacent market?
Certainly feels that way. And then I think when you get this Trump tweet risk that comes and goes, it certainly feels like a volatility pothole. Bonnie, I think one thing that is interesting about the options market and what it's saying is short term, we've certainly seen the VIX come down. It's kind of below that psychological 20 handle. But when you look longer term, when you look 3 months out, 6 months out, you still see a decent amount of elevation in implied volatility. This is on S&P. This is on IWM, which is the small cap proxy. And it is telling you that people are worried. I think they just don't know how to play the timing right now because there's been a lot of can kicking, especially as it relates to tariffs.
I love how you characterize them as volatility potholes. And I'm curious, Amy, where do you see the spikes more? Is it when President Trump tweets out something random that we haven't been anticipating? Or is it when we hear something about Iran potentially ordering a new nuclear enrichment site, a geopolitical headline? Or is it something, even as, maybe not central to domestic affairs as a rift between Elon Musk and Donald Trump?
Yeah, you would think rationally that something that's a major geopolitical tension, like a potential nuclear armament, would cause the volatility spikes. It's actually the latter. It's, the breakdown of a bromance. It's, whether or not Trump will not taco out because people have calling him a chicken. And so, it feels kind of silly, but there are quite serious consequences. And, I have to tell my bad volatility joke, which is, there's this other Greek that people aren't considering, and it's tweet a risk. It's the risk of Trump's tweets affecting implied volatility. We've seen that time and time again, and I think it's just related to the unpredictability that you have when you have one person who is so determinative for policy rather than something that's more tectonic like geopolitical risk, but also might move more slowly.
That is fascinating, Amy, what you just said, and takes me completely by surprise. I'm curious, what is the picture around July 9th? If you look at sort of the term structure and volatility out that far, is there anything surrounding July 9th, or is the market assuming that we'll have more answers by then?
Yeah, so if you had asked me this question a few days ago, I would have said the market is essentially believing that either this framework will get pushed out or we'll get some deal that generally the market's relatively happy with. That has been changing a little, and this is what I mean by Trump just continues to keep investors on their toes, and you're starting to see that change, that little bit of spike. But again, it's early days. I think, again, it depends on whether or not we get more of that tweet bomb risk. But anecdotally, when I talk to investors, what they say is they do believe there are guardrails in place. It might not necessarily be on the S&P in terms of the equity markets, but perhaps the Trump put is on the bond market. He does watch the markets really closely. And also Scott Bessent has said that we've seen the last VIX spike during Liberation Day. That's the highest it should go. It's always interesting to me when people in the administration are calling for the peak in VIX, and who knows, but they're certainly watching the market.
How much more expensive is it to buy volatility protection, and where are people looking for it?
So what I would say is, look, if you had asked me this question versus a few years ago, of course things do look relatively more expensive. But in the context we're in, which is the U.S. is trying to make this kind of generational change in tariff policy, if you go back to April 2nd when this all started, it's gotten a lot less expensive. So if you look on a 5-year basis at both tail risk and skew risk, so the risk of a 10% drawdown in the market, we're essentially in its 40th percentile, so below average on a 5-year percentile basis. And that's come down from basically the 99th percentile when you think about the week after April 2nd.
Amy, give us an update on the retail trader and those volatility spikes that we see at certain times of the day that may even be, or are very likely, bots to a large degree. Should we expect more of that? Is it troubling? Is it a concern that the rest of us should have?
Look, I think you can call it bots, you can call it systematic trading, but I think that is just becoming more and more of what is normal, especially in derivatives markets and equity markets. I will tell you in terms of a retail update, they won round one, right? They were steadily buying the dip when investors degrossed and de-risked, and they ended up being right. They did not get whipsawed, and some of that has to do with the fact that retail investors probably just have a longer time horizon. They're not trying to meet some equity benchmark for year end, perhaps if a 30-year time horizon. I think that's part of the difference. But, the retail investor who has been buying since April 2nd is still happy. And, look, you have markets near all-time highs, and that certainly for them is something to not complain about.
For sure. Amy, thank you so much for your time this morning. Much appreciated. That is Amy Wu Silverman of RBC Capital Markets. Coming up, mapping out the tariff agenda, President Trump reiterates his planned proposal for trading partners in the U.S. More on that story next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
We're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
President Trump reiterating his plan for the trading partners ahead of the U.S. deadline of July 9th as it looms. Joining us now is Bloomberg's Brendan Murray. Do these trading partners have any idea what to expect? Brendan, will it be a different offer, if you like, for each one?
Well, they do know what their tariff rate would be if they don't strike one of these deals by July 9th. And some of them are very high. Vietnam's is 46%. Japan and Korea are looking at something in the neighborhood of 25%. So those would be economically painful for those economies, particularly the Japanese and the Korean auto industries. Vietnam, based on our reporting, is in the fast lane for a deal. It's making noises that the Trump administration likes to hear about buying more U.S. exports. India is also among the countries that is moving quickly. So we have 3 or 4 weeks now before these deals need to come together, and you have the president saying, on one hand, if you don't have one with us, then you're going to get that higher reciprocal tariff rate. And then you have Treasury Secretary Bessent saying, kind of softening the tone and saying, well, if you're negotiating in good faith with us, then we'll push that deadline out and keep talking. So that's probably by design to encourage countries that think that they can delay and stall and wait this out to come to the negotiating table quickly.
Certainly seems so. Brendan, thank you so much for joining us this morning. We appreciate it. That is Bloomberg's Brendan Murray. Meanwhile, in the Middle East, geopolitical tensions are rising, causing oil to fall today, though. After a 4% jump yesterday, Iran has threatened to strike U.S. bases in the region if talks over its nuclear program fall through. Joining us now is Bloomberg's Will Kennedy. And Will, we're getting even more headlines today from the semi-official Noor agency that Iran has ordered the production of a new uranium enrichment facility. Does this up the temperature even more?
It does. I think that traders in the oil market are tracking a few different risks here, Bonnie. Number one, clearly there is this threat in the background of military action, this talk that Israel may be willing to strike Iran, and that's obviously the worst case scenario for many oil traders if it escalated and stopped oil flowing from the Persian Gulf, which obviously is key to the global oil market. But in the background, you've got this atomic diplomacy and the talks between the US and Iran on a nuclear deal. And there, the mood music is very, very bad. Today, you've got the IAEA, the UN Atomic Agency, saying that Iran is in breach of its obligations on uranium enrichment, and in turn, Iran saying, as you pointed out, that it may up its uranium enrichment. And against that background, the risk for the oil market is also that sanctions will snap back on Iran, that the US will press for more sanctions, that the UN process will snap back previous sanctions, and that will also restrict the flow of oil out of Iran. And that's why we're seeing prices rise yesterday by a significant amount. And I think one thing I would point out is that prices touched $70 a barrel yesterday, which is not a level for the key Brent benchmark that we've seen since April, when OPEC started putting a lot of oil back into the market. And I think that shows you just how resilient the oil market has been to all this extra Saudi and OPEC supply, and the concerns that we may be losing oil from Iran in the coming months.
Yeah, it was quite the eye-popping move yesterday. We'll certainly keep our eye on all the headlines and the market moves today as well. Bloomberg's Will Kennedy, thank you so much for joining. All eyes also on the 30-year Treasury auction scheduled for 1 p.m. New York time. Investors are looking for a fresh read on whether spiraling deficits are actually sounding alarms in the bond market. Veteran bond manager Jeffrey Gunlock of Double Line Capital told Bloomberg a reckoning is coming for America's debt burden.
There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%, probably going to go higher on the inflation rate.
For more on what to expect, Bloomberg's Alina Oyemada, who leads our European FX and rates coverage, joins me now. So, Alina, bond auctions have become much-watched events for Wall Street. What's the feeling going into this one, given that it was pretty successful yesterday and the 30-year might be a little richer today?
Yes, that's right. The auctions have been very much in focus, and this one in particular is important because it's an offering of 30-year bonds. If you remember well, last month we had a huge sell-off on long-term bonds, and those 30-year tenor ones were at the heart of it, not only in the U.S., but also in Japan. What's behind this whole anxiety is really fiscal concerns. So investors are worried that governments are spending more and will have to issue more debt to fund that spending, and that's making the market a bit jittery. Like you said, yesterday's auction went fine. So today we are really looking for any signs on whether investors will still buy into it or if there's some cold feet going into it.
All right, Alina, that's at 1 p.m. again, Eastern time, and we'll be keeping our eye on those yields. That's Alina Oyemada. Thank you so much. Back to breaking news. An Air India Boeing 787 aircraft carrying 242 passengers and crew has crashed, this according to the ANI news agency. The plane was traveling from Ahmedabad to London Gatwick Airport. For more, we're joined by Bloomberg's global aviation correspondent, Sid Phillips. Sid, what can you tell us about the crash?
So the airline just confirmed that 242 passengers and crew on board the aircraft, and they did confirm that they haven't yet said how many have survived or what the casualty numbers are, but we did see images of a fairly fiery explosion for the aircraft. And we do know that the aircraft was a Boeing 787 aircraft. If this would be the first ever fatal crash for the aircraft. I mean, this aircraft has been in service for over a decade now, and it's used by multiple airlines. It's Boeing's most technologically advanced aircraft that's currently in service. And this would be the first fatal crash for that model. We're still waiting to see what the airline or the authorities talk about in terms of what the reason for the crash was. I mean, I think we'll know more about it as the days and months go by. But at the moment, we don't really have a cause for what happened. We do know that the aircraft climbed to about 625 feet. So shortly after takeoff, this accident occurred, and we're still waiting on more details for what really went down.
And give us some context, Sid. Ahmedabad is in Gujarat region, and Air India would be the flag carrier airline, right?
Yeah, so Air India is in India's flag carrier airline. They operate international services to the US, the UK, and other destinations around the world. They're in the midst of a turnaround under the Tata Group. I mean, Tata Group acquired Air India from the government of India, and they've placed large orders for 500 plus aircraft. They're revitalizing their fleet, they're revitalizing their services, they're adding more destinations. And so this is a massive blow to the carrier, which had sort of ambitions to scale up and target more passengers, bring in more passengers through their hubs in New Delhi and Mumbai. And so we are still, I mean, this would be a massive blow to Air India's growth plans, as well as to their safety record. But I mean, at the same time, we still don't know what really went wrong and why this crash occurred. And we're still sort of waiting for more from the government and more from the authorities in terms of what the details of this incident are.
All right, Sid, thank you. And we're just getting another headline now that it had 169 Indian and 53 British nationals on board. That's Sid Phillip in London. A check now on the markets as we head ever more closely to the opening bell. We're down about almost 0.5% for S&P futures. That after a down day yesterday. It was 0.25% of a drop for the S&P. The dollar index down another 0.5%. That is just the theme. Dollar selling constantly. The 10-year yield at 438.28 after yesterday's pretty successful auction. We'll be watching the 30-year auction at 1 p.m. Eastern. Well, that's it for Bloomberg Brief. Do stay tuned. Surveillance is right ahead. Thanks for watching. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The U.S. economy's got a very asymmetric effect going on right now.
If the current level of tariffs stick, we do still expect this inflation pressure to rise.
Tariffs can certainly slow growth some. We're not big believers that they're in any way kind of inflationary in a durable sense.
We should expect to see some upside pressure on inflation coming from tariffs.
The noise versus signal, the noise is very high right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, confronting risk.
We're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is.
President Trump threatening to set unilateral tariffs in the next 2 weeks as tensions rise in the Middle East. The U.S. pulling some embassy staff out of the region, fueling a risk-off tone this morning, sending equities towards the first back-to-back losses for the month so far.
So there's a lot of risks right now in the market. First, when it comes to tariffs, there's a lot of questions on what's going to happen to all these countries the U.S. is negotiating with. The president says, we're going to set the deal, we're going to set the rate. I think that's for most countries, besides the 18 that the Treasury Secretary mentioned yesterday on Capitol Hill. And if you are negotiating, as he says, in good faith, this is what I've heard from foreign trade representatives, they will give assurances that that July 9th deadline will be extended.
We've got some debt coming to market a little bit later as well. The 10-year auction was fine yesterday. 30-year debt later on this afternoon. 30-year debt auction in the face of these comments from Jeff Gundlach, a double line to Lisa. A reckoning is coming. The Treasury Secretary, Scott Bessent, on Capitol Hill once again.
Once again, he's going to be asked about the debt in the bond market. He said that he recently spoke to Jamie Dimon about it. He said, I think he was just talking about market structure, not exactly what's going on with the U.S. deficit. He said what he wants to do by the end of his term and make sure he brings down the deficit to GDP. We'll see what he has to say, potentially in response to Mr. Gundlach on Capitol Hill today.
Bonds catching a bid in the last 24 hours. Downside surprise on CPI. Core CPI softer for a fourth consecutive month relative to expectations. Yields are lower in the bond market. Crude yesterday was higher. A little bit softer this morning, but new levels for you. Brent crude 68, WTI 67, and the focus on Iraq, Iran, Israel too, and what's going to happen in that region.
Absolutely. What we are seeing right now in the oil market is geopolitical risk premium being put into prices. This is after reports that Israel's potentially ready to launch a strike on Iranian nuclear sites. The United States, and if that is true, is looking at potentially in the region and where Iran could retaliate. So obviously they would want to pull not essential staff out of Iraq. The other thing is the diplomacy on all of this. On Sunday, Oman this morning said that they do expect another round of Iran-U.S. talks. Trump said yesterday in the New York Post he wants a diplomatic deal, but it does seem like his patience is wearing thin, and he doesn't think Iran is coming to the table in good faith.
Crude down this morning by 1.5% on both WTI and Brent. More on that story in just a moment. Coming up this hour, we'll catch up with Alistair Pinder of HSBC as the rally loses steam. We'll speak to Scott Lincecum of the Cato Institute on President Trump's latest tariff threat, and Norman Rule of CSIS as the U.S. pulls some embassy staff from the Middle East. We begin this hour with stocks falling after snapping a 3-day winning streak. Alistair Pinder of HSBC writing, we believe the path of least resistance for equities remains upward and potentially see room for some U.S. performance catch-up versus the rest of the world. Alistair joins us now for more. Alistair, good morning.
Good morning.
I've read those comments a lot from a lot of different people on the south side. Tell me how different things might be on a buy side. What the conversations sound like with clients at the moment.
I think the conversations with clients is that they're very worried. I mean, you look at our positioning data, what we see is that the long-only funds are, I would say, underweight equities. Our positioning data for systematic funds still suggests they're very short equities. I think there's a resistance at this point to really add a lot of risk at this point. And I think the reason for that is because people think that this tariffs are going to hit growth at some point in the future. And the thing that I love to watch the most is actually the data on Bloomberg, the consumer second measure data, because that is none of the survey data. This is hard data on a daily basis, and that shows that the consumers are front-loading a lot of stuff. And so I think you've got surprises to the upside on the economic data, maybe some softer inflation like we saw yesterday. That's good for equity markets, and that keeps them driving higher.
You understand the reluctance right now, though. We've had a 20% plus move on the S&P off the April low. We've got a forward multiple north of 20. Can you draw a distinction between the tactical outlook for you and the team and the medium-term risk-reward?
Completely, and the medium-term risk-reward, I think, is a lot more cautious. It really depends, you know, on our discussions of what does Trump do with tariffs here, because if tariffs are much higher permanently, that will ultimately hit profit margins, return on equity, and that big U.S. valuation premium, which they have versus the rest of the world. And one of the other interesting things that we do discuss a lot with clients is this theme of why are we putting money to work in the U.S.? Why are we not sticking it in Europe? Why are we not putting it in emerging markets? These have been much cheaper asset classes that have been outperforming this year.
Is that where clients are going?
We're definitely seeing fund flows coming out. I think there's $50 billion by our estimates out of U.S. equity markets. over the last 2 months from foreigners into international equity markets. Global fund managers are roughly 700 basis points underweight the US versus the benchmark. So people are definitely having that bearish sentiment towards US equities.
You say clients are nervous when it comes to trade and tariffs, but there's almost 3 different paths. There's China, which is a separate ball game, and then there's these 18 dozens of countries that they are in deeper negotiations with, and the rest that Trump says we're going to set the rate and send you a letter. What are clients most concerned about?
China. 100%, I think, is the big concern here. Just given at one point we had 145% tariff on China.
Trade embargo.
Completely, and there's so many other things, be it the rare earth materials. There's so many moving parts to the China deal, and it would also seem where you look at the negotiation between Xi and Trump. It's complicated. And I think that's where they think that's going to be a lot of resistance between those two leaders.
Pass-through is something we were looking for yesterday. Didn't see it in CPI. For a 4th consecutive month, of course, CPI comes in. Relative to expectations, a little bit softer. I had people sitting around the table saying, that's noise. In a few months' time, you'll see it. Other people send that signal. That shows you that companies can't pass this on to consumers. Is it signal or noise for you and the team?
I think, actually my reason why they've not passed it on is quite simple, which is that you built up a load of inventory before this, and why would you pass on this cost now when you don't know where tariffs are going to be in a few months' time? So you can increase prices and then decrease prices, then increase prices depending on what the administration said. They're waiting for clarity. And so until we get clarity, I think the impact on inflation might be muted, or until inventories drop.
So this is the risk into the summer, right?
Completely.
The prospect that we do get those hotter inflation prints.
Yeah.
What's the textbook, the playbook for that kind of backdrop into the summer?
So I think in that kind of backdrop in the summer, if you have higher inflation, higher bond yields, that's going to squeeze some of the tech sectors. I'd be more cautious on the long duration. Again, I've been a big narrative of the theme that who benefited the most from globalization? US mega caps, not China, not Europe. So if you put tariffs on and this comes back and you have higher inflation, again, the US underperforms in that scenario.
You said that basically companies are waiting for the rates to be set.
Yeah.
Is there a deadline that companies just can't wait anymore and they will have to potentially pass on those costs?
It's a really good question, and I think that's why we're tracking inventory levels so closely, because as soon as you get to that kind of 22, 23 level, or 2022 levels of inventory where you saw the big supply chain shock and inflation spiking there, that's a concern for us. Now, when might that come through? It really depends by industry, but the inventory levels that we are seeing at the moment, I would say, July, August is probably going to be a crunch point at this time.
Does this remind you the most of COVID?
It does a little bit. I mean, it does a little bit for a few reasons. A, because of the inventory aspect that we're talking about, but also B, because of the valuation argument that you were, talking about here, and this big kind of confusing aspect, which is like valuations are rich, but as a long-term investor, we're kind of like, how much long-term growth should we really be discounting at this point because of tariffs? Is it a blip, or is this something more structural at this point?
Later on this morning, we'll get some economic data, PPI at 8:30 Eastern Time, together with jobless claims. Later on this afternoon, another debt auction. The 30-year maturity is very much in focus. Jeff Gunlack caught up with Lisa yesterday. There was a quote from him, from Double Line, saying there's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. What does that kind of commentary on the bond market mean for the stock market?
I mean, so it means a lot of things. And I think one of the big questions that we've been seeing, so again, getting a bit technical, but on the equity risk premium, a lot of people are saying, well, the equity risk premium is very low, bond yields are moving higher, surely that's going to squeeze equities here. And I think there has to be a distinction between the credit quality of the government and the credit quality of these mega cap companies at this point. And so one of the things that we have been seeing because of this, bond yields, is the equity risk premium is falling, and a lot of people are looking at the US and just saying, this is screamingly expensive at this point. And I guess I don't necessarily buy into that completely, but I do think it is a concern that, there is not necessarily a natural flight to safety at this point. And one of the things that we're seeing as a result of that is that, typical market behaviors are completely dislocating, right? Where you're seeing bond yields going up, and the dollar going down, that doesn't seem like it makes much sense.
What's the flight to quality in 2025? What is it now?
I mean, it seems like gold is clearly the obvious choice where people have been going into. I mean, from an equity market perspective, I think people are looking for any kind of company with pricing power at this point. And that's another theme that we've been getting a lot. And where does that kind of, stick you into? More of the consumer staples and the consumer discretionary at this point.
Alistair Pinder of HSBC. Alistair, appreciate your time,
Thank you
sir.
very much for having me.
It's good to see you, buddy. Thank you very much. Later on this morning, I'll repeat it again, 8:30 Eastern Time. PPI, another read on inflation together with jobless claims. CPI softer yesterday. Softer than expected once again. And I think a bit of a victory lap from individuals around the White House.
Oh, yeah, and it was definitely a victory lap yesterday for the Treasury Secretary on Capitol Hill. Every time you saw a congressman or woman try to say that prices are going up, he said, did you see the CPI report today? And he didn't mention Neil Dutta, but they seem to have the same thinking. He said it's TDS, tariff derangement syndrome, that's happening right now.
We'll catch up with Neil Dutta on tariff derangement syndrome a little bit later on this program. Looking forward to that later on Bloomberg Surveillance. Let's give an update on stories elsewhere this morning with our top story out of India. Our Bloomberg Brief with Yahara Anand. Hey, Yahara.
Hi, John. Exactly. An Air India flight bound for London's Gatwick Airport has crashed. The Boeing 787 was carrying 242 passengers and crew and had departed from Ahmedabad in the western part of India. The plane reportedly went down in a residential area moments after taking off. Indian authorities have shut down the Ahmedabad airport and suspended all flights. Meanwhile, the U.S. ordered some embassy staff to leave its embassy in Baghdad due to heightened security risks. It also authorized families of members of U.S. military personnel in the Middle East to depart. Statements announcing the decisions did not cite any specific threat. CBS is reporting that U.S. officials have been told Israel is ready to launch an operation in Iran. And rallies against immigration raids that began in Los Angeles have spread to other cities, including New York, Chicago, and Milwaukee, with some clashes reported between protesters and police. California Governor Gavin Newsom used a TV address to call President Trump's use of federal powers an assault on democracy. That's your Bloomberg Brief. John?
Yahara, thanks. Thanks for the update. Of course, we'll bring you regular updates on Air India Flight 171 throughout this hour on Bloomberg TV. Up next on the program, renewing the tariff threat.
We're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall on the latest in the nation's capital and speak to Scott Lincecum of the Cato Institute on the other side of this commercial break. Live from New York City this morning, good morning.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Snapped a three-day winning streak on the S&P 500 yesterday. Losses again this morning. We're down by 0.5% on the S&P. On the Nasdaq, down by 0.4. The move yesterday faded, even with better than expected CPI, lower than expected. Some form of an agreement between the US and China, always better than the alternative. But the move did stick in the bond market. That rally continued into the close. 2-year, 10-year, 30-year yield to lower again. 30-year yields are down by 3 or 4 basis points at 488. Yesterday, $39 billion of 10-year bonds. Supply, that auction went well. Later on this afternoon, $22 billion in 30-year bonds. Look out for the auction later on this afternoon. Under surveillance this morning, renewing the tariff threat.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus. And you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
So here's the latest this morning. President Trump vowing to set unilateral tariffs ahead of a July 9th deadline. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. So, Tyler, it sounds like the deadline's not July 9th anymore at all for anyone.
Yeah, hey, John, good morning. Well, President Trump did signal a willingness to extend that deadline, though did say he doesn't think it's going to be necessary. But that sort of ran counter to the type of flexibility that the Treasury Secretary Scott Bessent was outlining yesterday on Capitol Hill. I was at his testimony in front of the House Ways and Means Committee, where he told lawmakers that he thinks it is, quote, highly likely that they will extend that July 9th deadline for those trading partners that are being prioritized in the talks, in a bid to continue what he called good faith negotiations. Now, of course, we're now within that 1 month deadline to July 9th for all of those trading partners, except for, of course, China, which is on its own separate track. And we should say the threat of escalation is definitely there. You had President Trump saying that these countries are going to have to take it or leave it once they set those tariff rates, though did add the administration's not quite ready to put out those letters just yet. And then we had Stephen Myron of the White House on Bloomberg television yesterday telling us that ultimately the understanding should be that if deals are not reached, then tariffs will snap back to those April 2nd levels, if not higher, for some trading partners such as the European Union.
Tyler, let's talk about the European Union. The president there, speaking last night, said, like I did with the EU. Did he send a letter to the EU setting a new rate we're unaware of?
It appears that he's probably talking about his heightened threat when it came to really lifting those tariffs up to 50% if they're not able to ultimately strike a deal. Now, he did say that it does appear that the EU does want to negotiate. Of course, the frustration has been running on both sides with the European Union, often saying that it's unclear what the White House really needs to see in order to get a deal done. We know there's a lot of complicating factors here, including that the EU is negotiating as a 27-member nation bloc, which only makes things more difficult as the administration pushes what appears to be some red lines for Europe, including changes to their tax systems. Now, at the end of the day, we're going to have to see how this one in particular strike evens out, because Anne-Marie, as you well know, the Commerce Secretary Howard Lutnick said yesterday that the EU is likely in the back of the line when it comes to getting a deal.
Tyler Kendall, appreciate the update. Tyler down in Washington. More from Tyler later on this morning. This is a lot of work to stand still, isn't it?
A lot of work. And with Brussels, they just do not seem like they're on top of the list of these dozens of countries that they want to strike a deal from, their biggest trading partners. This was the quote from the Commerce Secretary. Europe was more than thorny before Trump issued this ultimatum. Then, quote, all of a sudden they got a little religion and made a proper offer. I think Europe is one of the ones to watch that definitely gets extended.
Let's build on this conversation. Scott Lincecum of the Cato Institute joins us now for more. Scott, welcome to the program. We spent a bit of time over the past few days comparing and contrasting where we are now compared to where we were in the first term for President Trump. Could we just start there with you? How different this approach seems to be versus Trump Volume 1?
Yeah, I mean, it's radically different in both scope and speed. The first time around, it took us about 2.5 years to get a little less than $100 billion in tariffs. Now it took us just 4 or 5 months to get about 10 times that level, depending on how you measure it. Average tariff rate today is somewhere around 16 to 20%. Last time it got up to around 3%, right? So we're really talking about wildly different systems under which we're operating, and of course different laws. The first time around, we were operating under laws that had a little more certainty, a lot more process. This time, it's just a lot of legally dubious measures that the president is using with the snap of fingers.
What countries do you foresee getting an extension beyond July 9th?
Yeah, I think that the major trading partners, Europe, you mentioned, Japan, Korea, Canada, Mexico, throw in there to the extent they're negotiating on the fentanyl-related issues or steel and aluminum measures. It is the question, I think, really becomes some of those mid-majors, Vietnam, Malaysia, and others, that still have a lot of production and exports to the United States, but aren't maybe in that top tier.
I just got back from London. I was there for some 20-hour trade talks with China. This morning, the Chinese Commerce Ministry says that those licenses of rare earths and magnets will be accelerated. How much leverage does China now hold, given the fact that the United States has made rare earths such a pivotal part of this trade negotiation?
Yeah, I mean, it certainly seems like the balance has shifted a bit, right? And this indicates that, countries, not just China, have other levers they can pull when it comes to trade retaliation beyond simply slapping tariffs on American soybeans and other goods. Whether it is export restrictions like on rare earths, whether it is investment restrictions, services restrictions, there's a lot of things that countries can do. And I think that, maybe this has been a bit of a light bulb moment for the White House, that things can get hairier than maybe they thought.
Scott, there used to be two very separate tracks, national security issues and then economic issues. Have we blurred the line between the two with regards to China?
Not just with regards to China, quite frankly. Steel and aluminum tariffs, those are on national security grounds. The automotive tariffs are national security grounds. The administration has opened up other investigations on copper and wood products, semiconductors. So, they just basically runs the gamut these days that everything on trade to this administration is a national security threat. And that's a problem for a couple of reasons. One is it's kind of a get-out-of-jail-free card for our trade agreements because there's a big national security exception. But it also really undermines what national security really is. I mean, if everything is a national security threat, then nothing is.
Scott, just to build on that, I'd add another dimension. I think that saying it's a national security issue makes it easier to implement the tariff. I think it makes it far more complicated to take it back off. And that's what confuses me at the moment. How do you make this a part of the negotiation? Because if something is a national security issue, it should be non-negotiable.
Yeah, that's a great point because, tariffs are always difficult to remove because they build up domestic constituencies that are protected by them, that benefit from them. But then when you throw in the national security card, it does, like you said, add an additional element to all of this. It also, to the extent you are, like you said, removing them, it undermines your credibility for the other national security related measures, right? So if you negotiate on steel and aluminum, then what about autos and semiconductors? So I agree with you that I think it makes talks and it makes reform even harder than it already was.
The Treasury Secretary says there's no quid pro quo when it comes to trade deals, but speaking to me outside of those trade negotiations, Howard Lutnick was talking about the fact that if they see more rare earths, potentially there'll be an easing of export controls. To Jonathan's point, isn't that basically saying that national security issues are on the table as a bargaining chip that China can use?
When it comes to things that the United States manufacturing sector, our defense sector need, I think that's an obvious yes. But, on the export control side, it also indicates a huge contradiction in a lot of what the administration's doing right now. On the one hand, they're saying we don't need imports. We're going to slap 55% tariffs on a lot of stuff from China to build up our manufacturing sector. But on the other hand, they're saying, no, we need Chinese imports in the form of rare earths. So don't you dare restrict those imports. It really muddles the message.
What do you think the U.S. red line is when it comes to the easing of export controls? What will they not touch?
I think it clearly will not touch any of the highest end technology, semiconductor-related, supercomputer, AI-related technologies. Those things, there's a really broad bipartisan consensus in Washington that those things need to be locked down. I think it's going to be that middle dual-use technology where there's going to be a big gray area and a lot more negotiation.
Hey, Scott, appreciate the update from you, sir. We'll catch up again soon. Scott Lincecum there of the Cato Institute on the latest with trade. It just feels like Europe is going to take a whole lot longer. We haven't really even started to engage on the really thorny topics with regards to the European Union.
It's going to be incredibly challenging when it comes to Europe, and they already have a whole host of measures that they're willing to put into action if the U.S. continues with these higher tariffs. So we can get for a full tit for tat when it comes to Brussels that we haven't even seen yet, and they seem to be at the bottom of the list. This is going to be incredibly challenging for Brussels and Washington to negotiate.
Never mind July 9th. When's this going to wrap up? Months, years?
Depends what country, honestly. And if you look at China, if you want a grand bargain deal, when we're just talking about rare earths and export measures, export controls, what happens when we want to start talking about other issues when it comes to China, their economy, or a purchasing agreement? Should Beijing actually finally go back to the phase 1 purchasing agreement that they never lived up to during Trump 1.0? That is going to take months and years.
That's China. Speaking of Europe, euro dollar pushing 116 this morning, 115.80 around about now. That's the highest going back to November 2021. Positive on the session by 0.8%, a much stronger euro for a 4th consecutive session. That's the FX market in crude in the last 24 hours. A rally for Brent and WTI. Up next, Norman Rule of CSIS as the US pulls some embassy staff from the Middle East. Live from New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Secondly, the S&P, if the Congresswoman would care to check Bloomberg, the stock market, as judged by the S&P, which is the most widely held index by American 401ks, is up on the year. Up.
The Treasury Secretary on form just yesterday. We can check the Bloomberg. We are up on the year by 2.4% on the S&P 500. Endorsing the Bloomberg, endorsing the S&P 500.
Yeah, and he was saying, I don't actually know if there's a terminal, though, in Congress. That is something I have yet to find, besides our, our congressional reporters who have those
definitely a
terminals
terminal in the West Wing. They need one in Congress, let's put it that way. Certain Congress people maybe need it more than others. Other people seem to perform very well in the equity market without one, which is curious, isn't it? Yeah, that's maybe another story. Equity futures on the S&P 500, negative by 0.5%. On the Nasdaq 100, we're down by 0.5%. Also on the Russell, just a little bit softer, negative by 0.8%. Later on this morning, a few hours away, jobless claims and another read on inflation. You'll get PPI data, all of that just around the corner. Let's get you some morning movers. 3 hours away from the cash open. Here's Yahira Anand. Hey, Yahira.
Hi, John. We start with Boeing. Shares are lower by 7%. Now, I will say it is very difficult to talk about stock moves after such tragic news. But here's what we know about this crash. Local media is reporting that the crash involved a 787 Boeing Dreamliner. This was an Air India flight, and the plane crashed shortly after taking off from Ahmedabad, and it was en route to London. I will note the 787 has no prior fatal crash history, but we all know the scrutiny that Boeing has faced over production and safety issues. Moving on, we have Oracle shares. Those are up more than 7.5% now, fueled by a bold forecast. The company expects cloud infrastructure to surge over 70% this year. Sales, this comes as it becomes a major player in the business of renting out computing power and storage to AI-focused companies like Meta and OpenAI. And it says the momentum will carry on to next year. The CEO says next year's growth will be even stronger. And we end with Voyager Technologies. It is up another near 3% here after the space company soared 82% yesterday in its Wall Street debut. The defense and space contractor is behind Starlab, which, interestingly, this is a commercial space station set to replace the ISS by 2030. The company is also seen as well-positioned to tap into President Trump's proposed Golden Dome missile defense system. John?
Yahira, thank you. More from Yahira a little bit later this hour. On our radar this morning, one of our top stories, President Donald Trump threatening to set unilateral tariffs in the next 2 weeks. This ahead of a July 9th deadline to reimpose higher levies on dozens of countries.
I think it's important to take a step back and look at where we started and where we are. The tariff rates were set by this administration on Liberation Day on April 2nd. And now Trump is saying, we're just going to send you letters and set new rates. New rates juxtaposed by the ones they already sent months ago. So basically that is, I think, an implication that this White House is basically saying, we didn't like the rates we set and we're going to set brand new rates. But that's for all the countries that they're not in these deep negotiations with, about 12 to 18 countries where they're actually having these trade talks to potentially have broader deals.
And this was always a tight deadline. When you think about how much they had to do by July 9th, let's talk about how much they have done already. A form of a deal with the UK, and we don't have time to get into the detail around that, but let's set the UK to one side. Some kind of a truce with China, and that's about it at this point. That really is about it.
We still have to wait for Japan, for South Korea, for Switzerland, which I've been speaking to their trade rep. They said that potentially this is going to drag on past July 9th. What I find interesting as well is some of the tea leaves you're seeing in local reports. The Nikkei last week reported that in the middle of a trade negotiation with the Japanese officials, Jamison Greer, Scott Bessent, and Howard Lutnick all got into an argument amongst themselves. So how is the U.S. even approaching this? Are they all united on what they want to get out of these talks?
Speaking of Scott Bessent, the Treasury Secretary, he returns to Capitol Hill today for day 2 of his testimony. Yesterday, he struck an optimistic tone on U.S. trade negotiations, saying it's, quote, highly likely the tariff deadline will slide for countries already in talks. Does that include Europe?
That does include Europe. Although the Commerce Secretary Howard Lutnick says basically they're going to be the last on the list to get a deal done. He did say Trump sent them an ultimatum, and then they, quote, found religion and came back with a more appropriate offer. So the European Union is one of our biggest trading partners. Of course the United States is going to strike a trade deal. But you mentioned it earlier. It's going to be so hard for the non-trading barriers, the non-tariff barriers, like the digital services tax that irks Americans and irks American tech companies. These kind of discussions are going to be very challenging.
That's the latest on the trade story. Let's get back to that developing story this morning. A Boeing 787 crashing in India. The Air India flight was carrying 242 passengers and crew to London. Bloomberg's Sid Phillip joins us now with the latest. Sid, welcome to the program, sir. Let's just start with the basics. What do we know so far?
Morning, John. So at the moment, we know that an Air India 787 Dreamliner on its way from Ahmedabad in India to London crashed shortly after takeoff. We still don't know the reasons for that crash. We still don't know the details on what really went wrong, and we will find that out as the days and weeks go by. But in the short term, I mean, we do know that there was a mayday call that, according to the DGCA, which is the Indian Aviation Authority. We do know that the pilot and the co-pilot were very experienced, and we are still waiting on. I mean, this is the first fatal 787 crash ever, and so this aircraft is a very technologically advanced aircraft. Air India is in the midst of a turnaround at the moment. They are they're freshly owned by Tata Group after being owned for years by the Indian government. And the Tata Group famously at the last Paris Air Show announced orders for over 500 brand new Boeing and Airbus planes. And so they're in the midst of this turnaround, and this is a massive blow to the airline. And everyone will be looking to see what really went wrong and how this incident occurred.
Sid, before we get into the companies involved, let's try and piece together what precisely was happening when this plane crashed. As we understand, according to Flight Radar 24, it had only reached an altitude of 625 feet. Was this shortly after takeoff, immediately after takeoff?
Yeah, this is minutes after taking off. So, I mean, the aircraft was 625 feet in the air before it crashed, and so it just crashed outside the airport after, just off the runway and into a busy residential area. And so we still don't know what the impact on the ground is. We understand that it crashed into a residential building, so we don't know if there were any fatalities on the ground as well. So the death toll, if any, may go up even further. So we still don't know in terms of what the impact, both in terms of the casualties on the plane as well as the casualties on the ground.
I said it's going to take time to find that out, and as we get news, we're going to bring it to our audience. I just want to talk about the companies briefly. You mentioned the turnaround effort at Air India, also Boeing as well. Could you briefly discuss what's happening at both of those companies at this very time?
Yes, so as I mentioned, Air India is in the midst of a turnaround effort under private ownership. Boeing, on the other hand, has been under scrutiny for years following the fatal MAX crashes. That's a different model, the 737 MAX, in 2018 and 19, and that aircraft was grounded. We also had the scrutiny on Boeing after the Alaska incident last year when a door fell off the plane, and Boeing sort of been under lots of regulatory scrutiny, and this definitely will add to the pressure on Boeing. I mean, we still don't know what went wrong. We still don't know what the cause of the incident was, but this will add to regulatory pressure on Boeing, and it will sort of add a further question mark on Boeing, and we will wait to see what the company says. The company says it is cooperating with the investigation, and they are in the midst of sort of trying to ascertain what really went wrong.
Sid, thank you, sir. Hopefully we'll catch up with you a little bit later this morning as we get more details. Sid Phillip there, Bloomberg's very own on the latest. We'll be tracking the latest for you of flight Air India 171. The plane, Sid was saying earlier on this morning, only 12 years old.
Only 12 years old. This is absolutely tragic, and it happened almost immediately after takeoff, and that is why you see these devastating photos that is hit into a residential official building. We did hear from India's Minister of Civil Aviation. He says shocked, devastated to learn about this flight crash. They are on the highest alert, trying to mobilize all the rescue teams.
Tragic pictures. Any more details, we'll bring them to you. Just to turn back to the markets, let's talk about crude. Giving back some of the gains today after spiking on reports of rising tensions in the Middle East. The US ordering some of its embassy staff in Baghdad to leave the region due to heightened security risks. Joining us now is the former senior US intelligence official, Norman Rule. Norman, welcome to the program, sir. We always enjoy leaning on your expertise in a time like this. Could you just frame for us whether this is the real deal, something to be concerned about, or just one of those things that we typically see every few months out of this region?
Good morning. Well, it's something to be concerned about. What we're watching are three issues that are coming together after months of work. The lack of progress in the Iran talks, the dangerous expansion of Iran's nuclear program, and right now the IAEA Board of Governors finding that Iran is in non-compliance with its nuclear safeguard obligations under the Non-Proliferation Treaty. The Trump administration is committed to diplomacy, but it shows every sign of willing to use military force to prevent Iran from acquiring a nuclear weapon. And the actions taken over the last 24 hours are meant to signal Iran that that intent is indeed sincere without raising the temperature in the region significantly.
Norman, what does it say to you that the IAEA Board of Governors is saying Iran is non-compliant of its obligation? What does this mean? Does it mean we're going to see more countries take more action and sanctions on Tehran?
Well, first, the issues that the IAEA has worked on in the last few weeks are longstanding, in some cases for many years. But diplomacy has very slow wheels, and people put a lot of effort into trying to avoid this step. Indeed, this censure of Iran is the first time something like this has been done in 20 years. This will require now that the IAEA push this towards the UN Security Council for what is known as snapback to, in essence, restore all UN Security Council sanctions on Iran, probably in September. They have until October, but since Russia takes over the UN Security Council, in October, that's unlikely to happen. What we're seeing is that Europe is seeing that diplomacy is coming to its end. There are no other options here, and they are agreeing with the United States that the more severe pressure needs to be placed on Iran. And again, Iran's nuclear program is reaching a very advanced stage. Most of its enrichment capacity is now being devoted to military, which is not nuclear weapons, but still military-grade enrichment, for which it has no actual purpose.
Well, Norm, maybe an even further breach of IAEA obligations. What we're hearing today is that Iran says they're going to establish a new uranium enrichment center in response to this decision. At the same time, the Omani foreign minister confirmed that the 6th round of talks between Iran and the United States is still set to go on Sunday. How is there a path for diplomacy if Tehran is continuing to enrich uranium and announcing new centers?
It's a great point. I think you're seeing several things here. First, I think whatever Iran announces, it planned to do in any case. It's just using the IAEA Board of Governors resolution as an excuse. It's likely going to expand its scale of nuclear enrichment, as I say, to continue its program in this dangerous direction. We should be most concerned if it further restricts IAEA access to its program, which it has been doing for a number of years. That would be most concerning. Iran, however, has all the reason in the world to continue talks, to drag out this process, and that is what has been of greatest concern to the Trump administration and others, because, again, there has been no substantial progress in the talks. Iran refuses to halt domestic enrichment, to close any facilities, and to halt advanced research and development. And unless you have significant constraints on those activities, besides temporary constraints, you really do have a program that at any moment can be turned into a nuclear weapons program.
Norm, what kind of attack would it look like, given the fact that we do have reports that Israel's ready to launch an operation into Iran?
Well, to be clear, there is no evidence that we're facing an imminent attack by the United States or Israel on Iran, although such a likelihood is increasingly likely and will grow more likely as Iran refuses to cooperate. Such an attack would have a number of different elements to it. It is certainly unlikely to take place in a single strike. Iran knows this. Iran has almost certainly been preparing to live through such an attack and to respond with its own ballistic missiles and other tools against Israel. It will be a prolonged event, both diplomatically as well as militarily. But again, the United States has more than sufficient capacity to overwhelm anything Iran may seek to use to defend itself.
Hey, Norm, thanks for your time today. No doubt we'll catch up again soon. Norman Rule there of CSIS. Yesterday, crude rallying off the back of some of these reports. This morning, pulling back by 1.4%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. An Air India flight carrying 242 passengers and crew crashed shortly after taking off from the Ahmedabad airport. The Boeing 787 bound for London's Gatwick Airport reportedly went down in a residential area. The airline said 169 Indian nationals and 53 British nationals were on board. Meanwhile, President Trump plans to send letters to trading partners within the next 2 weeks to set unilateral tariff rates. The move comes ahead of a July 9th deadline to reimpose higher duties on dozens of countries once the current 90-day pause expires. And U.S. Health and Human Services Secretary RFK Jr. named 8 new vaccine policy advisors to replace the panel that he abruptly dismissed earlier this week. They include several vocal vaccine critics and one who identifies as a, quote, anti-vaxxer. The move comes as Kennedy makes major changes to how immunizations are studied and administered in the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, the U.S. exceeding expectations.
There's no inflation. People are happy. People are wealthy. The country is getting back to strength again. That's what I care about.
Up next, we'll get one more opinion. Francis Donald of RBC, live from New York. You're watching Bloomberg TV.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures this morning, a good morning to you, negative by 0.4%, adding to yesterday's losses. We're down by about a third of 1% on the Nasdaq 100. Under surveillance this morning, the US exceeding expectations.
The economic numbers are setting records. We took $88 billion in tariffs in 2 months, far beyond what anybody expected. There's no inflation. People are happy. People are wealthy. The country is getting back to strength again. That's what I care about.
It's the latest this morning. Investors looking ahead to PPI out in just under 2 hours' time after CPI rose less than expected for a fourth consecutive month. The team over at RBC writing, while this may have temporarily calmed markets, households are still grappling with the after effects of significant inflation over the past 5 years. Francis Donald of RBC joins us now for more. Francis, good morning to you.
Good morning.
Spoke to a lot of people yesterday, and they all said a very similar thing. We're going to see the pass-through today. We're going to see it today. Then we didn't see it, and they said we're going to see it next month and the month after. Your team's taken a different approach to all of this. Just walk us through it.
It's going to be a couple more months, and there's a range of reasons why, and one of them is you might remember this massive inventory build that we saw in the past few months. That means there's plenty of inventories that did not get hit with those tariffs yet, and that's going to take some time. We've got to see that inventory depletion. We saw this in 2018 with washing machines, 3 to 5 months before we saw it show up in the data, so there is some precedent there. We also don't know how many of these tariffs are going to come through in CPI versus PPI, so it's going to be a couple more months before we see this. And I think that's the reason why, while I'm happy to see that inflation is not accelerating right now, 2 things. One, it's a bit early. And second, inflation is not just a tariff story. Inflation is actually also a story with respect to a tight labor market. We have a very strong, ultra-wealthy consumer. We have big government. So there's structural forces under inflation as well. And actually, while tariffs are important, they're not the most important story with inflation.
Credit to you and the team for the approach you've taken so far. Let's sit on the labor market, I think, and agree with you that it's ultimately very important for the pass-through and whether we can stomach it as consumers. This is something we discussed over the last several weeks. Is the labor market tight enough for individuals to demand higher wages to fund higher prices?
So in my view, Americans don't need to worry about losing their jobs this year, but they do need to worry about their grocery bill. And in this particular case, we have to segment which consumer is doing what. Because if you're a low and middle income household right now, yeah, you probably have a job, but rent, food prices, those are up almost 30% in the past 5 years. And even though on aggregate, we've seen wages rise more than the inflation over the past few years, that's not true for low and middle income Americans whose inflation basket is tilted towards those areas that have seen larger inflation. So we can't paint the same brush with inflation or wages to the entire consumer household. Now, if you're trying to get a sense of what a retail sale is going to do, if you're forecasting GDP, you pretty much are focusing disproportionately on that high income household, and they're going to be just fine in this environment. But forecasting GDP and saying what's best for the American economy and American people is a very different thing.
When you're talking about underlying inflation, you're saying tariffs aren't the biggest story. What is it? Is it the labor market or is it big government?
Well, there's structural forces, and it's both these things. So when we talk about the labor market, we're not talking about, oh, there's so much cyclical demand here, the economy is booming. We're talking a lot about demographics, and we think of demographics as being a 10-year horizon story, but the demographic crisis is accelerating every single month. We see more retirees than we did the week before, the month before. That's creating huge exits out of this labor market, and there's not enough replacement demand. So that unemployment rate, even though we believe the economy will soften this year, we have it peaking around 4.5, 4.6%. I mean, I'm old enough to remember when that was an extraordinarily strong labor market. That's going to be our bar for a weaker labor market right now. We can't use the unemployment rate anymore as a cyclical indicator of growth. We have to turn towards other areas.
You're talking about retirees. What about Trump's immigration policy? What's that doing to the labor market?
Well, that's going to amplify the issues. I remember being here at the end of 2025 and saying, yeah, tariffs are going to be a big deal, but keep your eye on the immigration story. In our view, how much available labor is actually going to be the big issue in 2026 and 2027. We've said it before, America doesn't need jobs, America needs workers. And if you want to see a boom economy, you got to have people not just who are willing to do those jobs, but actually in the labor force. Sometimes we get pushed back and they say, oh, well, the labor force is, there's been a decline since 2001. The labor force participation rate is around 63%, but prime age worker labor force participation rate in the United States, 18 to 54, is near its highest ever. So there's not a lot of folks sitting on the sidelines right now who are of that age, and this is having impact on month-to-month data now. A structural trend that's showing up in the cyclical data is something we need to monitor.
It's going to take time to figure out, and we need to be open-minded about potential outcomes, because I've been surprised so many different ways since the pandemic with regards to the economy. How much flexibility does the Federal Reserve have with that in mind?
Well, not enough. And so the key is just going to be what side of the mandate are they focusing on? And also, how are they being flexible with respect to how the data is changing in this environment? CPI is one indication of what's happening with inflation, but we're going to see a dashboard of inflation that's going to see problems in some area of prices and other areas where it's going to be okay. So this isn't just a divergent economy in terms of growth, in terms of consumers. It's also going to be a divergent economy with respect to prices. That's going to complicate the Fed's job.
You've heard of Trump derangement syndrome. Neil Dutta of Renmark has coined a new term that the Treasury Secretary used yesterday, tariff derangement syndrome. Does the Federal Reserve have TDS?
Okay, well, we don't know what the policy is going to be, and we don't actually know exactly how it's going to impact the economy. So we have two sources of uncertainty in play, and that's why I say, yes, tariffs are hugely important. When we look at our inflation forecast, it can be as much as 0.5 percentage point on headline CPI, which could be make or break for the Fed. But the time right now is to focus on what are these underlying trends that are happening. This K-shape that's involved in the economy, massive government spending, which in our view is muting the economic cycle in play. We got to talk about that labor market and how things are changing. And we have to talk about some of these other issues, like a very extended troubled electrical grid that is limiting the ability to move forward. These are things that exist with or without trade and tariffs. And I can come up with a whole economic view on which the tariff is sort of the whipped cream on top of the ice cream, but not actually the core meal, even if right now it's the area where we have the most volatility.
Sometimes I'll take that as the core meal. Francis Donald of RBC. In the summer on vacation, just have ice cream for dinner, no?
Yeah, well,
Just
actually,
me?
in Italy, what I do is I have gelato first, and then I follow it up
And
2
then go
layers
out
with
for,
dinner.
for
Yeah,
pasta?
of
Yeah,
course.
why not? Okay, Francis, appreciate your time.
Thanks,
We'll talk more about that another time, I'm sure. Or maybe not. Up next on the programme, we'll catch up with Sarah Hunt of Alpine Saxon Woods. Bloomberg's Tyler Kenner will join us too. Adam Posen of the Peterson Institute will be joining the programme. And then Richard Clarida of PIMCO. Lots to talk about with the former Fed Vice Chair, not just on the economy, but also on PIMCO's new outlook and why maybe the 30-year bond is going to be a bit of a problem for the foreseeable future.
That's what everyone on this program has said. They want to stay away from it. It's a risk asset. And what did we hear from Gunlock yesterday talking to Lisa? Fantastic interview. He said a reckoning is coming when it comes to the United States of America.
Let's see if that comes later on this afternoon. $22 billion of 30-year bonds being auctioned off by the Treasury. The second hour of Bloomberg Surveillance. Up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I am never doing that again.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Outperformance of U.S. equity markets has been very, very clear.
I think the biggest risk for the market is going to probably be either rates or we do go into earnings season. It's not as good as people were hoping for.
The rally has been sentiment driven.
The market is going to need good news to continue moving higher, and it may be mixed.
A dollar not gained is just as bad, if not worse, than a dollar lost. And I think you're going to see that reality settle in.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores are shaping up as follows. On the S&P 500, pulling back once again. Back-to-back losses on the cards here for the first time so far this month. Snapping a 3-day winning streak in yesterday's session. We pulled back another, let's call it 0.5% on the S&P, down about 1/3 on the Nasdaq 100. Some better news in the bond market over the past 2 days. 1-2 punch in a good way for the 10-year yesterday. Lower than expected CPI, better auction, yields down another 4 basis points this morning on 10s to 437.69. Later on today, the 30-year will be in focus, a 30-year auction this afternoon. Look out for that supply at 1 p.m. Eastern time. Before we get there in 90 minutes time, we've got some data, PPI and jobless claims, and the data so far this week has been okay.
It has been okay, especially when it comes to CPI. Yesterday, another month, and yet again, CPI came in less than was forecast. Not this sticky CPI, but Frances Donlan put it very, very well. They don't expect it to hit the data just yet. This is going to take months. And she says it's not just about tariffs. Kind of what Neil Dutta said, tariff derangement syndrome. And then the Treasury Secretary also said that yesterday on Capitol Hill. There are structural issues happening and also what's going on in the labor market.
Got to talk about what's going on in the bond market as well. Lisa's on her way back from California. Fantastic exchange with Jeff Gundlach of Double Line yesterday. Check it out if you haven't already. I'll just share a quick quote with you. There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. Something to think about going into an auction of 30-year debt later on this afternoon.
$22 billion up for sale at 1 p.m. And Lisa's not here, so I will basically be, that existential threat on what's going on with the U.S. deficit in the bond market. It's pretty incredible to hear someone say it is no longer a legitimate flight to quality asset. Where else do you go then in this market? Jeffrey Gunlock also telling Lisa a, quote, reckoning is coming. That's a concern right now, Jonathan, when we still have uncertainty when it comes to trade and tariffs in Washington, D.C., and also what's going on with the one big beautiful bill and how much it actually will add to the deficit.
No big concern this morning, at least. We're down 4 to 5 basis points at the long end of the curve on 10s and 30s. In the commodity market, you saw a big rally yesterday in crude, WTI and on Brent, pulling back just a little bit so far this morning. We're down by 1.6%. A lot of news on the Middle East, so let me share 3 points with you. One, that U.S. staff are pulling some of their embassy staff from the embassy in Baghdad. That's 1 point. This came from CBS News. The U.S. told Israel is preparing an operation in Iran. That's something to consider. And then you factor in what the president said to the New York Post in the last couple of days as well, that he's losing confidence in closing a deal with the Iranians.
He's getting more and more less confident about a diplomatic resolution, though diplomacy is still on the table. The Omani foreign minister came out today and said that there will be another round of negotiations between the U.S. and Iran happening on Sunday. Also, what's happening on the diplomacy front, the IAEA Board of Governors saying that Iran is non-compliant. Potentially, there's going to be more sanctions. There's a lot going on the surface when it comes to the Middle East. And I think in this time, especially when you have oil having this geopolitical risk premium, it's important to just know what the facts are on the ground right now.
A number of market stories to track throughout this morning. Brent crude at the moment trading at 68.62, WTI at 67 flat. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as a risk-off mood returns to markets. We'll speak to Adam Posen of the Peterson Institute on President Trump's latest tariff threat. And we'll speak to the former Fed Vice Chair, Richard Clarida, as investors worry about a reckoning for U.S. debt. We begin this hour with stocks lower. After snapping a 3-day winning streak, Sarah Hunt of Alpine Saxon Woods writing the following: there are still potential storm clouds on the horizon. The dizzying movement of both tariff levels and timing make it tough to pass what has actually been affected versus what will be affected. And us Wall Street types are always looking for immediate gratification. Sarah joins us now for more. Sarah, good morning. Good to see you.
Good morning. Good to see you too.
Yeah, 8:30 yesterday was kind of that story. We were sitting there waiting for the pass-through. It didn't come. And then we sat there and said, that's just noise. It's not signal. You'll see it next month. Was it noise or signal?
So I think that this sort of goes back to the original, when the Fed started hiking rates and everyone was like long and variable lags, we're going to see this, we're going to see this. And we never saw the sort of crack in credit that people were afraid of. We didn't see some of the effects of higher interest rates the way we thought we would. I don't know right now with the tariffs. I think there's a good argument to be made that there was a lot of inventory build, and that inventory came at a price point that's different than inventory can be brought in right now. And I think that that's the question that we don't know, how much pull forward there has been. That's the catch-up that people are looking for, either positively or negatively, going into the second half. And I think that's going to determine a lot of the sentiment around what's going on in the equity market.
That makes it a timing issue, which makes the longs in this equity market vulnerable as we work our way through the summer. Do you think it is just a timing issue?
So the flip side, and the other argument, because economists always like to have both sides of the fence here, is that it's not going to come through as strongly as people thought, that earnings are still doing very well, that the tech side is pulling on earnings up even if the stocks haven't done as well as some of the other sectors. And that was the big risk, is that earnings were far too high going into this year, and now the revisions are starting to be more positive, and that's positive. Even though they had come down, they're going back up again. So I think that that's the tension that we get through the second half of the year, and how the data plays out is really going to tweak that story to those narrative flips that we see all the time.
How the data plays out, who's going to be eating the tariff rate?
That is the biggest question, and what is it actually going to be? And since we don't know the answer to that, it's going to be, this is, it comes down to margins again, which was the story at the beginning of the whole tariff argument, which was U.S. corporate margins are among the highest that they've ever been, and can they survive a continued push at the cost side? And we don't really know the answer to that. I would say that on the high end, you do see spending still going on. It's on the lower end where you have more trouble in those markets. So I don't think we know the answer yet, but I think it's actually going to end up being more shared than people think it will be.
When you're looking to protect margins at a company, is it that you don't want to increase prices and then potentially you lay off people? How do you foresee companies dealing with this if the tariff impact is going to happen?
It's that dance between my revenue side and my cost side, right? So I'm going to do as much as I can on the cost side, and if I can goose that revenue side a little bit, I will. And if I feel that other companies have to do the same thing because their input prices are going higher too, that gives cover for a whole group of industries in a sector to go, we all have higher input prices. So we all have to raise our actual prices. We'll see how that goes. We'll see what the willingness is both on the corporate spend side for CapEx and on the individual side.
There's a major bond market dimension to today's conversation in the market. A little bit later on this afternoon, 30-year debt coming to market. Today, better, yielded down by 4-5 basis points. Talked about Lisa's conversation with Jeff Gundlach yesterday. I'm not sure if you saw it or not, but the reckoning he's expecting to come in the debt market. What is a reckoning in the US debt market? What does that even look like?
I would think a reckoning in the debt market. I mean, there's two ways this can go, right? It can either be that the long end of the market starts rising because of either fear or because growth is better. So there's two outcomes there. Or the Treasury or the Fed starts doing something that's more along the lines of either a stealth QE or something else to bring that long end down. So I don't know which way that's going to go, but I think what it's speaking to is how volatile it is and how, as a non-risky asset, the 30-year should be as volatile as the bond market has been.
Do you think it complicates monetary policy, given what happened last time they reduced interest rates? And what we saw at the back end of last year was a reduction of 100 basis points on Fed funds, and the long end sold off. Now, there's a question as to whether they contributed to that. Some people think they did. Do you think it does complicate monetary policy?
I think it does, because one of the biggest questions is how much interest am I going to be spending, right? This is the big argument that we spent 10 years at zero interest rates, loaded on a bunch of debt, and now all of a sudden those costs are coming to creep up, and they're coming to bite us, really. So that really, the long end is a big part of that, because one could have argued that terming out more debt when rates were extra low might have been a better choice, because then you had more paper that was having lower interest rates. So I think that right now that's the reckoning that we're talking about, is what that spend is going to cost the government as well.
So Jeff Gundlach also said to Lisa, when he's saying it's not a legitimate fight to safety, he's talking about how gold potentially is. Costco's even selling gold retail and they can't keep it in stock. Where do you go at this moment?
Well, I think that it's made the Treasury market, especially the long end of the Treasury market, far more volatile. I think that that rush into gold is one of those things that is a relative game against other currencies, because there's more of a fixed aspect to gold, because there's less of it that's easy to create. I think you're still looking for growth, as opposed to I have to worry about this particular decision on this particular day. I really want to see where I've got cash flow and growth, and that just remains the place to go for quote-unquote safety in a market that's very volatile.
Do you think this market is vulnerable as we work our way through the summer?
I think it is, because I think if some of these negatives play out, it's very vulnerable. But if they don't seem to play out, it does seem like the bias is higher, right? I mean,
what is the pain trade right now? I've heard from so many people on the South Side that the pain trade is the stock market moving higher. Yet at some point when you hear it so many times, it just starts to sound like it's consensus. And consensus isn't a pain trade, is it?
I think that the pain trade was higher from the lows that people were afraid of. From here, would it be painful if it went higher? To some people, sure. But I think it's more that you've flipped that risk-reward scenario. So now you really have to be careful of the things that the market is afraid about. Because at 6,000 on the S&P versus 5,500 or 5,000, that risk is much lower. So even though the market seems to want to grind higher on the basis of reasonably good numbers, the vulnerability, I think, creeps the higher you get.
Sarah Hunt of Alpine Saxon Woods is going to be sticking with us. Equity futures so far negative just at 0.5% on the S&P. Later on this morning, 8:30 Eastern Time. US PPI following a softer than expected CPI read just yesterday, together with jobless claims as well. Two data points to watch a little bit later on this morning. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. An Air India flight bound for London's Gatwick Airport has crashed. The Boeing 787 was carrying 242 passengers and crew and had departed from Ahmedabad in the western part of India. The plane reportedly went down in a residential area moments after taking off. The airline said 169 Indian nationals and 53 British nationals were on board. Meanwhile, Japan's prime minister sees a large gap between the U.S. and Japanese stances on trade talks. Shigeru Ishiba is expected to meet President Trump on the sidelines of the G7 meeting in Canada starting Sunday. Japan is facing increased tariffs on July 9th if the deal is not reached in time. And a check on Oracle shares. Those are rising nearly 8% in the pre-market. The company reported fourth quarter results that beat analyst estimates and projected its cloud infrastructure sales will expand more than 70% this fiscal year. That's your Bloomberg Brief. John?
Yahara, thank you. Some market moves just to monitor. Euro-dollar through 116 now. Levels we haven't seen in a few years. A 1 percentage point move in today's session. That's a weaker dollar, a stronger euro. That's one to watch in the FX market. Up next on the program, facing down tariff risk.
We're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
Up next on the programme, we'll catch up with Bloomberg's Tyler Kendall in just a moment. Look out for that in a couple of minutes' time. In the meantime, let's turn now to the Founders Forum just outside of London. Stephanie Flanders speaking with Bloomberg Editor-in-Chief John Micklethwaite and the ARK Investment CEO, Cathie Wood.
To crypto or digital assets regulation, which we didn't have and we still don't have. It's still making it through the legislature. So I thought that was a very interesting and important step in this world, which is going to transform the financial system. So that's good. And I also do believe that half of the solution is understanding the problem. And as I go around Europe, which I think regulation is a problem there. Regulation is a problem.
Just to come back on that,
yes.
People like Stephanie and me, this is much younger, have been wandering around seeing European prime ministers for 20 years. If you drew up a list of the problems, over regulation, no integration, they've understood the problem for years.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Live from New York City this morning. Good morning to you all. Your scores look like this morning. Equities down by 0.5% on the S&P. Similar move on the Nasdaq. Underperformance on the Russell. We're down by 1 full percentage point. Adding to the losses from yesterday, even with a softer than expected read on core inflation. Plus, in the afternoon, a much better than expected debt auction relative to some of the doom and gloom out there too. In the bond market, the rally in fixed income continues. Yields are down by 5 basis points on 10s. Now we're down to 437.30. Yesterday, at this time yesterday morning, we were threatening 450. At the long end of the curve, we were having another look at 5%. Now we're down another 5 basis points to 486.64 as we wait for that $22 billion in 30-year bonds a little bit later on this afternoon. On the data front, PPI and jobless claims coming at 8:30 Eastern Time. And the surveillance this morning facing down tariff risk.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
Here's the latest this morning. President Donald Trump planning to send letters to trade partners ahead of his July 9th tariff deadline, setting the terms for higher duties on dozens of countries. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, when we think about those dozens of countries, which countries right now are maybe not in the best of spots with regards to conversations with this administration?
Yeah, hey, John. Well, we're learning that the administration still has quite a bit of frustration when it comes to negotiating with the European Union. We heard from the Commerce Secretary, Howard Lutnick, yesterday suggesting that they're likely going to be in the back of the line when it comes to clinching some of these trade deals going forward, which perhaps means that they could get an extension as the administration weighs pushing back that July 9th deadline. I was on Capitol Hill yesterday when the Treasury Secretary, Scott Bessent, said that it is highly likely that those trade partners that have been given priority in these talks would see a pushed back deadline in a bid to try to advance what he called good faith negotiations. It does appear that the White House is a little bit happier with the European Union, with President Trump saying yesterday that he understands that they do want to make a deal. We should also point out that when we are talking about these trade frameworks and agreements that we are looking for, even the one that we have already gotten, the United Kingdom, there are still big questions about how that ultimately is going to be implemented. We know that Keir Starmer is aiming to try to get some of those details wrapped up by as soon as next week. But John, there's still big questions here, including when it comes to the sector-specific tariffs that are part of that deal, not supposed to have originally been part of the so-called reciprocal tariff plan. But the UK is lobbying for steel tariffs to go down to zero, considered to be one of the biggest components of that agreement.
Speaking on Capitol Hill yesterday, the Treasury Secretary talked about China, and he said we're in the midst of constructing the deal, and it'll be a much longer process. How long can this take between Washington and Beijing?
Well, Anne-Marie, as you well know, a broader deal with Beijing could take months, if not over a year. We know that last time when the so-called Phase 1 trade deal was reached, it ultimately took them 18 months to finalize those negotiations. And that's because this round of talks in in London, was really to get back to that agreement in Geneva, to try to get over those differences when it comes to those export controls, but not talk about all those other critical parts that need to go into a longer-term trade deal. We've previously heard the Treasury Secretary say that Phase 1 deal could be used as a template, as he said, when it comes to purchase agreements around agriculture. But you also have to keep in mind this is going to be very broad-ranging. We know the administration has fentanyl concerns. For example, 20% of the tariff currently in place is linked to concerns over that. It's going to take a lot more time to iron out these details.
Of course, the other policy uncertainty is what's going on with the One Big Beautiful Bill. I believe on Capitol Hill yesterday, the Treasury Secretary was trying to mint it to call it the OBBB. Tyler, what did he have to say about it? Did he give any indication that he thinks that this can hit the timeline of July 4th?
Well, he's certainly ramping up the pressure on lawmakers, and perhaps yesterday he was met with a more welcome audience when it was in front of the House Ways and Means Committee chaired by Jason Smith, the lead tax writer in the House. Today he's going to be in front of Senate Finance Democrats and Republicans, but this is the committee that's really leading the way right now to get the Senate bill over to the House version. And we know that there are some key disagreements between the White House and the Senate as they try to get this over the finish line. That includes changes to no taxes on tips or overtime pay. We know that Senate Republicans would like to see some eligibility requirements put into place then. They've also raised some questions about other provisions, including Section 899, the so-called revenge tax, which the White House wouldn't agree with that characterization. But we heard Scott Bessent yesterday on the Hill sort of lend his support to it. So there's no doubt that there's still some key disagreements that need to be worked out between the White House and the Senate before we even get to talking about the differences that need to be worked out between the Senate and the House.
Tyler Kendall, Bloomberg's very own. Tyler, thank you. Down in Washington, D.C. More from Tyler later. Let's fold that conversation into the foreign exchange market. Back in November, we had a conversation around this table about what loose fiscal policy and higher tariffs would mean for financial markets. And if you push that through FX, a lot of people just sat there and said it's going to mean a stronger dollar, a much stronger dollar. What do you have this morning? Check out euro dollar. Euro dollar through 116, a level we haven't seen since November 2021. It's a 4-day run, the longest winning streak so far for the euro on a daily basis going back to the middle of February. And the euro keeps grinding higher. This euro strength, dollar weakness. Sarah Hunt of Alpine Saxon Woods is back with us. Sarah, that's been one of the biggest surprises of the year so far. The policy, largely as expected directionally, I think April 2nd surprised a lot of people with the magnitude of some of the tariff moves, but directionally, this was the direction of travel people thought. And here we are with a weaker dollar, not a stronger one. What's changed?
I think there was also some expectation that keeps moving out that the U.S. was going to be cutting rates, and they're not. I think that there is an expectation that the fiscal stimulus that's going to come through in Europe is going to be very high because they're going to start spending money that they haven't been spending, and that got people more interested in markets over there as well. I think the underperformance of the U.S. market relative to some of those markets has an effect as well because people start switching into other areas and on the margin kind of moving out of the U.S. and into European assets. So I think there are a number of moving parts, but in a lot of ways, like other correlations that we're used to saying X then Y, we've seen some very unusual correlation moves, and I think that it's sometimes hard to figure out exactly why that is.
Well, let's pick out one piece of that. So the FX component for some people speaks to the erosion of US exceptionalism, that people have started to look elsewhere. We had a guest on the program recently who talked about maybe there's some scope, some space for some catch-up here, the US versus the rest of the world. In fact, it was HSBC about an hour ago on this program. Would you share some of that maybe there's some space for some catch-up, just in terms of performance, that perhaps we've left the US behind and maybe we shouldn't have?
Well, it's interesting because to the extent that some of the U.S. large cap companies are going to end up with some of the burden of those tariffs, it might be interesting to see that small cap story that we've been talking about for years, that maybe you start to see a catch up in the small cap story because you've got a more domestically focused situation, and therefore they may not be as impacted as badly by tariffs as not. I think that the U.S. markets had such outperformance for the last couple of years that it's not a huge surprise to see a relative catch-up move outside the U.S. So then it's sort of like what's catching up to what, right? So I think that there is some element of that and some element of a lack of the same sclerosis or expectation that it won't be as bad in Europe as it has been for the last couple of years.
Most analysts are predicting that actually the dollar, though, has further weakness to go. What would be the catalyst for reversal?
I think more certainty around a lot of things would, at least, even if it doesn't reverse that direct trend in the moment, I think the lack of certainty is giving people reasons to say, I don't necessarily want to hold assets in X. So more certainty whether or not it is a good kind or a bad kind, i.e. it's higher than we thought it was and more detrimental potentially for growth. But I think if you continue to see the data hold up the way it has been and you continue to see U.S. growth being better than people expected, I think that that's a reason for reversal.
Is Europe and China, places like Europe and China, really in a better position to provide policy clarity, policy certainty relative to the U.S.?
No, they're not, and no, they generally don't, but it's the sort of jumping into the uncertainty pool that's going on in the U.S. that has sort of changed that story a little bit. And again, 2 years of really great performance and some inflows into the U.S. that were consistent. So seeing some outflows is, again, not a huge surprise. It's a question of where they stabilize and whether or not people are thinking, okay, that was enough of that. That was enough of that to some extent.
Isn't there a strong argument to make right now that in 3 months you'll have that clarity here in the United States? Should have wrapped up direction of travel for trade. Ultimately, we'll know the destiny of the U.S., the fate of the U.S. tax bill working through Congress right now. That should all be done in a few months, shouldn't it?
It should be, but markets, as much as they like to anticipate what they think is going to happen right now, the pathways at the levels that we are now on the equity indices are not as easy to say. I can easily say it's fine to own this outright, or I can easily say I'm going to jump into the pool here. That snapback from the drop that we saw in March and into April was so quick that it caught a lot of people off sides, and I think that that's where there's some question about directional here right now.
The last 2 months is a bit of a blur, isn't it?
It is.
Where's that time gone?
Yeah, I know.
7, 8 months since the election.
It's pretty incredible. We're over 100 days into this administration. It feels like we've done a few 180s after a few 180s. But when you say, Jonathan, is Europe any better place to go? I think about how it's herding cats in Brussels. 27 countries need to agree on all this. This is why this trade deal with Brussels is going to be so challenging.
And yet that grind higher continues in a single currency. Euro dollar sitting at 116 so far this morning. Sarah, it's good to see you. Thanks for dropping by. Sarah Hunt there of Alpine Saxon Woods. Up next on the program, Adam Posen of the Peterson Institute on President Trump's latest tariff threat. We'll spend some time on that. We'll also spend some time on the future of the Federal Reserve and who's going to be the next leader after Chairman Powell, as we count you down to a Fed decision in less than a week from now. From New York City this morning, good morning to you all. You're watching Bloomberg TV.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Snapped a three-day winning streak in yesterday's session on the S&P 500 this morning, backing down by another 0.6% on the S&P, similar amount on the NASDAQ 100. As we work our way into the opening bell, in about an hour from now, you'll get jobless claims and PPI data following CPI yesterday, the fourth consecutive month we've had a downside surprise on core CPI. If you check out the bond market this morning, the rally continues, yields are lower. 10-year yields are down, 30-year yields are down. We're down by 4 or 5 basis points across the long end of the curve, 437.30. 10-year debt auction yesterday went okay. BMO's Ian Lincoln said all buyers, no strike. We'll see if we get that strike later on this afternoon when we get that 30-year debt auction at 1 p.m. Eastern Time. Before we get there, 2 hours away from the cash open, let's get you some morning movers with Yahara Arnold. Hey, Yahara.
Hi, John. We start with Oracle bucking the risk-off trend. We are seeing shares rise 8.6% in the pre-market, fueled by a bullish forecast. It is saying that it expects cloud infrastructure sales to surge 70% this year. This comes as it becomes a major player in the business of renting out computing power and storage to the likes of xAI, OpenAI, and Meta. And it says momentum will carry on to next year, with the CEO saying growth will be even stronger then. And from one AI darling to another. Next up, we have CoreWeave. Shares are up 1.6% after Reuters reported that the company will play a central role in a new partnership between Google and OpenAI. The AI-focused cloud provider will supply computing power to Google Cloud, which will then serve OpenAI's growing demand for compute power due to its services like ChatGPT. And moving in the other direction, we have GameStop plunging here, down nearly 16%. It has been in the news lately. It did report weaker than expected results earlier this week, but we have other news that's also hitting the stock. Just yesterday, it announced a $1.75 billion offering of equity-linked bonds, and that, of course, is worrying investors because those bonds can convert into stock, which could mean dilution down the line. John?
Yahara, thank you. That stock is down hard in the pre-market by 15 to 16%. On our radar this morning, unilateral tariffs could be back on the table. President Donald Trump saying he intends to send letters to dozens of countries ahead of a July 9th deadline to reimpose duties.
So he's basically saying this is the deal. You could take it or leave it. But I question the deal from what? Their own April 2nd tariff levy, which was Liberation Day, which then obviously they said, okay, these are too high. We're going to go into negotiating mode. Or did countries send in their best and final offer, and there are potentially mini negotiations going on with tariff rates? We have to wait and see. At the same time, the Treasury Secretary yesterday was on Capitol Hill. Clearly, he was asked a lot about trade and tariffs. And he said that these 18 countries that make up 90% of trade with the United States, they will likely get an extension if they are negotiating good faith. So there's 3 different ball games going on. There's China, which is going to be a long game. Then there's the first inning of the EU, Japan, South Korea, and all these other countries. And then there's these other countries that are basically like, we're going to set a rate, and then that's going to be the new trading ground.
I actually think the other countries could be more interesting. I think there's a natural inclination, I understand why, to focus on the big economies, to think about Europe, to think about China. Go back to the trade data we had from the Chinese in the last few weeks, and what you saw was a big drop-off in exports to the US, a big drop-off in trade between the two countries, but then a big export boost to places like Vietnam. And this is where this administration, I think, is going to be increasingly focused on. Some of the exports coming from China to Vietnam, coming through the back door and back into the United States. What are they going to do about that? What can they do about that in the weeks, months, and years to come?
The knock-on effects. They want to make sure that China doesn't have a back door. This is why they've been putting a ton of pressure on Mexico, because we saw the near-shoring, friend-shoring. China was also doing that. They were going out to friends and saying, we're going to manufacture here. So they're going to have to work with these countries to try to put up their own tariff walls, because they know that China will dump somewhere if it's not on the United States or it's not on the European Union.
That's the latest on trade. I want to talk about fiscal as well. The trade-offs in the Senate over Trump's big, beautiful bill. The Senator Mike Crapo saying the 3 major business tax provisions will be made permanent, but will require a scaling back of the House brokered deal on the SALT deduction. This has been the focus for us. How much daylight would we see between the bill that went through the House and a bill that will ultimately come through the Senate?
SALT is going to be very challenging. It's very challenging for Speaker Mike Johnson. He had said to Lisa and I last week, Jonathan, that it's basically walking on a piece of dental floss through the Grand Canyon. He cannot get the bill through the House without keeping the SALT cap. And there are some Republicans who are not going to be willing to vote for it if it's not sticking at $40,000 when it comes to the deduction cap. And you already heard from the likes of Senator Tom Tillis saying, this is a moderate Republican, saying it's going to have to be lower, $30K. But do you know why? There is not a single Republican senator from a blue state that cares about the SALT deduction. I think they understand that the politics in the House is very different, but this is challenging for some of these senators to go take that vote.
This was always going to be a point of tension, and it's looking like it will be a point of tension. I want to turn to a developing story so far this morning. A Boeing 787 crashing in India. The Air India flight was carrying 242 passengers and crew to London. Bloomberg's Sid Phillip joins us now with the latest. Sid, welcome back to the program, sir. We caught up with you last hour. What's the latest?
Morning, John. So we're still trying to figure out, we still don't know what happened, why the plane crashed. We do know that there may be expanded casualties because the plane crashed into a residential building that's just basically off the runway. And so there may be much more casualties than initially, or just on the plane. The authorities in India still haven't released how many people are feared dead or what the injuries are. But it is a sort of developing situation at the moment. We understand that the injured have been taken to multiple hospitals in the city. Ahmedabad Airport, which is where the aircraft was taking off from, has reopened to passenger traffic, and aircraft have now resumed flying in there. So we're waiting to see what the impact of that's going to be. But yes, this is a massive, massive accident, and it is Air India's deadliest since 1985. When an aircraft exploded over the Atlantic Ocean. And so, I mean, both Air India and Boeing are in the midst of a turnaround. Air India going from a state-owned company to a privately owned carrier under the Tata Group, which is expanding rapidly. They're adding more fleet. They announced orders for over 500 brand new aircraft from both Boeing and Airbus. And Boeing, which has been under lots of scrutiny over the last couple of years about the 737 MAX, a separate model, the smaller, shorter range model. And Boeing sort of under lots of scrutiny in terms of its manufacturing practices and everything else. But this is a 12-year-old plane. This is a 787, Boeing's most advanced, technologically advanced model. It's carbon composite. And so we're waiting to see what happened, why it happened, and what the learnings from this will be.
It's a densely populated area, and it's seriously tragic, the news this morning. Sid, thank you for your time, sir. And when we get some more news for you, we'll bring it to you. Sid Phillip there on the latest aviation disaster, this time, unfortunately, in India. Let's turn back to trade. China affirming a U.S. trade deal announced earlier this week. Officials adding the country always, quote, keeps its word. Joining us now is Adam Posen of the Peniston Institute. Adam, welcome back to the program, sir. Let's talk about what ultimately you've been engaged with over the past week or so. I think yesterday after the inflation print, there might have been some excitement that maybe we could escape the higher prices off the back of the policy we've seen implemented over the last month or so. Adam, do you think maybe we're getting a little bit too excited too soon?
I think we're getting too excited too soon, Jonathan, for two reasons. First, as you imply, there is still a chance, and in fact, I think a very great chance, that we are just at the start of the tariff cycle. I appeared before the Senate Finance Democrats in a hearing yesterday, and there were small businesses, an array of them, sitting next to me, talking about how they are having to make hard decisions on what tariffs to purchase or what to cut back on. And we're seeing that in all kinds of data, even though it's not in the New York Fed inflation expectations, admittedly. And so I think the Fed's right to sit tight. But the other thing that's going on is we're not going to duck this as a real income hit. There's huge income hit because we're losing purchasing power of things people want to buy through tariffs, where it's a real income hit because uncertainty has gone up and it's going to remain up as the non-deals of the last month show. And so we might end up possibly with not that much inflation, but incomes are going to be hit.
Adam, when you look at the core inflation yesterday, we saw the decline was from airlines, cars, clothing. There was a drop across the board when it comes to energy prices. When do you think it'll actually hit the hard data?
It's a fair question, Anne-Marie. And after 4 months of under expectations inflation, even somebody like me who's been forecasting inflation to go up has to take a pause. 4 months in a row is real information. But the fact remains that the new and used cars number is weird, to use a technical term, given what we know is going on at Ford, at GM, at Toyota, at Stellantis, at Honda, given what we know is happening to their supply chains, given what we know is happening to credit availability for cars. It's odd. Doesn't mean it's not literally true, but I wouldn't put too much weight on it. But more than that, I think there's just needs to be, as the Fed, I think, is rightly doing by waiting, you need to wait to see what happens. If it turns out there isn't inflation, then great. And we just have to deal with the real income loss.
Well, Adam, what about if we do get trade deals, and this is all wrapped up in terms of the uncertainty by the middle or the end to the summer?
It still doesn't fix the underlying problems, Anne-Marie. I mean, two things. First is, again, two things. Again, it's both direct and uncertainty. The direct effect is we still have tariffs that are 20 times on average as high as they were for 80 years. And that has to work through the system, and that is paid for by American companies or American consumers or American companies who buy inputs. So full stop, that's there. Second, because of the nature of the tariffs, that they're not done through legislation, they're done through presidential emergency power executive orders, and because everything gets negotiated, everything's up for negotiation at all times, the uncertainty doesn't go away. I know Jonathan hates it when I bring up Brexit, but the analogy is to Brexit. From 2016 to 2020, people kept saying, well, once the uncertainty is resolved, once we know if it's a hard or a soft Brexit, it'll be okay. And I kept saying the problem with Brexit isn't uncertainty. The problem about Brexit, the problem with Brexit is Brexit. And so it's not the same thing, but there is that parallel here. The regime has changed, and we're seeing that in the fixed income markets. We're seeing that in the currency markets. People do not view the U.S. assets or U.S. policy or U.S. fiscal policy as safe as it once was. It's not gone to heck, but it is less safe, more than zero risk asset. And that has a cascade of effects that will not go away.
Adam, if you asked me seriously what Brexit is, what it was, I couldn't tell you. I stopped following the conversation a long time ago. I just feel lucky to live in America and no longer in the UK to track that story anymore. Did you give up too, Anne-Marie? I gave up years ago.
I sort of did. I did give up, especially because I moved to the UK at a 172 handle.
Soft Brexit, hard Brexit.
And then I left after Brexit.
Enough of that, Adam. Enough of that. I wanted to get your view on the next Fed chair and the kind of characteristics that you would like to see from the incoming Fed chair after, of course, Chairman Powell steps aside next year.
Right. I think, Jonathan, as Ben Bernanke, Thomas Laubach, Rick Mishkin, and I argued for after Greenspan, it should matter less who the chair is. It should be a system. It should be less about the personality. Obviously, it does matter. Jay Powell has had unique attributes that have mostly been extremely great leadership. I think the next chair is going to end up having a very simple job, because they're either going to get lucky because AI kicks in, and so like Greenspan in the mid-90s, you get higher growth and lower inflation, and they can sit back and thereby please President Trump, or inflation will be obvious and the committee will leave them no choice and they'll have to hike. So there's going to be a lot of hype around who's the next chair. And if there is a crisis, it matters whether it's Ben Bernanke or not. I don't mean to dismiss that.
Sure.
But I think people are overdoing it. The Fed will do what the Fed does.
Adam, let's talk about what the Fed will do and what they'll do next. You said for quite a while there's a real risk that the next move might be an interest rate hike. And you also acknowledged this morning that 4 months of softer than expected inflation is not noise, it's information. So, Adam, with that in mind, what's the view now on what you would expect to come from the Fed?
You're right to call me on that. I had been expecting higher inflation this year, and I was expecting that the Fed would be hiking before the end of the year. A few months ago, even before this run of data, I changed my forecast. It was still out of market, out of consensus, and remains a bit so, that the Fed is not going to be cutting until November or December at the earliest. And if they do, it's only going to be 2 cuts before the end of the year. There are a bunch of reasons for them to sit still. Some of them were articulated by Fed Atlanta President Raphael Bostic the other day. The general sense of the committee, I think, is broadly right, that we're not falling off a cliff in terms of unemployment or growth. So anyway, forecast, they're going to sit tight. And they're going to sit tight at least through September, probably till fourth quarter. And I think if they do make cuts in the fourth quarter, they're still likely to have to take them back by the middle of 2026.
Interesting. Adam, we get new information, the outlook changes. I appreciate the update. Adam Posen at the Peterson Institute. Thank you, sir. Thank you very much. Equity so far this morning, negative by about 0.5%. Not a big morning of drama so far in financial markets. Later on this morning, about 46 minutes from now, we'll get you an update on the economic data, PPI and jobless claims. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara.
Hi, John. We start with that devastating news out of India. Emergency crews there are working to contain the aftermath of the Air India flight that crashed hours ago. The plane was carrying 242 passengers and crew and was bound for London. The jet reportedly went down in a residential area moments after taking off from the Ahmedabad airport in western India. It's the worst incident to date involving the Boeing 787. Meanwhile, Elon Musk reportedly called President Trump late Monday night. The New York Times reporting the call came before Musk publicly backed off some of his attacks on Trump in posts on X. Musk also reportedly spoke with Vice President J.D. Vance and White House Chief of Staff Susie Wiles on Friday, who encouraged him to repair his relationship with the president. And Manhattan apartment rents reached a new all-time high last month. The median rent on new leases signed in May was $4,571, the third record price hit in 4 months, according to Miller Samuel and Douglas Elliman. Landlords are expected to raise prices further to cover the city's new law, which bars owners from imposing broker fees on new tenants. Can't catch a break. That's your Bloomberg Brief. John?
It's brutal out there, Yahara. Thank you. It's getting more and more expensive, isn't it?
To rent, yeah. It's challenging.
Absolutely ridiculous. What do we need? Lower interest rates. Except lower interest rates mean high mortgage rates. At least that's what happened last year.
Yeah, lower interest rates. But actually, if it was to work properly in the normal sense, lower interest rates, lower mortgages, people get on the property ladder, they don't need to rent anymore. They could buy.
There we go. Make it happen. Do you want to take the Fed chair's position? Start QE. Start buying some 30-year debt.
I'm running.
Up next on the program, the reckoning.
The reckoning is coming. There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset.
That conversation up next with the former Fed Vice Chair, Rich Clarida.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Stocks and bonds doing okay this morning. Equities just a little bit lower. We're down by 0.5% on the S&P. The rally continues, though, in the bond market. You'll see yields lower across the curve. Under surveillance this morning, the reckoning.
The reckoning is coming. There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%, probably going to go higher on the inflation rate.
Here's the latest this morning. The long bond in focus, $22 billion in 30-year Treasury notes up for auction today. That will gauge appetite for long-duration U.S. debt. The former Fed Vice Chair and PIMCO Global Economic Advisor Rich Clarida, together with the team, favoring shorter duration, writing, we anticipate maintaining a bias to be overweight in the 5 to 10-year part of the global yield curves and to be underweight in the long end over time. Rich joins us now for more. Rich, good morning. It's good to see you.
As always, thanks for having me.
New secular outlook. Always a fantastic team effort from you and the team every single June, I believe.
Yeah.
The era of fragmentation. Let's just start there before we get into the debt dynamics. What is that, and what does it mean for the path forward?
Very straightforward. The world's fragmenting into regional security alliances, trading blocs, currency zones. The process has been underway for a while, but it's accelerated under Trump 2.0. We point out it has important implications for the economy and markets. We see business cycles being amplified, markets being more volatile, but importantly, there are opportunities for investors in the fragmentation era to identify what's driving returns and repricing risk.
Well, let's identify what the economic characteristics are of the era of fragmentation. And what it means for the so-called long bond. Does it mean a less dependable bond bid for a 30-year maturity?
Well, we're not sure. We think what it does mean is there's a very large stock of debt in the U.S. and around the world as we come into the era of fragmentation. And so we do see already in market pricing a higher term premium. Our judgment right now is at the very long end of the curve for most investors, you're not getting paid enough to take on 3 times the interest rate risk, which is our preference for the belly of the curve. So that's the most immediate point I guess I would make.
What's your reaction when you hear Jeffrey Gundlach say a reckoning is coming to the U.S. and the U.S. debt market?
Our baseline view is that a reckoning is inevitable, but not our baseline for the next 5 years. We think the action-forcing event in Washington to get our fiscal house in order will probably be in the next decade when the Medicare and Social Security trust funds are exhausted. We could be wrong at some level. I hope we're wrong, because an earlier reckoning means that we get our fiscal house in order. But our baseline is that that's something in the next decade.
When you see these concerns of the U.S. debt market, and then you also have this view that there's this fragmentation going on in the world, what does this mean for U.S. exceptionalism? Is it over? Is it waning? Or potentially, could it reemerge in Trump 2.0?
We think it could reemerge for the following reason. As we come into the era of fragmentation, there's a lot to like about the U.S. Strong productivity growth, an innovative economy, more or less efficient capital markets, and those attributes have not gone away. There's a lot of uncertainty now, a lot of it generated about U.S. trade policy and security policy, but over time, Anne-Marie, that will get sorted out. And as that goes into the rearview mirror, we think there's a decent shot that the exceptionalism mean returns.
Can we just finish on the Federal Reserve?
Oh, of course.
The kind of new considerations monetary policy officials need to have in the moment that you and a team are framing. What's changed for them?
I think that it will make their job more difficult in the sense that the Fed benefited enormously, and all central banks did, from globalization. And Jay Powell and I used to talk about that at the time, is that the era of globalization lowered the cost of goods, increased efficiency, it put downward pressure on inflation. Indeed, the price of goods fell on average in the 90s up until the pandemic. And so as globalization goes into reverse, and in the era of fragmentation, that process will be accelerating, it's going to make all central banks' job at the margin harder because you will not have that disinflationary force from globalization.
Do you think it makes it more difficult to respond to adverse shocks and respond quickly enough?
I think at the margin, probably for all central banks, they have a little bit less room to respond preemptively to news of a slowing economy, simply because they don't have the tailwind of inflation being a bit below target for 10 or 15 or 20 years. And they want to keep inflation expectations anchored. So again, I think these effects are more at the margin, but I think it's less likely that you get preemptive moves to cut going into downturns.
I remember a phrase of yours, an ounce of protection is worth a pound of cure. It doesn't feel like they have that luxury this time around.
They have less of a luxury, and you know, John, there is some path dependence here. I mean, we would be having a different conversation if inflation for the last 4 years had not been well above 2%, and I won't even use the T word here. And so I think there is some path dependence here for all central banks. You know, Christine Lagarde, Andrew Bailey, and others. Central banks at the end of the day want inflation expectations to be anchored, and they want to be credible. Yep. And so I think that is relevant here.
Rich, a clinic as always. It's good to see you. Congratulations to you and the team on the latest secular outlook from PIMCO. The former Fed Vice Chair, Richard Clarida. In the next hour on Bloomberg Surveillance, we get some PPI data, jobless claims too. We'll catch up with Brent Schutte of Northwestern Mutual, Garrett Nelson of CFRA, Neil Dutter of Renmac, and Lindsay Rosner of Goldman Sachs. From New York, this is Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
The U.S. economy's got a very asymmetric effect going on right now.
If the current level of tariffs stick, we do still expect this inflation pressure to rise.
Tariffs can certainly slow growth some. We're not big believers that they're in any way kind of inflationary in a durable sense.
We should expect to see some upside pressure on inflation coming from tariffs.
The noise versus signal, the noise is very high right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We are poised for back-to-back losses on the S&P 500 for the first time so far this month. Equity futures at the moment, your scores look like this. We're down by 0.6% on the S&P. Similar move on the Nasdaq 100. On the Russell, we're down by more than 1 full percentage point. If you turn to the bond market, some better news. Yields down by 5 basis points. The 10-year creeping towards 450 in yesterday's session, back down to 437.30. 30-year bond yields down another 5 basis points to 486.44. We are rallying into some supply later on this afternoon. The day ahead shaping up as follows. 30-year debt coming to market at 1 p.m. Eastern time. Before we get there at 8:30, 29 minutes away, some economic data, US PPI, and jobless claims.
And PPI is going to be important, right? Of course, on the heels of CPI yesterday, which showed that inflation is coming down less than forecast, 4th month in a row. At the time, when everyone was talking about tariffs are going to be inflationary, what view do you take? Has it not hit the data just yet? Has it not actually creeped into the market? Well, potentially, also because we don't even know what the tariff rates are going to be. The president made that clear yesterday. The next 2 weeks, he's going to be, for some countries, sending out letters. That's the deal. Take it or leave it.
Inflation data, noise or signal? It can be both. It can be both. You can sit here and say it's noisy because of the tariff story and the inventories we need to work through, and that maybe you're going to see higher prices later this summer. But you also have to acknowledge the signal. 4 consecutive months of softer than expected inflation data in America. Adam Poston of the Peterson Institute with us 30 minutes ago, accepting there's some information in that. Starting points matter. This is a better than expected starting point.
And also because it's 4. This is a trend. We're seeing declines in airfares, cars, clothing, of course, also a drop along the energy space. This was welcome news to the White House. And I know Neil Dutta is going to be on with us later in the hour. Secretary Bessent also repeated what Neil said in his note yesterday. For all those that are concerned with uncertainty, he's calling it not Trump derangement syndrome, but tariff derangement syndrome.
And he thinks maybe this Fed chair and this Federal Reserve has so-called TDS. Later on this afternoon, we need to talk about this bond market. Yields are lower today by 5 basis points on 10s. decent auction yesterday. 30-year supply coming to market a little bit later. It's the long bond that's in focus in a bigger way.
$22 billion. I can't believe I'm even paying attention to this auction today. I feel like Lisa at 1 p.m. But it is really important, on the heels especially of Lisa's conversation with Jeffrey Gundlach. There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. We have heard that for months on this program around the table. People are saying that the 30-year bond is a risk asset and they don't want to touch it.
Lisa making her way back from California. She'll be with us hopefully at some point in the next week. Fantastic exchange with Jeff Gundlach of Double Line just yesterday. Check that out on Bloomberg.com, on YouTube, or if you are a Bloomberg subscriber, on the Bloomberg terminal. Coming up this hour, we'll catch up with Brent Schutte of Northwestern Mutual on the latest trade deals, Garrett Nelson of CFRA as Musk and the president take down the temperature, and Neil Dutta of Renmac on what he calls tariff derangement syndrome. We begin this hour with stocks lower as President Trump says unilateral tariffs are coming. Brent Schutte of Northwestern Mutual writing, we do not believe investors should make dramatic changes to their investment plans. An unpredictable future will lead to unpredictable opportunities for investors. Brent joins us now for more. Brent, welcome back to the program, sir. I think we kick it off with inflation. PPI data 26 minutes from now. CPI data just yesterday. A downside surprise on core. Is it still too early to declare the all clear on inflation?
We think so. So if you think about the last few months, you've had this incredible pull forward of demand. So you've had this yo-yo economy where consumers, businesses, importers have pulled forward demand, which could be showing up in the inflation data. And the second reason, I kind of tie it more to consumer spending overall. I think we're all kind of missing kind of the noise or the data here, where it shows consumer spending has slowed. Think about Q1 GDP, 1.2% consumer spending growth, which I believe was the lowest since the second quarter of 2023 when we were worried about the banking crisis. We had April PCE that showed 0.2 nominal, 0.1 real growth in spending in the month of April. And then we had the Beige Book last week that really talked about 9 districts overall reporting slight or modest declines or no change, and only 3 reporting growth. And there was a sentence in there that talked about consumer spending starting to falter just a bit. And so I think it's too early to declare all clear on the inflation and the economic front.
Brent, is that an argument, though, for that inflation to be temporary? A lot of people would say the greatest cure for high prices is high prices. And if the labour market is not strong enough to support the spending, that ultimately you won't see that high price story last that long. And this economy will roll over and this will self-correct.
Yeah, I guess you're asking me, is there a recession possibly in the future? I don't think we've taken that off the table yet. Look, there are still quite a few risks that are out there. I mean, the data last week, I think we've all become numb to it because it didn't work last year. You had the ISM services sub 50. I mentioned the Beige Book. I mentioned the ISM manufacturing below 50. You had the ADP of 37,000. The jobs report looked strong on the surface, but beneath it, you only had 50% of industries actually hiring during the month, and most of them were actually non-cyclical. You throw in the unemployment rate that would have risen had people not dropped out of the labor market, and that's where I think you're seeing this gradual weakening. We'll see where it goes from here. Probably the most important data point coming up today is those jobless claims, because those have been rising over the past few weeks.
Brent, what are you looking for in Washington when it comes to policy uncertainty? What are you hoping to get clarity on? Is it the tax bill or is it what's going on with trade?
I don't think we're going to get clarity on anything in the near term. Look, I don't think we're at max tariff uncertainty. I think there's still more to go there. I do believe the administration wants and needs those tariffs. You can read it in Stephen Myron's commentary. You can read it in Scott Besson's commentary. I think they need to pay for on the tax bill. And so I think tariff uncertainty is going to continue. I think economic uncertainty coming out of Washington is going to continue. And that's where I think there's just the opportunity here to be a little bit cautious and to make sure that you are near your asset allocation where you're supposed to be longer term and you're not taking undue risk. And as you open up with my commentary, I think diversification is great again.
Well, it's interesting you say we're not at max tariff uncertainty yet, because most people have said after April 2nd that we have passed peak uncertainty when it comes to tariffs. What are you concerned about on the trade front?
I mean, where do we go from here? I mean, last night there was a new headline about just sending out letters to let people know where they're at. What was resolved with China yesterday? And so that's where I think there's still tariff uncertainty. Yes, the overall effective tariff rate has come down from 27% or whatever you would have calculated on Liberation Day to somewhere in the 13.5% to 14% rate. But that's still, a lot more than it was at the beginning of the year, where it was 2.3%. And that's where I think there's still some back and forth to go. And while maybe you could tell me that it's max tariff uncertainty, I don't think it's max economic impact yet.
Let's get to the D word, diversification. Let's talk about what that actually means and the role the bond market can play in this moment, Brent. So You heard Jeff Gundlach of Double Line. This is what he said to Lisa. There's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. I think this is a really important question for a lot of people. I can be what I think is diversified, have a stock allocation, a bit of a bond allocation, and sit there in the belief, maybe even the comfort, that when things go wrong, maybe the bond side of the story does okay for me. Brent, can I have that confidence still, that when things go wrong, bonds will perform?
I think in the near term, the answer is yes. I think in the long term or intermediate term, I think the answer is a little bit less than yes. And that's where you see the annual interest cost on our debt rising in the next 5 to 10 years to somewhat above 4%, maybe even 5% of GDP, which is not a good scenario given the fact that we only can grow at 4 or 5% nominal longer term. And so that's where I think it's kind of a bifurcated answer. I think the other side of the equation that I'd focus on is that people need to have more than just bonds to diversify. And so if you think about the last 15 years, the only thing that was the biggest risk, or the one-sided risk that we had, was deflation. Now there are two-sided risks. There is the inflation side of the equation, where this could be a period of inflation because of deglobalization. We could have inflating away of that debt. I think you need to own real assets on the other side. And I think international stocks, for example, there are other ways to diversify. I think international stocks, for example, were a cheap asset class that needed a catalyst. I think they have that catalyst right now. And I think the administration wants the dollar lower, which is a huge tailwind to U.S.-based investors. And so my big message is to get out of just U.S. large cap stocks, diversify into international. Think about adding commodities to your portfolio. Even thinking about small and mid cap stocks, which I know are economically sensitive, but small cap stocks, for example, I've done this for 30 years. They're the second cheapest in my career relative to large caps. The other time was June of 2000, and that ushered in a period of small cap outperformance. And so I think there are lots of opportunities for investors. They're just not looking in the right place.
Brent, why do you believe that an international allocation to equities provides diversification? I understand by definition you're diversified beyond the US, but why does that help me performance-wise?
Currency diversification is one thing. I think Rich was just on your show talking about the kind of dysfunctional period that we have going forward, where central banks may not be as coordinated. Look, I think there's certainly, if U.S. equities falter, you may say international equities falter, but they might falter just a bit less. And that's where I think people are so underinvested here. You're going to see repatriation of cash. You're going to see a dollar that likely falls in the coming years, which is a huge tailwind to U.S.-based investors in foreign assets. And so I think having all these different asset classes and asset allocations, I think is going to work going forward, just given the reality that we're kind of in this desynchronous world.
Seeing the dollar fall today. Brent, appreciate your time. Brent Schutte there of Northwestern Mutual. Much weaker dollar against the whole of G10 so far. The dollar weaker against the euro for a fourth consecutive day. Euro dollar through 116 earlier on in the session. Euro dollar the highest since November 2021. That's the story in foreign exchange. As Brent talked, we were talking about the data that comes at 8:30 Eastern time, and he said the one to watch is jobless claims. Jobless claims last time around, 247. That's the highest print of the year so far. In fact, it's the highest print going all the way back to October. If you get another high print on claims, people are just going to start to worry just that little bit more that this labor market is starting to crack.
Absolutely. There's going to be a little bit more of a nervousness, and especially if it's second time in a row, does it start to become a trend then if we see it again in the following weeks? That's where the concern potentially is going to be. At the same time, though, on the CPI front, things are looking good. 4 prints in a row, we have lower inflation than what was forecast.
Better than expected, that's for sure. More data in about 19 minutes' time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with this morning's tragic news. An Air India flight carrying 242 passengers and crew crashed moments after taking off from the Ahmedabad airport. Local police say that there were no survivors. After closing for several hours, operations have now resumed at Ahmedabad's airport as Air India works to ascertain details around the crash. Boeing saying it's been in touch with Air India. Meanwhile, the U.S. ordered some staff to leave its embassy in Baghdad due to heightened security risks. It's also authorized families of members of U.S. military personnel in the Middle East to depart. Statements on the matter did not cite any specific threat, though CBS is reporting that U.S. officials have been told Israel is ready to launch an operation in Iran. And President Trump plans to send letters to trading partners within the next 2 weeks to set unilateral tariff rates. The move comes ahead of a July 9th deadline to reimpose higher duties on dozens of countries once the current 90-day pause expires. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Let's set up the rest of the hour. Up next on the program, the morning calls, plus Garrett Nelson of CFRA on what's next for Tesla after Musk and Trump back down from their feud. Then later, we get some economic data, PPI and jobless claims just moments away. Live from New York, this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The opening bound 1 hour and 15 minutes away. Yesterday, snapping a three-day winning streak on the S&P 500. Today, back-to-back losses, potentially on the S&P. We're down 0.5% on the benchmark in America. The Nasdaq 100 is down by 0.6%, and we're down more. Underperformance on the Russell 2000. Small caps negative by 1 percentage point. If we switch at the board and get to the bond market, these are the scores going into the economic data at 8:30 Eastern time. This bond market is rallying quite nicely. We're down 5 basis points this morning. Yields were lower yesterday as well. The yield on a 10-year maturity, 437.10. On 30s, the long bond, 486.34. A test for the long bond, not just from the data in a moment when we get PPI and jobless claims, but again this afternoon when we get that debt supply at 1 p.m. Eastern time. That's the price action. Let's get you some morning calls. First up, TD Cowen upgrading Tapestry to buy, citing continued momentum at its Coach brand. That stock is negative by 1/3 of 1%. Your second call from Piper Sandler raising its price target on Oracle to 190, saying it's entering a new wave of popularity not seen since the 90s. That stock is up by 8.4%. And your third and final call from Bank of America raising its price target on Meta to 765, citing easing tariff uncertainty and potential AI investments. That name is down about 0.6 of 1%. Let's stick with the Mag 7. Tesla rising for 4 consecutive days as tensions cool between the CEO Elon Musk and President Trump. And investors await the robotaxi launch on June 22nd. Garrett Nelson of CFRA has a hold rating and a 320 price target on Tesla shares. Garrett joins us now for more. Garrett, welcome to the program. Let's get into the call and first focus on this relationship between the president and the leader, Elon Musk, the CEO. It feels like we're putting that to bed. What does it mean for the stock?
Yes, thanks for having me. It seems like it. Obviously, there was significant fallout given what we saw that transpired over social media over the last week or two. But it seems that things are being, fences are being mended here. And I think that's a good thing for the stock. The big concern with this fallout and with the big declines in the stock price that we saw a week or two ago was because there was a view that Tesla had accumulated a certain amount of goodwill with the administration, with the federal government, and that is extremely important right now because the government, the U.S. Department of Transportation, is in the process of approving a framework for autonomous vehicles, and so there's a lot of discussion, a lot of decisions that need to be made on that front, and that really is the future of Tesla. And so, that falling out was not going to be helpful to Tesla or to shareholders, and I think that's why you had such a negative reaction, a week or two ago when this happened.
So let's build on that, Gareth. So you've got the mood music around the name that improves as they make up, but then you've got these operational issues further down the road that we still need to focus on. The robotaxi business, that has been the future of this name. When I speak to the Tesla bulls, Gareth, they tell me repeatedly it's not about auto sales. Ignore that. There's a much bigger story coming further down the road. How much bigger is that story going to be, and how much of a helping hand do they need from the government?
It's a huge opportunity longer term. We estimate the market opportunity globally is north of $5 trillion. So that said, we think it's very difficult to ignore, very challenging near-term fundamentals. We saw in late April, their Q1 EPS was down 40% year over year. They continue to lose market share in all three major markets, China, Europe, and the U.S. You look at China, the most recent data, their sales were down 15% in May. Overall EV sales were up 38%. As recently as 2023, they were second in EV market share in China. Now they're fifth. Very similar story in similar market share losses in Europe and the U.S. And so you look at this very poor quarter that they reported in April, and then the dramatic increase in stock price since then. It's really hard to justify from a valuation standpoint and in light of these market share losses. But I think this robotaxi, unsupervised robotaxi service in Austin will be watched very closely. It's been delayed 10 days now. They're aiming for June 22nd now. And I think everything is going to be compared to what Waymo is doing in that market, currently operating driverless robotaxis. Their geofenced area is about 37 square miles. How does Tesla's geofenced area compare to that? And then how quickly they can increase the number of vehicles operating and expand to other markets.
When you look at Waymo, what's the gap right now between them and Tesla?
We think the real difference here, everything will be compared to what Waymo is doing. And I think many investors will say, well, this is no different than from what Waymo has been doing for some time. But I think the real difference is in the cost and the scale of the two companies. Waymo uses a different technology, LiDAR, whereas Tesla has largely taken a camera and AI approach to developing their full self-driving. So we do think Tesla is going to end up proving to be the right approach, and is going to be a much more scalable technology. But it will take time, and I think the key is not really what happens on June 22nd. It's what happens over the next 3 to 6 months in terms of how many incidents are there. We know the dozen or so unsupervised robotaxis that are operating on day one will be supervised remotely. So. But it's really about how quickly they scale, and investors, everyone will be watching how this goes over the next few months.
I love to also build on your point about the weakness in EV sales across the three major regions. I don't know if you saw this morning. It's small potatoes, but a coalition of 10 Tesla owners in France are actually suing Elon Musk because they don't like his politics. Do you think that rupture with the president, some of that was by design? He needs to put some distance between him and the Oval Office because of brand reputation and the fact that EV sales are down?
No question. There's been a fair amount of brand damage. I don't think a move more towards the middle is a bad thing. A lot of the issues he had with this dust up were related to the national debt and the government's deficits year after year. And I think most Americans have an issue with that. You look, a Gallup poll said that 81% of Americans recently said that they were either very concerned or somewhat concerned about the deficit and the deficits in the national debt. So I don't think the concerns here he's raising are really outside of the mainstream, and I think those are shared by a lot of Americans.
It's true. It's well said. Garrett, appreciate your time, sir. Garrett Nelson there of CFRA, the latest there on Tesla, coming off the back of a 4-day winning streak for that particular stock this morning. Just a little bit lower, down in the pre-market by 1.9%. In just a moment, at 8:30, the data you've been waiting for. PPI, another read on inflation and jobless claims. Bloomberg's Mike McKee joins us now for a preview. Good morning, Mike.
Good morning, John. Sounds very Star Wars-ish. These are the droids you're looking for. We get jobless claims. They're not expected to change a whole lot, but if they do, that'll get Wall Street's attention. It is a difficult time of the year to seasonally adjust these as especially education workers go on and off of payrolls. But there hasn't been any indication we're getting mass layoffs yet. If we did, the Fed would be worried, but right now it looks like claims are expected at least to stay about in the range that they are. And then, of course, we have PPI coming up. Yesterday's CPI benign overall, but there were some categories where we did see tariff-induced inflation. Should we see more of them in the PPI? Probably, particularly in the intermediate goods categories, the parts that go into other things that are made, that are imported into the United States. So there's a possibility for two different reports to have an impact on Wall Street today.
So, Mike, let's focus on the inflationary read that we got just yesterday. CPI, downside surprise on core for 4 consecutive months. Bit of excitement. Some people saying it's signal, others saying it's noise. And the people who say it's noise say we're working through some inventories, and in the next few months you'll start to see the tariff pass through. Mike, which is the more convincing argument? Not just for you personally, but for the Federal Reserve who convenes next week.
Well, I think you have to go with the latter one, that we will see more coming up, because we don't even know what the final tariff regime is going to look like. It's not till July 9th that the president's delay of tariffs, the reciprocal tariffs, comes back into play. We don't know what he's going to do at that point. There was a lot of confusion yesterday when he was tweeting about what China's ultimate tariff number will be. So there's still a lot of danger out there in terms of higher tariffs that would bring higher inflation. And so I think you have to look for the June, July, August data to give us a much better picture of what this is going to look like in the long run.
Mike McKee, thank you, sir. Mike McKee, stay close. Mike McKee's going to break down that economic data for you, jobless claims and PPI. It's going to take a while to negotiate these trade deals and ultimately get a better understanding of what the policy is going to be.
It is going to take a while, and some of these countries may get extensions, but one thing seems certain: we are not going back to the levels we saw on April 2nd, which was Liberation Day, which were maximalist approaches and very high tariff levels.
We've got some economic data to get through. PPI is just around the corner. Jobless claims as well. Jobless claims, the estimate this morning, 242. The previous read, 247. Coming up, we've also got to talk about this: tariff derangement syndrome.
There is a duality between the critics of this administration. All I hear is tariffs. It's like TDS has become tariff derangement syndrome. And that all I hear about is uncertainty from tariffs, uncertainty from tariffs.
Neil Dutter of Renmark joins us next.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The opening about 60 minutes away. The economic data seconds away, about 22 seconds away. And going into it, your scores look like this. Equity futures on the S&P negative by 0.5. On the Nasdaq 100 down by 0.6. Potentially some back-to-back losses for the equity market in America. Ahead of this economic data, we look like this in the bond market. 2-year, 10-year and 30-year looking better and better. Yields down by 6 basis points on 10s at 4.36. With your economic data this morning, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, it looks like we've got fairly benign PPI coming in with final demand and core coming in just a tenth. Core ex trade up also just a tenth. So that leaves the year over year headline PPI at 2.6%. The core PPI falls to 3% from 3.1%, and we get a 2.7% core ex trade. So that looks like in line. I'll get you some breakdown in just a second. Jobless claims come in at 248,000. That's 1,000 more than last week, although last week was revised up to 248. So now we're looking at an unchanged jobless claims situation. Again, this is a difficult seasonal adjustment time of year. It does not suggest that there is any kind of problem with the labor market at the moment, even though we're sort of at an elevated level compared to where we had been earlier in the year.
Mike McKee, we'll come back to you in just a moment. It's another downside surprise, the right kind of downside surprise on an inflationary read in America. Yesterday, CPI, today, PPI. In the equity market, not a big reaction. Equity futures still negative by 0.5. The bigger reaction in both bonds and foreign exchange. The rally continues in fixed income. 10-year yields are down by 8 basis points now at 4.34. At the very long end of the curve, going into that supply later this afternoon, down by 7 at 4.84.72. And once again, that lower bond yield unlocks some further dollar weakness. Euro dollar now near session highs at 116.17, up by more than 1 full percentage point. The biggest one-day move going back to the middle of April and the highest since October 2021. We'll get back to Mike McKee in just a moment. Neil Dutcher of Renmac is joining us around the table, shaking his head. Neil, good morning. What don't you like?
INJ, CSP, Index, Go on your Bloomberg screen.
Tell us.
Look, I mean, this is, the labor market's cracking. With, you know, I mean, with all deference to the, but the break-even rate is lower.
You're worried about the claim story.
How do you look at that chart and not be concerned about the claim story? The fact that continuing claims are basically running at cycle highs tells you that permanent layoffs are going up, not down. Now you have to ask yourself, what's the outlook for these things? Like, where do you think, I mean, so continuing claims have been hitting cycle highs, even with initial claims kind of moving sideways. Now it's possible that initial claims continue to move higher, right? Which means that there will be further upward pressure on continuing jobless claims from here. The reason why this has happened with relatively benign claims, initial claims, excuse me, is because the job finding rates collapsed. But there's some risk that layoffs are growing. I mean, look at the anecdotes just this month.
Yep.
Procter & Gamble, Paramount, Microsoft, Disney. Now we're seeing that Google wants to buy out there. So the labor markets are cracking. You know, I think that there's a lot of this sort of rationalization going on about, well, you know, it's okay because the supply side of the labor market's also cooling. You know, immigration is waning, and so the break-even rate is lower. I just think you're just tempting fate with those sorts of arguments.
You put a note out earlier in the week and you said the Fed is whistling past the graveyard, potentially. So we've got this on the one side, the labour story, and at the same time we've got these softer than expected inflation prints. Should that give the Fed more flexibility to make a move and provide some comfort to the labour market, if you do indeed think these are real, genuine cracks?
Well, I think, you know, it's their job to make decisions with imperfect information in an uncertain environment. That's their job. And at the end of the day, I mean, I agree that, you know, there's additional tariff pressure in front of us because May, you know, we weren't at sort of full strength with respect to tariffs. But at the end of the day, did we collect tariffs in May? Yes or no? Did inflation come in stronger or weaker than expected in May? It came in weaker. So at some, like that, you should be updating your priors to some extent, just given that information, right? So either, you know, the trajectory of inflation wasn't as strong as people thought. I mean, you know, before all this, right, there was, remember they're going to pull forward the price shock, right? Like, so before the tariffs actually come on, they're going to raise prices. That didn't happen. So I do think the other thing to keep in mind with respect to the inflation outlook is home prices. Home prices are slowing across the country, particularly in the major markets. And there's an important link between home prices and consumer price inflation, right? So, you know, you look at go around the country and you look at the metro areas like Dallas, Phoenix, like these are places where you have significant home price weakness and also very, very benign inflation. And so if home prices are cracking now nationally, I think that introduces more downside than people appreciate to the inflation outlook. So I think, will goods prices go up over the next few months? Yeah, probably. But what about service sector inflation? What about rents? That'll probably continue deflating.
You've been pretty consistent. You think the Fed's going to be behind the curve and should cut. When you're seeing rising initial jobless claims and a cooling of inflation, how soon do you think they should cut?
Next week.
Do you really think they should make a move next week?
Look, I mean, unemployment is typically a line that goes up or down. It doesn't just move sideways. So I mean, I don't think they're going to go in June.
No, sure.
But I just think that you have to start asking yourself whether, you know, the train has kind of left the station. And I think that that's kind of where I'm at.
Well, let's compare and contrast the last time they did make a move. They were spooked by claims in the summer of last year. They cut interest rates by 100 basis points. What are the parallels now, the similarities, the differences to the moment we're in currently?
Thank you for bringing that up, because Jay Powell, at his last press conference, says that he was a little bit late when he cut in September. If he was a little bit late then, what does that make him now? So why not June?
He would make the argument that the policy has changed, that we've reintroduced some upside risk to inflation. This is when you would say the TDS that Secretary Bessent used earlier this week, just yesterday, was something you coined, tariff derangement syndrome. You think the Federal Reserve is gripped by that?
Well, I think I think about an alternative scenario where there wasn't tariffs, but they were still talking about the legislation that's currently making its way through the halls of Congress. Would they still be waiting because of that? I'd argue that, you know, possibly they would be. I think you could make that argument. You know, and they could talk about that. I mean, well, they're going to blow out the budget deficit. This could be inflationary. We have to lean against that. I mean, I think it's important sometimes when things are uncertain, that's exactly when you should be focusing more on the data as it's coming out. And so the uncertainty in my mind has kind of, to me, what it feels like is the uncertainty around how much inflation is going to pass through from tariffs has created this sort of freeze in terms of what the Fed may do. But in my view, what they should be doing is focusing more on the data as it's coming in, which should be how they make their next move.
Well, you also mentioned the uncertainty of the one big beautiful bill, and that's something the Secretary was pointing to yesterday. If we didn't have this uncertainty on tariffs, it'd be uncertainty whether or not tax hikes were going to happen if they don't have this extension of policy. How difficult, though, is it for the Fed right now? Those are two massive uncertainties that are a cloud over Washington.
Yeah, I mean, I think. Look, I mean, yes, there's uncertainty. You know, there's a changing of the guard. There would be uncertainty if the shoe was on the other foot. I mean, if let's say there was a scenario where Kamala Harris won, right, and you're basically threatening, you know, corporate. I mean, what happens when you raise corporate taxes? Does some of that not get passed on to prices, right? I mean, so I don't know. I mean. That's why I say there's uncertainty. I think whenever there is uncertainty, you should be focusing more on the data as it's coming to you, and the data as it's coming to them. You know, that should be sort of the escape valve for them. And you know, it looks like continuing jobless claims are at a cycle high today. There's no reason why anyone should think it just magically starts going down absent some kind of policy move. Like, that's to me the issue. Like, housing isn't weak.
We started a process.
Yeah, housing isn't weak because of tariffs. Housing is weak because the Fed's too tight, okay? Like, come on. I don't think, even the labor markets was, for example, was the downward revision of 100,000 jobs in March a function of Trump's tariff policy? It just means that they were too optimistic on growth to begin with. Like, that to me is the other.
Let's be very clear, just allow me to jump in, Neil. You've been pretty much out front on this all year. When you came into 25, you weren't as bulled up on economic growth. In fact, you thought the slowdown had already started coming into the new year. I just want to point that out because some people might be sitting here and just say, yeah, benefit of the hindsight, you're making things up as we go along. You were talking about this coming into the new year.
Yeah, I mean, I think so basically, I think relative to consensus, we were more cautious on growth. I think, you know, a lot of forecasters use Trump's tariff policies and Obliteration Day as a reason to kind of adjust their estimates. And because, you know, arguably he has, you know, he's backed off some of this and so forth, you know, everyone's kind of called off the recession risk. But people, I think, have lost sight of that initial disconnect, which was, well, actually, the housing market was frozen when Trump came into office. The labor markets were frozen when Trump came into office. Like, these are things that have been ongoing, and those things are a function of monetary policy being too tight. I mean, it's not a good look if the housing market got worse after you cut 100 basis points, and that's kind of where we are. Compare and contrast to late 2022, when the housing market was doing better even as the Fed was hiking aggressively.
If you are just joining us, welcome to the program. Moments ago, a downside surprise on PPI. The first thing Neil Dutta went to, though, the ticker on the Bloomberg for continuing jobless claims. Initial jobless claims also near highs for the year, at highs for the year. Continuing claims, cycle highs. Mike McKee's back with us for a little bit more. Mike, we've talked a lot about the inflation story. What do you make of Neil's argument for the labor market?
Well, I think what the Fed would say is that continuing claims represent a more difficulty in finding jobs, and that's what they've been hearing from all of their contacts, that nobody's hiring, but they aren't particularly firing in huge numbers yet. The question is, how fast does that turn around? If companies decide that things are not going to be good and we're going to see demand weakening, they tend to let people go much faster. So it's still, to me, at a kind of a tipping point, waiting for direction on this. The one thing we can say about the price numbers is that underneath the hood, some of the same categories that we expected to rise did rise. The intermediate goods for assembly into other things, machine tools, construction materials, and metals all up a little bit during the month. So there may be something to the tariffs that have already been imposed. But the good news is when you look at the categories that they take out of PPI and put into PCE, almost all of them are down significantly or up just a tiny bit. So it looks like PCE is going to come in for the month of May at a relatively low number as well, which may reassure some people. And I did want to mention, John, your cable TV subscription services.
It's a problem.
1.4%. So there is inflation in that area in both PPI and CPI.
That should be hiking, Mike. Mike, thank you, sir. Mike McKee, I don't think they should be hiking. Just be very clear in case anyone cuts that clip. In the bond market right now, yields are down by 6 basis points on 10s to 436. I've talked about that dollar weakness throughout this morning. We take another leg this morning. The dollar down, euro positive, euro dollar through 116. Neil, just want to finish up with you on the Federal Reserve next Wednesday. You said what they should do. Let's talk about what they will do. They're coming out with a statement, a news conference, new forecast too. What do you expect to see?
Well, I expect them to not do anything, frankly. I mean, I don't think they're going to change their dots. I think if, you should leave those in place. I mean, if they actually start removing dots, I mean, I think that would be, a massive opportunity for people to kind of go long duration because it kind of, it's a mirror image of, kind of what they did last year, where they went peak hawkish in June, and then 3 months later they went 50 in September. So I think that, if things are uncertain, then you shouldn't try to really upset the apple cart one way or the other.
Do you think they have to acknowledge, though, there is some information in the data we've had recently that things have changed?
Well, I think what I'll be looking for is how Powell characterizes the labor market. Because if he continues to say solid but cooling, I think that would, to me, be like a very negative sign for the outlook, because the labor markets are no longer, at some level, at some point, you can't keep saying that, right? If something's cooling, it can't be solid anymore. That's how temperature works. And so I would just say that if he keeps saying solid but cooling, and how he characterizes the labor market, I think that's what I'll be keying in on in particular.
Neil Dutta of Renmark. Neil, appreciate your time. Thank you, sir. Bond yields lower this morning. The equity market just about hanging in there. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. An Air India flight carrying 242 passengers and crew crashed moments after taking off from the Ahmedabad airport. Local police say that there were no survivors. After closing for several hours, operations have now resumed at Ahmedabad's airport as Air India works to ascertain details around the crash. Boeing now saying it's been in touch with Air India. Meanwhile, recapping the latest economic data you were just speaking about, PPI came in lower than expected, rising 0.1% in May. The median forecast in Bloomberg's survey of economists called for a 0.2% gain. This comes after yesterday's CPI print also came in softer than expected. Meanwhile, jobless claims remained unchanged last week at 248,000. And President Trump launched a website for people to sign up for an immigration gold card. The card would allow successful applicants to buy U.S. permanent residency for $5 million. Trump has suggested the card that would replace the EB-5 investor visa and could result in 1 million sales and raise enough money to retire the national debt. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next on the program, we'll set you up for the day ahead as we count you down to the opening bell. Equities negative this morning. Looking ahead to a bond auction a little bit later this afternoon.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
The opening bell, 42 minutes away. Equity futures recovering just a little bit. We're down about 0.25% on the S&P 500. In the bond market, the rally continues. Yields down by 6 basis points, 436. Claims are elevated. Another downside surprise on inflation, this time on PPI. Going into that supply later. The 30-year bond, 4.85. As we count you down to the opening bell, let's get you some movies this morning. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with Micron, falling 1.1% on some breaking news. It unveiled $200 billion of investments in U.S. semiconductor manufacturing and R&D. In a statement, it says about $150 billion will go to building out domestic memory chip production, and another $50 billion will go into research. And it says the plan is expected to create 90,000 jobs in the U.S. Music to the president's ears. Meanwhile, next up, we have some M&A action. CureVac here is soaring more than 30% after BioNTech said it's buying the company in a $1.25 billion all-stock deal. The two former rivals in the COVID vaccine race are now planning to team up to develop cancer treatments. And last up, I end with Oxford Industries. Shares are down 9%. This is the company behind Tommy Bahama, and they slashed profit forecast for the year. That is because it says it's now facing a $40 million hit from tariffs due to heavy exposure to China. And on top of that, people just aren't buying their Hawaiian shirts, leading to weak sales. John?
It's better taste. Better taste.
Thank
Yahara,
God.
thank you. I hope Dan Ives is not listening. Let's count you down to the opening bell with a trading diary. What to look for going into the weekend and through the next day or so. At 10 a.m. Eastern Time, Treasury Secretary Scott Bessent back on Capitol Hill. 1 p.m. a 30-year debt auction. Friday, UMich consumer sentiment. Tuesday, looking ahead to next week, retail sales, jobless claims going to be in focus once again, and a Federal Reserve decision. U.S. markets, of course, closed for the federal Juneteenth holiday, so look out for that. Day of closure next week. Still ahead then, later on this afternoon, 30-year debt coming to market. Lindsay Rosner of Goldman Sachs is with us around a table for a preview. Lindsay, it's good to see you.
Thanks for having me.
Let's talk about fixed income, the kind of risks out there. Lots of people worried about the long bond, the 30-year issue.
Yes, and that it's been trading more like risk asset than it has been trading as a flight to quality, which I think we're used to. The big thing here is just trying to figure out where fiscal is on the going forward. And what we've been telling clients is there's no need to go into the 30-year bond. There are a lot of bonds in the belly and the very short end of the curve. Stay there, and you'll be better served.
If you're worried about risk in treasuries, does it upend how we perceive risk elsewhere in corporate credit?
Absolutely, because treasuries are the base, which is what we then build everything off of. It's the risk premium above it that gets us to where spread risk is valued. So what we're seeing in the back end actually influences our views on back end investment grade corporates, for example. And as a result of what's happening in the back end of the rates curve, we've actually also stayed in the front end of the corporate curve and stayed away from the back end of the corporate curve.
Jeff Gundlach yesterday talking to Lisa. John's been talking to a lot about these comments, but he says it's certainly behaving differently than it was for the last 4 decades. Things are behaving differently. He's talking about how he won't touch the 30-year Treasury. Why do you think this is so different than what we've seen with skirmishes in the last 4 decades?
Yeah, I do disagree a bit in that this isn't something we've never seen before. Questioning the fiscal sustainability or unsustainability of the government is not anything new, and it has been a concern. What's different is the problem's gotten larger and larger and larger, and I think we're getting pretty close to a breaking point. And that's what the back end of the curve is telling you. That being said, there's always a right price for something. And I think we're getting fairly close in the back end to an area where it seems interesting. And certainly we've bounced off today. Yields are lower on the back of the economic data that we got that were surprising. But there will be a point in time where the 30-year is something that you want to own because we're putting in some real yield in the back end.
Let's talk about this economic data. Neil Dutta was with us moments ago, I'm sure you heard. Very worried about the labour market and continuing claims. I wonder what your perception of where the economy is right now is, and ultimately how that's shaping your approach to corporate credit more broadly.
Sure. So for us, the labor market is gradually softening, and I think each piece of that phrase is important. Gradual is comfortable, and softening is actually okay. It's when you have something that's more extreme, and I think that's what Neil is trying to suss through, is that are we seeing continuing claims at an alarming level? Are there things that we should be more worried about? The non-farm payroll last Friday, I think, was kind of the beginning in telling us that we are for sure in this softening episode. But the read-through for that, for us, is not that the economy is falling off a cliff. But it puts us in a position where we think it is important that the Fed begins acting. Agree with Neil completely. It's not at the next meeting. I know that he joked, he said that they should cut, but I don't think he really means that. We don't think that they should cut either, but I think it'll be really interesting to see the dots, and we are hoping that they at least that is really going to upset the market.
Speed matters, and it's not happening quickly. And I think that's important not just for policymakers, but also for corporate balance sheets. So can you describe the kind of corporate balance sheet strength that you see at the moment and how resilient corporate credit would be in a continued downturn?
Sure. So balance sheets look really good. All the things that we look at, metrics, leverage metrics, that they've termed out debt, thinking about just their business models, not all of them, but most of them are in really good standing. For example, we did have a fallen angel earlier this week with Warner Brothers. That's getting a lot of fanfare. That's the 5th largest fallen angel. But if you take that out of the equation, we've had a really solid investment-grade corporate market that's been extremely resilient. That makes us feel comfortable with the balance sheets. The problem that we're dealing with right now is spreads. So are you being compensated for the potential going forward economic softness? Spreads are really tight right now, and they are pricing in that everything's going to go fine. That's where we take issue.
Are all-in yields attractive enough to compensate for that?
They have certainly, in some of the backup we've had, gotten to levels that have hit triggers for some of our clients. We've seen clients saying that we're actually interested in getting into fixed income. We want to add, we're underweight our fixed income allocation. So yes, the all-in yield is good, but what we really encourage, and I think our clients agree is important, is active management around this exciting yield thing, because not every corporate is going to have a solid balance sheet on the going forward, and tariffs are happening. Maybe they're less than we thought, but they still are happening.
So dial 1-800 Goldman Sachs Asset Management is the pitch, I think.
Yes, that line should ring. Thank you.
Lindsay,
yes.
Thank you. Appreciate it as always. Lindsay Rosner there of Goldman Sachs Asset Management. The latest on fixed income as we count you down to an important debt issue later on this afternoon. This 30-year debt auction, very much in focus.
It's very much focused, especially if someone like me actually paying attention to the auctions. Lisa's not here, and we all care about what's going to happen with this more than $20 billion that's going to happen at 1 p.m. But it's because time and time again, people have been coming on this program saying it is a risk asset. And then we heard from Jeff Gunlock to Lisa yesterday saying a reckoning is coming, and it's something he doesn't want to touch.
Look, the good news this morning, so far at least, is that we had some data. Jobless claims still elevated, inflation downside surprise, and bonds did what they're meant to do. Behaved in a predictable way. Yields are lower by 6 basis points on 30s, 4.85. Tomorrow, we'll catch up with Max Kenner of HSBC, Aaron Kennard of Clear Harbor, Darryl Cronk of Wells Fargo, Greg Dacko of EY. Live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is
Do we
the
have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Futures lower, bonds higher after soft PPI. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Romaine Bostic. Matt Miller is on assignment. Bloomberg Open Interest. It starts right now.
Coming up, a Boeing airplane crashes in India. It's said to be the worst accident involving the plane maker's most advanced wide-body airliner. Meanwhile, reigniting trade tensions, President Trump plans to set unilateral tariff rates within the next 2 weeks, ahead of an earlier deadline. And software stocks in the spotlight after Oracle delivers an upbeat forecast. Next up, Adobe reports after the bell. Romaine, what else are we keeping an eye on?
Also keeping an eye on chip stocks. The Philadelphia Semiconductor Index looks like it's going to open lower. Micron, part of the drag, down about 0.8%, following news this morning that it's investing as much as $200 billion in U.S. chip manufacturing and research for an unspecified timeline, an investment that includes some projects already underway, Katie.
Meanwhile, back to that other big story, and that is that a Boeing 787 Dreamliner operated by Air India crashed shortly after taking off earlier this morning in Western India. The plane was heading to Gatwick Airport outside London with 242 passengers and crew on board. For more, we're joined now by Bloomberg's global aviation correspondent, Sid Phillips. Sid, this is a developing story. There's a lot we don't know, but give us the details as we know them right now.
Morning, Katie. So we're obviously still trying to figure out what happened and what caused the crash. But at the moment, we do know that this plane crashed shortly after taking off. It had reached an altitude of about 625 feet when it crashed into a residential building. We understand that there were no survivors on the plane, and we also understand that because it crashed into a residential building, there may be some casualties on the ground as well. So the death toll might actually go up beyond the 242 passengers and crew that were on board the aircraft. This is obviously, as you mentioned, the first ever fatal accident for the 787. I mean, this is Boeing's most advanced model and has been in service for over a decade now. But this is a sort of significant blow to both Air India and Boeing.
Sid, I know it's still early in the investigations. Of course, a tragedy just occurred just about 4 or 5 hours ago. But do we have any insights into whether Indian authorities are receiving help from U.S. authorities and European authorities as well?
So typically investigations are led by the country where the accident occurred in, but also the NTSB and the FAA said that they would be willing to help if required in the investigation. And typically NTSB, FAA, the manufacturer of the aircraft, in this case Boeing, as well as the engine manufacturer GE, would all be involved in the investigation and contribute towards the investigation as to what really went wrong.
All right, Sid Phillip there of Bloomberg News. We are continuing to keep an eye on what is still a fast-moving story. A lot of conflicting reports here about whether there are survivors or not. We will keep you posted on that. We are learning as well right now that in the U.S., the National Transportation Safety Board, in a post on the social media platform X, has said that it does plan to go to India to assist Katie in that accident probe.
Yeah, and to your point that this is a developing situation, this coming from the Ahmedabad police chief saying that 204 bodies have been found at the Air India crash site, also saying that there may be survivors, 41 are injured, but of course we will bring you those details as we have them.
All right, obviously a developing story, and we will continue to follow this. We are going to make a pivot to talk about some of the other movers going on right now in the pre-market here in the U.S., and that includes Micron. The memory chip maker just announced a $200 billion investment in U.S. chip manufacturing and R&D. The co-host of Bloomberg Technology joins us right now, Caroline Hyde. All right, Caroline, there's been a lot of headlines over the past few months of various chip companies making big announcements about what they plan to invest in the U.S. $200 billion, that's a lot of money. Where's it
is. And the question is how much of that is new?
Yeah.
And I think we'll see, they're saying, look, $30 billion is new when you're putting it into manufacturing here in the United States. Idaho is going to be the big area, second memory fab in Boise, Idaho. They're looking at Virginia as well, modernizing a facility there. They're already building a lot in New York. That was already scheduled. Already that money was being put towards that, a mega fab. High bandwidth memory, though, is the really interesting part. It's about the packaging part of the equation. They say that they're going to be packaging capabilities in the US to enable long-term growth in high bandwidth memory. That is basically what NVIDIA has been totally dependent on SK Hynix for. Samsung hasn't managed to get it up to speed. It's crucial for the next iterations of generative AI chips that we're getting through the pipe. So this is going to be crucial to have it here in the United States. But look, $30 billion is new. And what's also notable, Romaine, they are still getting CHIPS Act money. And I think that's always been a question as to how much the Commerce Secretary, Howard Lutnick, would hold that back. But they are still going to get some federal funding for all of this.
Yeah, CHIPS Act. I haven't heard that name in a long time. Let's talk a little bit about Oracle, too. That is one of the biggest movers pre-market, up nearly 9% before the bells ring. Of course, they reported, and it seems like AI infrastructure is still one of the hot plays out there.
And look, this is what makes these two stories so interesting together. The issue here is supply. The issue is we cannot live up to the scale of demand. That's why Micron is putting more money to work. This is why Oracle, Larry Ellison said on the call, we have got a new client who says they will take everything from us. Capacity, no matter where we put it. Europe, Asia, in the United States. He says he's never had an order like that. Their issue, the reason why actual fiscal fourth quarter cloud sales didn't live up to expectations, it's a supply side. They cannot build fast enough. So this is why they're still committing to Stargate, why they're still trying to bring more infrastructure on tap. They want to be one of the biggest cloud infrastructure players out there. Remember, they're a software company, but now they're an AI cloud compute offering, basically, and boy, is it going to drive their overall sales higher. About 70% increase they're expecting for the next fiscal year. Investors, they love it.
Yeah, that seems to be the logic working its way through shares right now. Caroline, appreciate your reporting. You can catch more from Caroline, Bloomberg Tech co-host, at 11 a.m. But let's get to that trade news now, because President Donald Trump has once again threatened to impose higher duties on dozens of trade partners. Here's what he had to say last night.
We're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
Now, while the U.S. dollar is at a low for the year, market reaction to the announcements like this, it's been less volatile, with investors recognizing Trump's use of uncertainty as trade leverage. Bloomberg macro strategist Simon White has been reporting on how tariff risks are underpriced in markets. And Simon, there's many different ways to take this sort of muted reaction that we've seen in the equity market. You could make the case that maybe investors are just fatigued at this point from the back and forth.
Quite possibly. I mean, the marginal kind of impact from, increasing noisy kind of headlines will leave people, obviously, as you say, fatigued. I think it's kind of interesting, though, the markets kind of went from zero to hero very quickly. In the wake of the initial tariffs, we had this very sharp sell-off, and now we're within a few percent of all-time highs again. Now, the tariff news is not as bad as was first feared, but it's still, tariffs are going to settle probably higher than they've been since the 1930s. So it's kind of like the markets went one step backwards and two steps forward, which is kind of remarkable. But I think actually a lot of that is to do with the rebound in excess liquidity. Excess liquidity is a dollar measure. It's the difference between real money growth and economic growth. And what's basically happened is because the dollar has weakened, it's meant liquidity produced in other parts of the world in dollar terms is now worth more. And that's actually created this rebound in excess liquidity. And I think that's what's helping to keep the market more supported than otherwise you might have expected.
It gets to this idea of a floor being put into the market. It's certainly here on the U.S. side, Simon, but when we talk about what the potential upside is, whether you claw back to that all-time high on the S&P 500, does that trade risk have to be taken off the table at some point?
Well, I think the market, if it's shown as anything in recent years, is when it gets to new highs, it often does breach them. And then you get the FOMO kicking in. You'll get people saying, right, I've maybe got this completely wrong. And that money then chases the new highs and it becomes self-fulfilling. I think this particular instance in the bull market, I think it's harder to fashion an argument, even when we're so near new highs, that the bull market is ready to kind of like continue unfettered. Just given the backdrop, as I say, the tariff backdrop alone is telling you that the situation is not as good as it was a few months ago, right, where we're going to end up. And the policy uncertainty, plus a number of other factors, as I say, liquidity is rebounded, but it's still not as high as it was before. You really just don't have the set circumstances that were going to provide such a tailwind to the market as we had before.
Well, Simon, in your view, what is the catalyst that we're waiting for? Because we were having this conversation at 6 in the morning. We've had pretty good economic data this week. We've had back and forth on trade, but the direction seems to be positive. Even the Treasury auctions that we were all in a twist about seem to be going pretty well. And with all of that in mind, to see the S&P 500 falling now set for a second day here, I mean, what is the catalyst that this market would want to see?
I think, well, you just had your previous piece there. I mean, the tariff situation is still live. So although the latest estimate is maybe 15% average tariff rate, and again, that is still as higher than it's been since the 30s, we don't actually know 100% yet. So that level of uncertainty really will keep people from sort of pushing the buy button with abandon. So I certainly think that's holding people back. But as I say, overall, the general environment is really just not as propitious for stocks as it was before. That's not to say the market won't try and make a new high, but I really think it's going to be hard to do it with particular gusto. And as I say, even if it does go through new highs, and part of that's momentum driven because people have FOMO, I really think that even then that rally is on pretty thin ground.
Yeah, it just seems like we move from the cycle of FOMO to wait and see and back again. Our thanks to Bloomberg's Simon White. Meanwhile, let's get a check on futures right now. About 20 minutes ago, until those bells ring, you can see pretty quiet when it comes to the S&P 500 right now. A lot of the action is in the bond market, if we can pull that up. And as you can see, 10-year Treasury yields down about 7 basis points at this moment. Romain, once again, it feels like a lot of the action is in the bond market rather than in the equity market.
Yeah, a big drop. And we talk about just how much yields have come down. I think we're down something like 15 basis points just on this week on the 2-year, 11 or so on the 30-year. And we have a big auction later today. The economic data, we got another benign inflation report on PPI, but I thought that jump in jobless claims that we saw, highest level since 2021, that's got to be of concern, at least if you're a bond investor.
Absolutely. I mean, we didn't see that kind of stories show up in last week's NFP report, but you know, you keep adding together all these weeks and maybe it'll start to show up. I did also want to point out the dollar. We don't normally talk about the dollar at like 9/11 in the morning, but we're close to the lowest level in 3 years on the Bloomberg Dollar Index.
Yeah, and it's been a big driver. I think Simon White kind of touched on this inarticulately, but it gets to this idea of just how much the dollar does fold into the equity trade here as well. We're going to talk about some of the individual movers on the day. We talked about Oracle, Micron. How about BioNTech? A company buying a former COVID vaccine rival. Details on that deal coming up next. This is Bloomberg Open Interest.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Time now for high interest, a look at what's making headlines around the world, and we start in Los Angeles. Downtown LA calmer today with a heavy police presence designed to prevent a repeat of the unrest that has already led to about 600 arrests since the weekend. The Los Angeles Police Department last night using horses and less lethal weapons to clear out protesters. Protesters upset over the questionable tactics used by federal agents to enforce immigration laws. Those protests now spreading to other cities, though, including Spokane, Washington, where the mayor there issued a curfew and police made 30 arrests. Meanwhile, Warner Brothers Discovery's decision to split into two companies is a sign of a broader shakeout across the media industry. That's according to Netflix co-CEO Greg Peters. He sat down earlier in an exclusive interview with Bloomberg editor-in-chief John Micklethwait, where he talked about the increasing dominance of on-demand services and the expansion of the streaming giant abroad.
There's a lot in Asia. We're just younger in Asia. We've got more work to go do to improve the offering there. You know, we think about, oftentimes in countries you start at a center in terms of the content and the offering and how it's presented to market, and then you start to expand out. And there's many countries that we've got a lot more room to grow in Asia.
Well, back here in New York, if you're a renter in Manhattan, my condolences. Apartment rents hitting a record high last month and shows no signs of stopping. That's thanks to the city's new broker fee law. Demand is also expected to soar as a large share of existing leases expire and students and recent graduates flood into the city. The median price tag on new Manhattan leases in May, more than $4,500.
Well, in less depressing news, shares in BioNTech and CureVac in focus this morning. That's following the announcement that the German biotech giant agreed to buy its former COVID vaccine rival in a $1.25 billion all-stock deal. Bloomberg health reporter Damien Garde joins us now at the desk. So, Damien, these two companies were rivals for decades. Why are they combining now? What does that bring to these companies?
It's interesting. It's kind of a sliding doors moment for these two firms, which, as you've mentioned, have been working on mRNA since long before it was a household term. It was kind of a speculative idea in biotech. And back before the pandemic, they took basically forking paths scientifically. BioNTech made one decision in terms of how it approached mRNA. CureVac bet on the other decision. And what we saw is BioNTech, along with Pfizer, developed a vaccine that made billions of dollars and was put into the arms of millions of people around the world. CureVac never managed to actually get its vaccine off the ground. Cut to now, BioNTech has soared, both in terms of its market value and its success in the clinic. CureVac not so much, such that the former is in the position to buy the latter in an all-stock transaction. So it is kind of it would prove to be a somewhat whimpering end for CureVac given the length of time they've been in this space.
By the way, Sliding Doors, one of Gwyneth Paltrow's greatest movies ever made, by the way. So I like the rom-com reference. When we talk about what they're actually developing, these cancer immunotherapies, is it for a specific type of cancer?
There's a multitude. So both firms have been working on, with mRNA and with other technologies, immunotherapies that would treat tumors all over the body based on different genetic signatures. So what BioNTech is signing up to get from CureVac is basically odds and ends in that company's pipeline that would complement, I think, the work they're already doing. CureVac, it's worth noting, had sold off its vaccine capabilities to GSK last year, so they remain a cancer-focused company.
Situate this deal in the political backdrop because Bloomberg News reported last night that the Health and Human Services Secretary, Robert F. Kennedy Jr., has appointed a new panel for its vaccine panel, 8 new members. What does that possibly mean for these companies and others in this space going forward?
It's an interesting time to be in messenger RNA because among the 8 people that RFK Jr. appointed to this very powerful panel that serves under CDC are people who've expressed not just skepticism, but have advanced easily debunked theories about the safety of mRNA. They will soon be empowered to set U.S. vaccine policy functionally. They don't decide what gets approved or rejected.
Wait, I'm sorry, it's unsafe? Is that what you said?
I'm sorry. So among the members of the new CDC panel are people who have advanced, debunked theories about the safety of mRNA vaccines, including, I mean, it's not worth digging into probably in live, but
I didn't mean to interrupt you.
No. So there's legitimately concerns, both for the companies and from public health officials, that what this could mean for vaccine policy in the U.S. going forward as to which vaccines are recommended for which populations.
All right, well, it'll be really interesting to see how this combination navigates that environment going forward. Really appreciate your time. That is Bloomberg's Damien Garde. He covers health for us over at Bloomberg News. Let's take a look at some of the other movers on our radar as we count down to that opening bell. I want to talk about Mattel here, rising on a collaboration with OpenAI. I wasn't quite expecting this one.
Yeah, so I'm confused. Are they going to use AI to make the toys, or is AI going to be embedded into the toys in some way or another?
These are a lot of great questions. What does it mean for your Barbies? I'm not sure, but we'll bring you more details.
They're going to be more expensive?
Maybe they're going to be more intelligent, too. Let's also talk about Voyager. It's a space firm. It's extending gains after it raised $383 million in an upsized IPO yesterday. Those gains continuing today. It rose 82% yesterday.
Yeah, and it's cool too also to see just kind of the reopening of the IPO market overall.
We should also talk about GameStop, shall we?
Do we have to?
We do.
Okay.
Well, it's falling 17%. It has plans to offer $1.75 billion worth of convertible bonds.
Yeah.
This would theoretically make the video game retailer one of the year's biggest issuers of the equity-linked securities strategy. Has also been big in that space.
And of course, they're trying to move deeper into that Bitcoin space. When we come back after the break, BMO's Carol Schleif talking about the wall of worry for investors as markets see more muted reaction to economic data and Washington policy. This is Open Interest.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Up to the minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I think the biggest threat to the stock market has been our fiscal profligacy, something like the big beautiful bill, because that was always going to be a threat to the safety and security of the bond market, whether investors would tolerate what's going on. And right now it seems like both globally and domestically that the world's okay with kayfabe, kicking the can down the road. We're going to suspend reality. It's okay.
That was Paul Tudor Jones speaking with us yesterday. And let's keep that conversation going with Carol Schleif. She is Chief Market Strategist over at BMO Private Wealth. So, Carol, Paul Tudor Jones, his view is basically it seems like markets are okay kicking the can down the road right now. That seems to align with your view that stocks here, they can continue to climb this wall of worry.
I do think from an equity market perspective, that's pretty accurate. But on the other hand, I do think we're watching very closely what's going on in the bond market. And because you've seen some hiccups this year, we've kicked that can down the road for decades, basically, we and a lot of the other industrialized countries. But you're starting to see some objections, particularly from those longer term fixed income investors, that they may not be so happy doing that. So it's a very delicate balance. But for now, especially in the equity markets, you know, the U.S. markets have round tripped. We're back to basically flat for the year after 2 very solid years. But economically, there's still a lot going right underneath the surface, even while everyone's waiting for another tariff shoe to drop. We haven't seen it come through the numbers in a big way.
Are the markets, the bond market and the equity market, Carol, are they singing from the same hymnal here?
I think you've got different investors with different objectives, because equity markets are looking for gains. That's why people buy equities, is hoping for that long-term capital gains. On the other hand, the fixed income markets, particularly as you go out to those 10, 15, 20-year sorts of maturities, they're operating like creditors. And so they're a lot more concerned about the balance sheet than the income statement.
All right, Carol, we are just getting started. Carol Schleif is sticking with us through the opening bell, and here's your setup. Minutes away, you can see the S&P 500 down slightly. So is the NASDAQ 100, the Russell 2000, those small caps a little bit more. We'll walk you through all the action up next at the open. This is Open Interest.
For Trump to have been, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging.
Yes, exactly.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading on this Thursday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and we're looking at a market that's really deciding what to do near record highs. You can see the S&P 500 now down about 0.2% as we await these opening bells. You can hear them ringing right now. We ended above 6,000 yesterday, even with that drawdown, breaking 3 straight days of gains. Now the question is, where do we go from here? We're still very much getting that back and forth when it comes to tariffs. We've gotten better than expected inflation data this week when it comes to CPI, when it comes to PPI. We'll see what that means for the Fed next Wednesday. We also have some auctions when it comes to the bond market. Yesterday went okay. We'll see how 1 p.m. goes today. But as we focus on this equity market bell ringing, Romaine, who do we have an eye on?
Well, we're keeping an eye right now on Micron, I believe, and some of the chip stocks here. Micron is said to be investing $200 billion in U.S. chip manufacturing and research in plans to create an estimated 90,000 direct jobs. Not the right ticker on the screen. Micron down about 2% at the open.
Well, you had an eye on Boeing, so let's talk about that a little bit more, because a Boeing 787 Dreamliner, it was operated by Air India. It crashed shortly after taking off earlier this morning in Western India. That plane was heading to Gatwick Airport outside London with 242 passengers and crew on board. And as such, we're also taking a look at some of its suppliers right now of Boeing. You can see Spirit Aerosystems taking a little bit of a leg lower this morning. So too is General Electric, and you also have Triumph Group down a little bit as these markets open, Romaine.
All right, let's bring Carol Schleif back into the conversation. BMO Private Wealth Chief Market Strategist here. As we look at somewhat fractional open lower here on an S&P 500. Carol, an S&P 500 that's still trying to grasp back towards that record high, 6144 and change. We're about 2% away from that. And I do wonder, given the somewhat holding pattern that we've been in over the past few days, what is that catalyst that potentially gets us there?
Well, probably near term, not much, because we are in quiet period waiting for the Fed meeting next week. Don't expect a lot out of the Fed meeting other than maybe some commentary. The interest obviously will be in the Q&A at the press conference after the meeting, not necessarily anyone waiting on tenterhooks for the decision itself. But catalyst for the short term, we'll have to basically wait until we start getting earnings announced in 3-4 weeks. And there's not a whole lot to go in here other than announcements, because as you talked about in the lead up, you've got the back and forth on tariffs still in process. Who knows if we get some conversation out of the G7 meetings that start this weekend. But there's a lot of potential for news flow and not anything really economic to hang our hats on too much in the very short term.
With that in mind, I mean, we were talking about this with Simon White. It feels like we cycle through FOMO to wait and see to FOMO again. Right now, it feels like we're very much in a wait and see sort of vacuum here, Carol. And with that in mind, what is your highest conviction in this market?
I think the highest conviction is that diversified portfolios have been working, because for years we have tried to talk to investors about being diversified, and all anyone wanted to own was U.S. And so while you've got U.S. within a couple % of all-time highs, you've got a lot of those international markets that have really snapped back, done very well this year. The TSX, for example, the Canadian exchange is at all-time highs. So you've got a lot going on elsewhere. So having that diversified portfolio, making sure you've got toes in a lot of different camps, if you will, just to make sure no matter which way the swings, the news swings, because you do have a lot going on globally as well. You've got a lot of interesting things going on in developed markets. The EU is making some big investments in infrastructure. You've got things going on in China, things going on in Japan. So it's really a great time to be able to step back, keep your exposure in the U.S., but also look globally.
With regards to that exposure in the U.S., I am curious about kind of the health of the AI trade, and more importantly, of chip stocks in particular. You look at where we were off of those lows back on April 8th, and at the top of the leaderboard, it's just a slew of those big tech names, primarily names that are in the chip space. Is that still investable? Is that still of value?
We definitely think you still want to have some of that exposure in your portfolio, but keep in mind you get a lot of that exposure just by buying a passive index because of the preponderance they are of indexes. But yeah, we think there are a lot of things that we don't think the growth trade is through. We think you've got the opportunity for high quality growth in here. When you look at the private sector spend that's been going on in terms of continuing to build up that AI, the quantum, the data center, the move to the cloud, there's a lot of that activity going on. And employers, as they try to figure out how to absorb the cost of tariffs, because they know consumers don't want to see it passed along, as they try to figure that out, a lot of that, it depends on continued technological deployment throughout their infrastructure and their processes and procedures. And you're seeing it some in the hiring market where you've got some softness at the edges.
Absolutely. I mean, that takes us back to the claims data that we got this morning. Carol, great to spend some time with you. That is BMO Private Wealth's Carol Schleif. Meanwhile, let's take a stock of this market right now with the S&P 500 trading on a nice edge near 6,000. You actually have pretty bad breath when you take a look overall. The S&P 500 down by about 0.3%. We do have some heavy hitters in the green when it comes to those 132 names that are positive. Right now, right at the top, you have Oracle. Remember, this company reported earnings yesterday showing that demand for AI infrastructure remains robust. That's good for a 9% gain. You also have Microsoft, NVIDIA, Netflix, Eli Lilly trading places here up at the top, but they're fighting against quite a strong current when you consider that you have Amazon, Meta, Alphabet, Tesla, all lower this morning. So a real push and pull in this market. Let's take a look at how that looks at the sector level as well. Up at the top, you do have utilities up there. That looks a little bit defensive this morning. You also have technology still managing to go green, as too is healthcare with news of that BioNTech and CureVac deal. But then you take a look at the bottom, a sea of red as you go down the list. Right at the bottom, you have energy, industrials, and financials is your biggest loser today, Romaine. That sector down about 0.8%.
All right, let's take a look at chip stocks. The Philadelphia Semiconductor Index rallied 2% on Monday, 2% on Tuesday, pulled back yesterday, and pulling back here on this Thursday morning. Micron, one of the biggest drags. This after it made an announcement about a $200 billion U.S. investment here in the great United States of America. Jake Silverman is a semiconductors analyst for Bloomberg Intelligence, and he joins us right now. And we need to be very clear about what we're talking about here with that $200 billion. We're talking about an increase in what was already previously announced of roughly about $30 billion, an investment to, I guess, open new plants or expand plants in Idaho and in Virginia. Is that what we're talking about here?
Yeah, that sounds right. I mean, the Micron strategy has been to increase their domestic supply in the United States. They've already committed to fabs in New York and Idaho, and this is really just an extension of that, both in terms of CapEx, but also R&D as well.
And so talk to us about the timeline here. I mean, $200 billion, that is a big, headline figure, but how many years are we talking about to spread out that investment?
Yeah, I think Micron's been pretty clear this is an investment that's probably going to take place over several decades. If you look at the cash they have on their balance sheet and the reasonable amount of free cash flow they can generate over the next several years, it's really an investment that's going to take place over a very long time span. So not necessarily something that we're going to see overnight.
When I think of DRAM makers, memory chip makers, I think about just how heavily cyclical that market is. Is that smoothing out? And if not, when you make these types of investments, how can they be sure that that demand's going to be there once these plants are up and running?
Well, yeah, I mean, over time, the demand for memory has continued to grow fairly consistently. Obviously, you know, plus or minus a cycle, right? But whether or not it's smoothing out, it's a little unclear. I think high bandwidth memory demand for products in AI, obviously that's you know, a structural driver. We still expect there to be cycles over the long term, but demand for memory will likely continue to grow over a very long period of time. And so I think it's reasonable to expect that these investments that as they build it, the demand will eventually be there.
Yeah. All right, build it and they will come. Jake, great to get some time with you. That is Jake Silverman of Bloomberg Intelligence. Now coming up, as we've been discussing this morning, an Air India Boeing 787 aircraft with over 240 people on board crashed this morning in Western India. We'll talk about it next. This is Open Interest.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Joby Aviation getting downgraded over at Cantor because of its valuation. The firm also says that the EV aircraft maker has the highest cash burn in the industry, not what you want to see. Shares down about 4%. Next up, Stifel resuming its coverage of Freshpet with a buy rating. The firm says that the company has a long runway for growth. That's good for a 1% rise in shares. And we end with SoFi Technologies getting initiated with a buy over at Stephens. The firm says that the online personal finance company has strong growth prospects, not showing up in shares this morning. Romaine, shares down about 1%.
All right, we do have to go back to this morning's top story, and that is, of course, that horrific aircraft crash in India at about 1:39 p.m. local time. That's roughly about 4 a.m. here on the East Coast. A plane crashed there in western India. Over 200 people have been found dead at the crash site, a Boeing 787 Dreamliner operated by Air India that was bound for London. That flight crashed shortly after taking off in what was now the worst accident involving Boeing's most advanced aircraft. Now, officials haven't yet said how many of those people were passengers, crew, or area residents. Police say there may be survivors. Brooke Sutherland covers Boeing for us here on the U.S. side, and she joins us right now. And obviously, there's a lot that we don't know, Brooke, about the cause of this crash, and of course, it will take a long time. We do know that the NTSB, the U.S. agency that investigates flight crashes, is going to India to assist in this investigation. What do we know so far right now?
We don't know very much right now, and it is very early days, and like you said, I mean, it will take a while to figure out what exactly happened here. We do know that this particular plane was over 12 years old, which means it's been flying for a while. There are many 787 Dreamliners flying in the world, and this is the first crash that we have had for this plane. Now, there had been earlier issues with it, but not a crash. And so we'll learn more as we dig into this, but obviously it comes on the back of a series of safety incidents in the aviation world that's really sort of rocked this bedrock thought that, this was one of the safest modes of travel. And I think, that is going to be impactful, especially as we look at the travel demand environment, already feeling some pressure in the U.S. just from inflation concerns, consumer spending pullback, and then inbound travel internationally into the U.S. has also taken a hit just from some of the political positions of the Trump administration. So this will just sort of compound some of those issues facing the travel market going forward.
And it's worth pointing out that the Paris Air Show is scheduled to start on Monday. Boeing's CEO, Kelly Ortberg, is scheduled to attend, or had been as of this morning. And Brooke, put this into context. You touched on some of this, but Boeing, unfortunately, is no stranger to safety incidents. So what does this say about the company's path forward and how they're going to address this?
I think it's too early to say that this is a Boeing issue. Like I said, this plane has been flying for about 12 years. And so at this point, there's just a lot that we don't know, in terms of the maintenance history of this plane, what the pilots did, what the circumstances were. And so it's too early to say, whether or not this is something that will ultimately make its way back to Boeing. But you were obviously seeing the stock reacting today. And I think that reflects, like you said, that this is not the first safety incident that has happened in recent years with a Boeing airplane. The most recent, of course, was that mid-air blowout on an Alaska Airlines flight. The company was just starting to get to the point where it was moving beyond the fallout from that accident, really ramping up jet deliveries and getting its production line back, to the point where it needed to be to flow properly and ensure that, the kinds of mistakes that led to that mid-air blowout didn't happen anymore. And so certainly this comes at, not a great time for Boeing.
And I am curious, too, and it's also kind of this idea, too, that Boeing was not only sort of trying to recover from the optics of that, but of course we go back to 2018, 2019, the Lion Air crash, the Ethiopian Airlines crash as well, which led to a lot of questions about Boeing's management. I know they have new leaders, and again, not drawing any connections to what happened earlier today, but there is this idea, this perception in the minds of investors and potentially in the minds of travelers about what Boeing is and whether Boeing planes are safe. And I do wonder how Kelly Ortberg navigates that now that you have yet another fatal crash involving one of his planes.
And I think ultimately, I mean, Airbus has also been clear that these accidents are not helpful for Airbus either. While they have involved Boeing jets, it does sort of create a perception that builds on itself that air travel is not safe. And that's not helpful for anybody in the aerospace ecosystem. And, you know, the engine makers, the parts suppliers, they've all talked about that this industry only works to the extent that it has if everybody feels comfortable getting on an airplane. And so it certainly is, you know, a public image crisis that Boeing itself will have to grapple with and really need to reassure the traveling public that its airplanes are safe and it's okay to, you know, board them. But this is really an issue for the aerospace ecosystem writ large, including the airlines, and really just communicating that to their passengers and easing some of those fears that people will have.
Yeah, Brooke, you do make the good point. Again, it's too early to say whether or not this is a Boeing issue, what exactly went wrong, but that brand perception, the potential damage there is certainly real as well. Appreciate your time this morning. That is Bloomberg's Brooke Sutherland, and we will continue to monitor this developing story and bring you updates as we have them. This is Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres June 13th, only on Bloomberg Television.
Welcome back to Open Interest. Let's get a quick check on some of the stocks that are moving here on this Thursday morning. And let's start off today here with what's going on with United Natural Foods. The share is down for a fourth straight day, now down almost 27% this week. We had learned on Monday about a hack of the food supplier. This is the major supplier for Whole Foods here. They have not yet resolved it. They are apparently working with their cybersecurity provider to try to get things under control. That is moving to the downside. When you talk about some of the other big movers on the day, I want you to take a look at two here right behind me. That has to do with Oklo. Just yesterday, this is they announced a big contract with the Department of Defense. The shares rallied more than 29% on the day. They're pulling back today after, well, they decided to move into the secondary market, a dilutive share offering. That's moving the shares lower by about 2%. Dilution also the story of the day for GameStop, moving down about 17%. A convertible bond offering there, presumably to be used to shepherd that Bitcoin strategy moving forward. Meanwhile, you have two interesting stories in the tech space here. We have Adobe. They're set to report earnings after the bell tonight. This is a bit of an AI play, but keep a close eye on their pricing power. That has been a big driver of this stock, a big driver of their bottom line. Just yesterday, also in the AI space, we did hear from Oracle having one of their best days going back a couple of months, and at 197.92, I believe that is a record high. AI infrastructure build-out. That seems to be relentless. And right now, Katie, it seems to be going strong. Unfortunately, right now, you can see on the red behind the screen on me, that is not quite enough to lift the broader market here. But on an individual stock basis, Katie, Oracle is the star of the show.
Yeah, let's go back to that, Green. Let's go back to Oracle and talk about it now with Anurag Rana. He is senior analyst for Bloomberg Intelligence. Oracle, your biggest gainer by far in the S&P 500 right now. And it seems like the takeaway, Anurag, is that demand for AI infrastructure, it's still super hot right now.
Yeah, I mean, that is the biggest theme right now is the infrastructure investments that are happening around the world for AI. And, we already know that Amazon's a big player, Microsoft's a big player, Google's a big player, and, Oracle with their cloud infrastructure is really making a lot of movement over here because they're getting work from everybody at this point. The backlog is huge. They are investing a lot more to expand their data center. And there aren't that many companies around the world that can, afford to spend, let's say $25 billion per year to expand their data center footprint. So that's really helping Oracle, and I think that's a story that's going to go on for, at least the next few years.
I am curious what the secret sauce is. I mean, obviously we know their involvement in Stargate, as well as some other projects. There was a big headline earlier today on the Bloomberg terminal about how Temu, seeking to deal with some of the trade tariffs, is enlisted Oracle's cloud domestically here in the U.S. to aid their efforts here. Why are these folks choosing Oracle specifically?
Yeah, I told you the secret is $25 billion. This is a company extremely profitable that can go out and spend and expand data center. That's a number you can't really expand, think about any company in the US do that. So when we know the demand is really high, companies that have capacity to invest. So Oracle makes a lot of their revenue from, their database business, from their applications. Very high margin business. Their operating margins are, adjusted operating margins are in the 40s. So they generate a lot of cash flow and they have the ability to invest. And that's really what's happening here.
So AI infrastructure, that demand's still very strong right now. What about for software? Push ahead to Adobe after the bell. That's a company that really needs some good news.
Yeah, this is the most controversial stock in software, honestly. And, we are hoping that they don't reduce their guidance. If they're able to beat their numbers and even take it slightly up, I think investors will gain some confidence. But there is so much, controversial, you could say, stories around this, bull-bear arguments about what's going to happen to their creative business. We think it's going to be fine, may not be able to grow as fast as it has historically, but, widely debatable stock. And honestly, it's going to be a very interesting print today.
Yeah, absolutely. That is Anurag Rana of Bloomberg Intelligence with the preview. Adobe shares down 7% year-to-date on a total return basis, have rebounded strongly since their lows in April, but still in need of some good news.
I would like to point out, I host a show called The Close,
I've
which
heard of
comes
that.
on. We're actually going to cover Adobe earnings. And also
I would imagine.
Another big earnings report, too, is RH. This is the company formerly known as Restoration Hardware, gigantic couches.
Heard of that one, too,
at gigantic prices. So you get a read on consumer spending as well.
Yeah, that's all coming at 4 p.m. today. You're opening and closing the markets today.
Wire to wire, Katie. You can stick around, too. You're more than welcome.
I will be watching fondly from afar.
From your big Restoration hardware couch?
Exactly, from my giant couch in New Jersey. Coming up in the next hour, we're going to continue to follow these markets with Marianne Bartels of Sanctuary Wealth. She'll explain to us why she just raised her S&P 500 price target above 7,000.
This year?
This year. Well, maybe in the next 12 months. We'll get the details from Marianne next. That's her 12-month target. We're also going to talk about the resurgence in nuclear power with the nuclear physicist and the CEO of Nano Nuclear. His name is James Walker. All of that coming up in the next 60 minutes. Don't go anywhere. This is Open Interest.
Are you worried about your orders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. It's a chaotic scene in northwestern India where a passenger plane with 242 people on board crashed just after takeoff. The Boeing 737 went down in a residential area in the city of Adibabad. Officials say rescuers have found at least 204 bodies so far. Transportation correspondent Chris Van Cleve.
The plane almost looks like it's descending to land. The landing gear is down. That would be indicative, essentially, that this 787 failed to generate enough lift to stay in the air shortly after taking off.
Hassan Shahidi heads the Flight Safety Foundation.
It's still very early in this process. Before investigators can really get in there. It's a very difficult, challenging crash site with residential area, and it's going to take some work to be able to clear that to make it safe for investigators to actually go in there.
Boeing shares down 5% at the open. The U.S. is pulling some non-essential personnel from the Middle East over fears of a new conflict. Correspondent Ed O'Keefe.
Multiple sources tell CBS News U.S. officials have been told Israel is fully ready to launch an operation against Iran. In response, sources say the U.S. anticipates Iran could retaliate against certain American sites in neighboring Iraq.
Iranian officials say they are not going to give up what they believe is their right to enrich uranium used to make nuclear weapons. All of this as the U.S. and Iran negotiate a new nuclear peace agreement. Officials say at least 2 people have been swept away in flash flooding in San Antonio, Texas. Others reported missing after 6 inches of rain fell. KENS TV's Rania Kaur.
They were actually on top of trees. They had gotten out of their cars and had climbed up to higher ground to escape the floodwaters.
A mystery in New York City, where police say several NYPD squad cars went up in flames overnight. CBS's Christina Fan in Brooklyn.
Some were charred beyond recognition. Others look like they had their windows deliberately shattered. Detectives and investigators with the fire marshal's office are here and are working to determine the point of origin and how this fire was set.
One of Sean Combs' ex-girlfriends is returning to the stand in his sex trafficking trial today for cross-examination. CBS's Jerika Duncan from the courthouse.
There were a number of texts that we heard from Jane where she set up the hotel nights,
helped to set up the payments for them, and even purchased supplies for the escorts. Jane also said at one point in court, "I resent him," referring to Combs, "for knowing how much I loved him and knowing I could not say no to him."
Dow down 168. This is CBS News. President Trump set to roll back the clock on EVs.
The president is expected to sign a resolution passed by Congress to stop California's first-in-the-nation rule banning sales of new gas-powered cars by 2035. Congress took that action over the objections of the Senate parliamentarian and the Government Accountability Office, which said Congress did not have the authority to do so. With some of the nation's worst air pollution, California has been able to seek waivers for decades from EPA, allowing stricter emission standards than the federal government's. A spokesperson for Governor Gavin Newsom said, quote, "We're fighting back." Michael Toscano, CBS News, Washington.
Both supporters and detractors turned out for President Trump's first visit to the Kennedy Center since he took office in January. Mr. Trump, unfazed by reports some members of the Les Mis cast were boycotting.
I couldn't care less, honestly. All I do is run the country well.
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio. Streaming live as well on YouTube. So head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us on your smart TV. You just search Bloomberg Pursuits, and that's where you'll find us. Coming up, we're going to get the latest on these markets. We're going to check in with Shelley Bancho. She's Bloomberg Managing Editor for Global Business. She's going to give us the latest reporting we have here at Bloomberg News on this crash in India. Jeffrey Cleveland, Chief Economist at Payden & Regal. We'll get his thoughts on some of this economic data. Again, we got some PPI data today that kind of confirmed what we saw yesterday with the CPI, which is there's not a lot of inflation in this economy, at least not yet. So we'll get his thoughts there. Michael McKee, we'll get his thoughts on the economic outlook as well from Bloomberg Economics. Dan Ives is going to check in. We'll get the latest news on Tesla, Trump, Musk, all that kind of stuff that's impacting global big tech. But right now, let's go to John Tucker and get a Bloomberg Business Flash. John.
All right, guys, this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Let me start with the money market betting. Boosting bets on Fed reductions this year. They are projecting higher odds of a first move from the Federal Reserve in September. Of course, this comes after the latest data, more tame inflation data. Producer price index rising just 0.1% from a month earlier, less than expected. The dollar also falling to its weakest level in 3 years. The 2-year yield, more policy reactive. That is at 390, down just about 5 basis points. And worst performing stock in the S&P 500, probably not surprisingly, shares of Boeing right now, down 4% after the crash. Also GE, which made the engines, not far behind. Shares of GE right now down 2.3%. Meantime, economist Francis Donald at RBC says growth is going to be slow at best.
And even though there is wage growth, it's decelerating. So this is a muddle through type of environment, and that's going to be more problematic than actually sometimes I would prefer a short, quick reset recession and a reacceleration. This is not what this is.
And auction today, the long bond 30-year yield right now ahead of that, 5 basis points lower. That probably doesn't have anything to do with the auction today. 486 right now. The Treasury selling $22 billion of 30-year bonds. That's at 1 p.m. Wall Street time. And at the time of spiraling deficits, this is going to be closely watched. See if investors are losing any interest in buying U.S. debt. They had a 30-year auction last month with kind of, I'll call it tepid demand. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, happy Thursday, happy Friday Eve, everybody. Alex Steele alongside John Tucker and Paul Sweeney. All right, he's waving. Okay, so we got through the economic data.
Yep.
Let's take a look at some of the stocks in the move today. I'm Alex Steele with Paul Sweeney. We're joined now by Bloomberg's Isabel Lee. Got to start on Boeing. What's the latest and what's with the stock?
The stock is down 4.3%. That's the biggest decliner is an S&P 500. So again, of course, this comes after the fatal plane crash that killed more than 200 people. There were no reports of survivors. And the Boeing 787 Dreamliner was operated by Air India and bound for London, and it crashed shortly after taking off. And this is the worst disaster involving Boeing's most advanced twin-aisle aircraft. So shares of its suppliers, General Electric and Aerosystems, also down by more than 2%. And based on the number of people on board, this would be the worst commercial air crash since 2014, according to Aviation Safety Network. It's just really scary, and Boeing has had a string of accidents since 2018 and 2019.
Yep. You just kind of thought they were turning the corner.
Yes.
The stock was kind of turning the corner, putting some of that in the rearview mirror, and here we go again. So we'll have to see how that plays out. What's happening with Oracle?
Oracle is rising 12%. This is an all-time high. So this comes after the company projected cloud infrastructure sales will jump more than 70% in the current fiscal year. So obviously, this got investors excited, boosting enthusiasm. So the company is long known for its database software, and it's been gaining traction in its effort to really just become a major player in the business of cloud computing, which is, to put it simplistically and basically, it's just really renting out computer power and storage. So they've been targeting clients focused on AI work, and they found their niche in renting out AI-focused computer power as other industry giants like Amazon has really been stretched to the limit. So the past month, the stock has climbed 17% as investors just really grow more optimistic on the stock.
Yeah, we broke earnings as they came out. An initial reaction to the stock was actually lower, but then this was the sentence that I had found in the report. We expect total cloud growth rate applications plus infrastructure will increase from 24% in the full year of 2025 to over 40% in the full year of 2026. The cloud infrastructure growth rate is expected to be over 70%.
Yes, that's a wild number, and the stock ticker is ORCL.
All right, yeah.
Just keep on giving the cloud, the AI thing. Everybody's making money.
Yeah, but it seems like it's the AI cloud infrastructure part now where a lot of the focus is being turned to. All right, let's go to Oxford. So Oxford makes the Tommy Bahama stuff, right? Lily Pulitzer.
Tommy Bahama, Lily Pulitzer, Southern Tide, the Bonnet Company, Duckhead, Johnny West, and Jack Rogers. None of them sound familiar to me, actually.
See, those are all in my wheelhouse.
I was like, you know what? That's okay, Isabel. That's A-okay for you.
It's a Jersey Shore thing, dude. So you just, I mean, you're going where tomorrow?
Yes.
India.
Oh, yes, I'm going to India.
That's not Tommy Bahama, I'm telling you.
Yeah, it's not. It's just summer
and
there.
You know what,
40
Paul,
degrees
you can
Celsius.
Keep it there.
40 oh my
degrees
God.
Celsius.
I'm doing the
I don't
math
do
here in my
Fahrenheit.
head here. That's
probably 190.
Yeah.
Yikers. All right.
Okay, so this stock, OXM.
Oh, right. Let's get to that.
It's down by nearly 10%. The company slashed its profit forecast for the fiscal year. They reported EPS close to estimates and sales above estimates. So Truist said that they remain cautious on Oxford's outlook, especially given an uncertain second half of the year. Citi said it's not surprising that they cut guidance again due to tariff, and especially considering the company's exposure to China. I feel like this is the reason over and over again for companies.
All right, Isabel, thanks a lot. Really appreciate it. Bloomberg's Isabel Lee. For more conversations just like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else that you listen. Well, the striking news over the last 12 hours is what happened with Boeing. That stock is down 4%. And Air India Boeing 787 Dreamliner traveling from India to London's Gatwick Airport crashed shortly after taking off. It looks like it killed everyone that was inside. flight, over 240 passengers. Shelley Banjo is Bloomberg managing editor for Global Business. She joins us now. Shelley, I know they're going through the wreckage as we speak, but do we know what actually happened yet?
No, we still haven't figured out what the cause was. So this airport is known for sometimes bird strikes. That is one sort of thing that has been floated, but there's absolutely zero sort of idea as to what is happening. So Boeing has said, they're sending folks. GE, who made the engines, that are saying they're looking into it. And then obviously you have the Indian government, the U.S. government, because it's a U.S.-made plane, and then UK as well have said that they're going to, start. And this could take weeks, if not months, to sort of figure out what exactly happened.
Shelley, have we heard anything from Air India? Do we expect them to communicate with us at some point today?
Yeah,
I know
so
it's
they
much later in the day over there.
Yeah, they just came out, released a statement on post on X, and expressing their condolences, saying they're looking into it. It's really all they can say right now. This also comes on the backdrop of the Paris Air Show, which is one of the big Super Bowls for Boeing. And Kelly Ortberg, the CEO, was en route or meant to be en route to go to Paris. There's no word yet on whether or not he's still going to attend or not. Either way, it will have implications for the business.
And by a bird strike, we mean something like the birds fly in the engine, and then the engine stops working, and then therein lies all the issues.
Yeah,
is that
because
what we're
it was
talking about?
really right after takeoff. So it was right after takeoff. They didn't make it very far, and so that's sort of what we're trying to figure out, or what they are trying to figure out right now.
And this is unusual. I guess it's 787. I was telling George Ferguson from Bloomberg Intelligence how I love the aircraft. It seems like such a great aircraft. It's always fun to fly on one. We do get on one because they're brand new and they're so big and everything. But it's generally been a safe aircraft, as I understand.
That is why it is such a big deal for Boeing right now, because that Dreamliner hasn't been involved in crashes like this yet. Others have. This airplane was about 12 years old, and for what we understand, there hasn't been a spate of problems or something like that with this type of plane. And so if that becomes a problem for Boeing, that could be a very big problem for Boeing.
Is 12 years old for a plane? Do we know?
So it sort of depends. It depends how well it's maintained, and that's what we don't know yet. That's what we're trying to find out now. If a plane is maintained, fine. If a plane is maintained well, 12 years is fine. If it's not, then it could be a problem.
And that's another thing George Ferguson was saying. Tom Keene asked him, is plane maintenance kind of the same all around the world, the quality? And George says it's not, and so there are certain things. And so somehow how the Boeing will then come involved periodically to make sure it's up to speed and things like that. So there's a lot of checks in there, but things happen. What's the next? What are we looking for? What are you looking forward to next, Shelley, on this?
Yeah. So first of all, on the death count, we know so far they found or identified about 200 bodies. There's probably going to be more. There were 242 people on board, but from what we understand from reports, this went right into a medical school where people were sitting and having lunch. So the death count could get much higher. We still don't know. A lot of rubble. They're trying to pick people out. Then we have the cause. What we want to find out is, why did this happen? So that's going to require, is this a Boeing issue? Is this a GE engine issue? Is this an Air India issue? The answer to that could then, determine where this story goes from here.
Unbelievable. And that's sort of the scary part, is there's so many different layers.
And I saw some reporting that the pilot had just tons of experience.
Right, because he knew right away, from what I understand.
Yeah,
and he radioed air control. Okay, well, we will obviously be keeping you updated on any headlines as they cross, as this continues to unfold in the coming days and coming weeks. Shelley, thank you very much. Shelley Banjo is Bloomberg's managing editor for Global Business. Again, looking at shares of Boeing, down almost 4% after the Air India Boeing 787 Dreamliner crash shortly after takeoff. Just looking at those suppliers as well, looking at General Electric and Spirit AeroSystems, which of course Boeing is trying to buy, except for the part that is going to be dealing with Airbus. The plane was powered with those two GE engines.
Yeah, and I'm just looking at the, the stock of Boeing. It's up 16% year to date, up about 13% on a trailing 12-month basis. It kind of had seemed like they were beginning to put from at least the stock price performance perspective, they were putting some of their troubles from the last several years
in
the
worst
rearview
was
mirror.
in, right?
Yes.
Yeah.
And because I always kept saying to analysts, boy, it just feels like the time to go in and buy this thing. It can't get any worse. They've seen it all, and this is such a great company that you got to own it at some point, and maybe the stock is starting to move in that direction. So we'll have to see how this plays out, because as Shelley Banjo was mentioning, to the extent that it becomes a Boeing issue, that obviously would be an additional issue for this company.
Well, coming up, we also had some economic data out. Jobless claims are rising. It was the continuing jobless claims, actually, that everyone's really focused on, even though the producer price index was pretty benign. Jeffrey Cleveland, chief economist at Payne & Regal, will be joining us on his outlook for the U.S. economy. And Michael McKee, Bloomberg International economics and policy correspondent, will be joining us on both of those data points. Taking a look at the market, it is a really weird trading day. And I say weird because you'd think stocks would be higher on that data. They're flat.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News, with this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. 6 of the 11 major industry groups in the S&P 500 lower right now. The biggest drag coming from industrials, and that's home to Boeing, The stock also the worst performing stock in the S&P 500 and the Dow Jones Industrial Average. It is down right now 4% even. And also GE, which actually is GE Aerospace, that's down just over 2%. The maker of the Air India engines actually has a bigger weighting than Boeing in the S&P 500. I don't know if you've ever seen them test. I had the advantage of seeing them test airline engines.
Yes.
They literally throw frozen birds into the engines at full.
Are you serious?
Yes, seriously, and then check the engine for a deflection or breakage of any of the titanium fans. U.S. Producer Price Index rising 0.1% for the month of May. Got that data this morning. Muted inflation across the board. No sign of price shocks from tariffs yet on the data. And before the long bond auction, yields are lower. The long bond right now, the 30-year, down almost 5 basis points, 486. The twos, which are more policy reactive, they're down 4 basis points. That is at 390. S&P 500 up 10 points. The Dow 28 points lower. NASDAQ 100 up 43 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele and Paul Sweeney live here in the Bloomberg Interactive Broker Studio in New York City, or streaming live on YouTube as well. All right, let's talk inflation. Yesterday, remember, we had the CPI data came out, and it came in a little less than expected. So we called that benign inflation, I think was the term we used. As John was just mentioning, we got the PPI out today. John characterized it as muted. I'll go with that. PPI final demand month to month, 0.1%. Consensus was 0.2%. And then if you annualize all this stuff and say PPI X food, energy, and trade year over year, came in at 2.7%. Consensus was 3%. So that's a pretty big beat, I would say. Jeffrey Cleveland joins us, chief economist at Payden & Regal out there in L.A. Jeffrey, what did you make of yesterday's CPI, today's PPI? What's your call on inflation these days?
Well, Paul, not only was it benign for May, that's 4 months in a row. So 4 months in a row after, a January hot start to the year, CPI has been soft. I know the inflationistas listening are going to say that, just wait another month and the tariff toll will hit. And that is possible. But I would point out that in the data we saw yesterday, it wasn't just that goods prices were soft, also services prices were soft. So, housing,
Jeffrey, are we all clear?
But also non-housing services. I wouldn't say they're all clear, Alex, but I mean, it's we're getting there. We're getting close to saying all clear. I think another couple of months, I'll declare the all clear. I think also with this morning's PPI, you throw that in the mix, you can imagine a soft reading for core PCE when it comes out at the end of this month, which is what the Fed is more focused on. And I think very good news for the central bank and for the bond market. So soft inflation readings.
So Jeff, is we're not necessarily seeing any inflation in the numbers yet. Maybe we will in the future. Is that a reflection of companies just kind of eating the cost increases that they are experiencing, maybe taking it in their margin as opposed to passing them along to consumers?
That's a possibility, Paul. It's possible. We just haven't seen the pass through yet. People are shifting their behaviors. People are making up for it in other ways and not passing it through into prices. I think all of those are in the mix. I think for one thing we've been telling clients is that keep in mind imported goods in terms of the PCE index are 6, 7, 8% of the index. So you could see potential price increases on those goods, but you have to keep in mind most of what you spend your money on, Paul, are things like services. And those, we still see scope for services to continue to cool off. And certainly we saw that in May. So that could outweigh some of the tariff price increase. So that's a good news. So I think by the end of the year, so if you can look out 6 months or so, I think inflation will continue to moderate.
Okay, so if we are in this disinflationary environment right now, well, actually, would you categorize this as disinflation?
Oh, yeah. I mean, we peaked in 2022 at a very high level on core inflation. It's been coming down. It's been coming down slower than we would have hoped, but it is disinflating. So I think we're definitely in a disinflationary environment right now. Yes.
So if it's disinflationary, is that enough for the Fed to cut in July, September, preemptively?
I think you have to step back here. If you put yourselves in the shoes of the Fed, you're at 450 on the funds rate. I would categorize that, Alex, as restrictive. So they have a restrictive policy setting. But we know, we just talked about it, inflation is cooling, disinflation. And the other thing that you brought up earlier on the segment, which was wonderful, we are seeing a slowdown in the labor market. So with that backdrop, I think the next move from the Fed is a cut. The question is, when are they comfortable doing that? I don't think it's likely next week, but I think the market should start pricing in July, should start entertaining July. But we think by September, guys, we'll have some evidence enough where they could possibly cut.
If that's the scenario and inflation, is not necessarily a concern here or a big concern, what does that do to your GDP outlook for the remainder of this year?
We cut our GDP, Paul, after the tariff turmoil really broke out, starting February 2nd. That Sunday afternoon, my team got together and we cut our GDP. So we went down to 1% for 2025, Q4 to Q4. We brought that actually up a little bit in recent weeks. So we're around 1.5% for the year. That's not a recession, Paul. I would characterize that as subpar economic growth, so sub-trend. But that doesn't really change here with this disinflation story. I think that will be the case. We'll have subpar growth. We'll avoid a recession, but we'll have disinflation. That's good for bonds. I think especially the long end of the Treasury market is really been pushed up by fears of the fiscal, fears of inflation from tariffs. And if all of that sort of fades, man, bonds look good. We have a good setup here for the bond market over the second half of the year, in my view.
Really? Deficits included in that?
Yeah, I mean, the deficits, Alex, this is the most widely known story on earth. Talking to global clients for years, they've been looking at the U.S. budget deficit. It's huge. I'm not denying that, 6 or 7% of GDP. I don't think that's going to change next year with the big, beautiful budget bill. But I think that's priced in. We see that in, I think, the slope of the curve in term premium that's been built into 10s and 30-year treasuries. So that's a known. I think as we move on beyond that, people are going to realize the real story here is, okay, what happens with growth and what happens with inflation? That will drive markets.
Hey, Jeffrey, I know you're in LA. You're an LA guy. Give us a sense of what's happening out there.
Well, I'm 25 miles from downtown LA today, as you can see here in the home office. Part of that is because Payden & Regal offices are, in the heart of it, downtown Los Angeles, which enjoyed such a great resurgence pre-COVID. It was a renaissance, if you will, of people living and working down there. So the events that we've seen in the last week or so, really unfortunate, causing a lot of uncertainty here on the West Coast. I think as far as it pertains to the economic data, I mean, the big thing we're watching here, Paul, is the labor force. You saw that actually in the May jobs report. Labor force participation went down. We like to look at the labor force flows. So every month you can look at the number of people that are going from being employed, for example, to out of the labor force. And in May, that number was the biggest increase that we've seen outside of COVID in the last 25 years. It could be retirements. It could be people leaving the labor force for reasons other, than work-related, maybe family-related reasons. But it could also be related to the immigration issues. So I think we need to keep an eye on that, because the labor force participation is a key part of economic growth.
Jeffrey, thank you so much for joining us. Really appreciate getting your time. Jeffrey Cleveland, Chief Economist, Payden & Regal, joining us via Zoom from Los Angeles, where he is based. Michael McKee darkens the door here. He does all the economic stuff for us here at Bloomberg. Mike, we were just talking to Jeffrey Cleveland about this. I mean, if you look at the CPI data yesterday, the PPI data today, I'm like, I'm not seeing any inflation out there. Is this just a timing thing? Do we need to be patient? Or is there something else going on in the economy that may be mitigating some of the tariff-related inflationary pressures?
There's a little bit of all of that in there. The biggest thing is the tariffs haven't really hit yet. Most of them were paused by the president. In areas where we have had tariffs, like steel, we did see in the PPI today a 7.1% rise in steel prices last month. So there are sectors affected by tariffs where tariffs are leaking through. In the CPI, washing machines went up over 4%. So there is some pass-through that is happening. But for the most part, we're still waiting to see what the tariffs are before we get the tariff effects. Interesting note, speaking of Donald Trump and not knowing what he's doing, Jeff Cleveland was just talking about the labor force flows. And especially out in California, I don't know if you saw this tweet a few minutes ago from Donald Trump about the farmers complaining that the deportation policy is taking a lot of workers away from them, and it seems to be getting on the president's agenda. And he says changes are coming. So I don't know what that means, but I'm sure that people in many agricultural communities are worried because it's the undocumented people who come in and do all the work in the fields, and those people, as I understand it, have started to disappear because they don't want to be disappeared.
Yep.
To that point, when we saw the continuing jobless claims increase, so basically people who are unemployed are having a harder time getting jobs, why? Like, is there a sector breakdown?
No, there's not a sector breakdown, but what we're seeing is general reluctance by companies to do anything.
Oh, I see.
They're not. It's not that they're letting people go in vast numbers, and they're definitely not hiring. They're waiting because they don't know either, and that's what you get from all the Fed officials that you talk to or I talk to these days. Is they're relying on what companies are telling them they're doing, which is basically just sitting and waiting for some sort of guidance on which way the administration is going to go. If Trump takes off all the tariffs and they lighten up now on the immigration thing, then maybe the economy starts to rebound and people feel better about it and companies go back to investing. Otherwise, they might start laying people off, figuring demand is going to slow.
And the jobless claims, 248, is that getting to a level that gets your attention at all, or we just let's look at it?
It would be if we thought that that was an ongoing process. The problem is this is a time of year when it's really hard to seasonally adjust for jobless claims because the dates of the things that happened, like Memorial Day, and then when school gets out, move around. And this is a time of year when a lot of people who work in schools, not teachers so much, but all the support people, they get laid off because it's the end of the school year, and so they can go file for jobless claims. And so the Department of Labor knows this, and they try to adjust for it, but they can't get it exactly right.
I see.
But we haven't seen a big spike. We saw it go up, and then it stayed that way. If it goes much higher, then you would start to worry.
All right, Mike, always appreciate it. Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us there. And just taking a look at what's happening in the bond market, we are off. The bid is strong, but not as strong as it was, is what I mean. The 2-year yield is now down only 4 basis points. You got the 10-year down by about 3.7 basis points there. So what that winds up meaning then for the Fed, as Jeffrey Cleveland was talking about, he thinks that they should go ahead and cut, that the disinflationary trend could stay. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages right now mixed a little change. Bond yields, they're pushing lower, the dollar falling. Oracle right now the leading technology share for predicting cloud infrastructure sales are going to jump more than 17%. Also the best performing stock in the S&P 500 shares up close to 14% right now. After the Air India crash, Boeing shares worst performing stock in the S&P 500. They are down 5%. And the maker of the engines on that aircraft, General Electric, those shares right now down 1.7%. The Treasury is selling $22 billion of 30-year bonds this afternoon. Now, this auction comes as Double Line Capital's Jeffrey Gundlach warns the long bond has lost its haven status.
The long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%.
Gundlach telling Bloomberg a reckoning is coming. Surprisingly poor reception for last month's 20-year auction. That contributed to the bond sell-off that pushed 30-year rates as high as 5.15. Right now, the long bond is at 4.87. That's down about 4 basis points. S&P 500 up 16 points at 6,039 in the index. The Dow Jones Industrial Average up 25 points, and the NASDAQ 100 57 points higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right. Thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. All right, let's check in with one of the best technology analysts out there, Dan Ives, Global Head of Technology Research over at Wedbush Securities. He joins us now. So the latest is that Elon Musk has an apology tour now. Reportedly, he spoke to President Trump. He said he overdid it. He posted on social media. Does this calm down Tesla?
I mean, look, that was the overhang, right? I mean, you don't want a BFF to turn into an enemy, especially when they're in the Oval Office. And I think it was a smart move. I mean, obviously, hotheads, things got a little wild. But I continue to believe Trump and Musk will be friends again. And Trump's a supporter of Tesla when it comes to ultimately the autonomous vision. And that continues to be key around robotaxi.
Yeah, let's go to robotaxi, Dan. Can you tell us kind of the timing around it, the market opportunity around it, the competitive nature? What do we need to know about the robotaxi business?
Yeah, I mean, and that'll be late next week. It looks like when it's actually, going to launch, or in maybe potentially June 22nd. But this is in Austin. This is going to be a small launch, but it's the start of what's going to be 20, 25 cities around the country in terms of basically a Waymo-like vehicle that Tesla is going to be able to scale and scope that's going to be unmatched. I think it's going to start, obviously, in a more of a ring-fenced, small area in Austin. But this is the beginning. We believe it is worth $1 trillion to the story in terms of the autonomous vision. And I continue to view this as probably, not just one of the best AI plays out there, but probably the most undervalued AI relative to the technology I see at Tesla.
But aren't there better ways or less stressful ways to play AI where you don't have a key man risk overhang?
Yeah, and now, I mean, our view is it's the Ives AI 30, right? It's, in terms of the report, yeah, this is the autonomous way. Akko's the nuclear way. The godfather of AI, Jensen NVIDIA on the semis. Hyperscalers, Palantir, obviously one of the best pure plays. There's different ways to play it, but in my view, you can't just play it on semis. Can't just play on software. You have to play the whole theme. And I think when it comes to autonomous, Tesla continues to be the best way to play it.
So broadening out a little bit, Dan, U.S.-China, we had some news come out from President Trump about maybe after the London negotiations between the U.S. and China on trade. Still, we're sitting there with, I don't know, on China, the best I can read is still 55% tariffs. That's still a big, big deal. How do tech companies like an Apple, how do they deal with that?
I mean, I think also investors are viewing this 55% is probably the start. I mean, I think there's a view that that's going to come down. I think that's how the market's reading it as more negotiations come out. And I think there's going to be a lot of loopholes and a lot of exceptions. I think when it comes to tech, they're going to have to play both sides of the fence in terms of pivoting like Apple to India. But when it comes to NVIDIA and Jensen, I think that's the next big thing everyone's waiting for. What does this mean in terms of export controls? And will NVIDIA in some way be able to sell into China instead of handing that business to Huawei on a silver platter?
So, Dan, what else are you looking at? Like, okay, so we got through all the earnings. We got through Oracle yesterday, right? We got through the Musk and Elon, the Musk and Trump disaster. What is next on your radar? What's going to be a catalyst for your industry?
I mean, to me, it's all about the use cases, expanding on enterprise, and that's key. The hyperscalers, the oracles, of course, the semi plays as well. You're going to be looking out for they're loosening on the export controls in NVIDIA, and that's important, especially around China. But I think the big thing is now the consumer piece that's going to play out from Meta to what I view as really autonomous to robotics. I mean, that's the golden goose is physical AI. I think autonomous and robotics are going to be probably the biggest theme within AI. So to me, investors continue to kind of, I think where they're wrong, they continue to be skeptical about AI. I don't think there's any skepticism out there. I mean, you spend all of our time traveling around the world. This is a fourth industrial revolution. It's why I believe we're going to be talking about NASDAQ 20,000, NASDAQ 25,000, and so on over the coming years.
So, Dan, when we think about AI, one of the question marks in your world, Dan, and the world that touches almost everybody out there, a couple billion people, is Apple. I'm wondering, is an acqui-hire, which is something Apple historically has not done, or at least in scale, I kind of feel, I'm probably like a lot of your clients, I feel like they're kind of missing the boat here, and I keep waiting for them to jump on here, and they don't seem to have been. What's your call there in Apple?
I mean, look, you could call it a snooze fest, in terms of Monday. I mean, it was a little time warp back to 2018, right? So, I mean, right now they're in the right lane going 45 miles an hour. Every other big tech player is going 100 miles an hour left lane. It's my view, like acquisitions are going to have to do, even though they historically haven't done it. But I think it was clear on Monday, we walked out of there for the first time coming out of Apple Park, kind of shrugged the shoulders.
Okay, sorry, I was getting distracted by your hat. So for those of you who are on radio, usually we're used to like Dan's really loud colors and jackets and stuff.
That's
but you have a hat. What does it say? Epic.
Oh, I mean, epic. Now it could be used to describe Sweeney as epic or AI.
Back in the day.
You could use it in a few different ways.
Okay, that feels important as Dan Ives does stock analysis from a car, which
Exactly. We've done it all. I remember doing it first with the BlackBerry, driving between meetings in like Minneapolis and stuff like that. That was way back in the day. Dan Ives, thanks for joining us. Appreciate getting a couple minutes of your time. Dan Ives, Global Head of Technology Research at Wedbush Securities. Of course, we all believe that Dan Ives peaked when he was a student at Penn State, Happy Valley.
No,
and
he
it's
has
been
an
all
ETF
down.
now, named after
Oh, that's
him,
right. He
right?
has an
I mean,
ETF.
come on. Maybe that's
Exactly,
his peak, though,
exactly.
at the end of the day. In the markets, it really is about the dollar today, it feels, falling to its weakest level in about 3 years. But then you wonder, do you wind up getting analyst calls for equity markets being like, hey, that's actually good for company earnings?
Yeah, I know. It's interesting because we haven't seen this. And some FX people we had on today said, don't worry about it. A 9 or 10% pullback in the dollars, it happens. And maybe it's part of it's just selling off because one could argue it was overvalued coming into all the euphoria of the beginning of the year and the new presidency. So that maybe this is healthy. And others are suggesting, no, this is structural. This is the market telling you something.
Well, that's what I was wondering. Like when you get cyclicality that then transforms into structural. And so does it mean that all of a sudden the dollar's toast? Well, no. But can the dollar sustainably then be down 10, 15%? And if that's the case, then what winds up happening to other markets, to earnings, to other FX? What does Japan wind up doing with that? What is it? Can the Europe capitalize on that? Does the Europe want a structurally higher euro?
I'm going over to Italy in the fall, and I got the euro. 115 is crushing.
You remember when the euro was like, was it over 2 or was it the pound?
I can't remember.
But either way,
I still have Deutschmarks in my drawer, so wow. Coming up, Nathan Dean, we're talking some policy stuff. This is Bloomberg.